Good, good morning. I'd like to start our meeting this morning, if we could. It's 10 o'clock. Ms. Jill, if you'll take the roll.
Yes. Mark Lenny.
Here.
Justin Campbell. Chad Bradford.
Yes, ma'am. Here.
Ken Sutton. Art Leary.
Here.
We have a quorum.
Fantastic.
We have a quorum.
So let's go to the approval of minutes. Has everybody had a chance to review last meeting's minutes?
Motion to approve.
Motion by Mr. Leary, second by Mr. Leonard. All in favor? Aye. Next up would be Mr. Gia of Sawgrass. Good morning, sir.
Good morning, everyone.
How are you?
Good morning.
Glad you're here.
Thank you. Here. Morning, everyone. Again, third indeed on this progress asset management portfolio manager. Before I begin with the presentation today, I'd like to thank you again for the opportunity to manage your fixed income portfolio, which we honor. Today, we're going to talk about the portfolio review, but before I do that, let me get into the current state of the bond market first, and then we'll get into the performance and then the outlook, what we see at least in the near term. So just to kind of summarize, for this year, the bond market unfortunately has been another year of disappointment. The expectation at the beginning of the year was for finally the bond market would come back from a major loss that we experienced last year. We saw a huge increase in rates last year. Everybody kind of got caught by surprise in terms of the magnitude that we saw on the recent inflation increase, and the Fed was essentially forced to follow that trend, and that's what caused the major fall in the bond market. But at the beginning of this year, the expectation was that we would have a decent bounce back in terms of prices, meaning rates would level off a little bit, but we didn't really see that as much as everybody expected. Inflation continues to be a little bit stubborn. And I think the reason for that is that if you look at the CPI, which is the main inflation gauge data, the composition of that, over 40% of that is only the equivalent rent. And that major variable is all survey based. It's not really real-time data. And unfortunately, the Fed really goes by that number. But when you look underneath the hood, the reason why we're confident that inflation is actually peaking and it's trending in the right direction, and it's on pace to reach that 2% target for next year. We look at the real-time data for major vendors like, apartments.com or Zillow.com, and we look at the rent composites. Those numbers are actually flat year over year. New home prices, the most recent data that just came out, that index is actually down 18% year over year. So these are all leading variables that ultimately will make their way into that owner's equivalent rent portion of the CPI. And that's why we think that the true inflation number is actually much less than what the headline is actually giving us. The most recent CPI print that we got was roughly 3.2%. I think we're closer to sub 2, and we should be on track to have that 2% by the end of next year. So based on that thesis, given where the nominal rates are, which we're talking 4.5%, and we recently reached 5%, but we quickly came back from that. I think that is actually provides a decent real yield going forward. Let me get into the performance first, and then we'll talk about the attributions, and then we'll get into the outlook. So on page 10, I got the performance at 930. As I mentioned, it's been a truly volatile year. The volatility of interest rates, it dwarfs the volatility that you see in every other asset class, especially VIX, which is the major gauge for the equity market. If you compare the interest rate volatility, it's multiples of what we're seeing on the equity side. So it's truly been a very uncharacteristic market for the bond side of the asset allocation. But that is kind of sort of to be expected because we're in this kind of transition period where we don't know, well, initially we didn't know what the Fed is done with the rate hikes, but now there seems to be more evidence that the Fed is pretty much done with the rate hikes. We went from 0 to 550 in breakneck speeds. Now we're trying to see the lagging side effects of the economy, if the economy can really handle these types of rates. But with regards to the performance, unfortunately, for the calendar year-to-date numbers, we underperformed as
Oh,
Mike wasn't on.
I'm so sorry.
Let me ask you, could I, the chair would permit me, could you talk about the yield of maturity and how that, what that means in terms of, let's say, a pivot by the Fed to push rates back down, let's say rates go down 1%. Explain to them what this is telling us about the expected return of this portfolio in that example.
Right. So the yield to maturity factors in two things, right? It factors in the coupon that you're getting on the bond, plus the state of where the price is of that bond relative to the par. Remember, every security you own in your portfolio is going to mature at some point at par, right? If you buy it at a premium, you're going to mature it at par, but you're getting a decent coupon. If you buy it at a discount, it's going to mature at par. You think you get a gain, but you're actually getting a much lower coupon than what the market rate is supposedly. So based on that principle, the yield captures the combination of those two things. So it's truly giving you the state of your true earnings, right? So what that says is if rates stay at these levels, at least for the next 12 months, you're going to earn that 5.5% carry yield, whatever you want to call it, income, right? Real income. To Burgess's question, if for some reason the rates move lower on a parallel fashion, meaning across the entire spectrum of the maturities, which sometimes it's rare to find because in real world it changes. But let's just say it's a parallel move. The expected return, because of the duration of roughly, say, 7 years or 6.5%, 6.7, call it for ease of math, 7 years. The expected return over the next 12 months would be the change of price as a result of the change in the interest rates, plus that carry, which is 5.5%. So if we have 100 basis points or 1% move lower in rates, the expected return for your portfolio in this case would be 7 plus 5.5. So that's roughly, 12.5% total return over the next 12 months.
Okay, so what do you think the likelihood of a 1% or 0.5% decreases I know you have some predictions in your office and you look at the futures market, but what's your outlook for the next couple of years?
I think the outlook is that, at least based on the empirical data, my personal observation is that we're starting to see signs of cracks. Unfortunately, we should have had a recession by now, given how restrictive Fed has turned out to be. Nobody expected that we would go from 0 to 5.5% in such breakneck speed. Even the FOMC members, if you go back and look at their forecast, 2 years ago, for example, Kashkari, he's the president of the Minneapolis office, and he's an FOMC member. If you look at the actual official record of the forecast, he had 0.75% expected Fed funds rates 2 years ago for 2023. so you can see the delta there is incredible. Right? We've gone from that expectation to now 5.5%, which is the highest yield we've seen over the last 20 years. So it's a huge deal for the bond market. In my personal observation, based on what I see in the economy, I see signs of the economy starting to crack. The housing market is completely upside down from an affordability standpoint, given where the prices are, where mortgage rates are. And it's a bit of a zombie type market where the new home builders are taking advantage of this lack of mobility. But the true economics of that market it's really hard to square. And that ultimately will trickle down into the real economy. And you're starting to see a lot of things. For example, the leading indicators have been negative for the past year and a half. That's a leading data that is telling us that the economy is expected to roll over or at least slow down from a growth standpoint. I think it's going to be an environment where if we start seeing signs of cracks and the hard landing theme is back, I don't think the Fed will only cut rates by 50 or 75 basis points. I think they're going to cut back down to 1% to save the economy. So this notion that, we're like in this new environment, higher for longer, the Fed funds rate will be at 3% floor, I don't really buy into that concept.
Well, the reason why I want to talk about this, and I'll get more into it at lunch, but that would be an example of a period where bonds do well, what he's referring to, and stocks wouldn't be doing well. So you have that negative correlation relationship between the two, which is why we have both stocks and bonds.
And I would fully agree in that type of environment. So that's why I'm a big believer that now it's actually even a better time to own this particular asset class that has struggled from a performance standpoint in the last 2 years. But because of this diversification benefit and the fact that you're not getting paid to not really take a whole lot of risk. If you look at the relative valuations from bonds where equities are trading, and that's basically the street calls it the equity risk premium. That is actually near the recent lows of the last 2 decades. So that tells you that bonds are significantly more attractively valued than equities in this type of environment. So as I mentioned, going forward, you got a 5.5% yielding portfolio. We are a little bit tad long duration, meaning we're a little bit got more sensitivity to interest rates because of our view that the economy is most likely going to slow down and we might get lower rates going forward, because now you're getting a decent real yield, which is the difference between the nominal yield and what the baseline inflation is. So you're actually getting paid now to take this type of risk. So on that basis, we have increased the duration. As I mentioned, we've gone overweight mortgages, but not just the current production mortgages, which come with a 7% coupon. I've been buying the legacy production at 3.5%. And the reason for that is that you're getting a decent spread on that mortgage, but the prices on that is like in the mid 80s, right? So from a prepayment risk, because that is the key risk for mortgages is really the prepayment risk. You and I get in mortgages and we got the mortgage broker on the speed dial. The moment I see rates going lower, I'm going to call him to get refinancing on my mortgage. Well, when we refinance collectively, the holders of that mortgage-backed security, the ultimate investor, that is the side of the ledger that actually loses in that equation. But if you're buying these way out of the money, meaning at a significant discount, the prepayment risk is not there, and you're getting a comparable spread to a credit instrument. So we think that from a quality standpoint and risk-adjusted standpoint, it's a very attractive asset class right now. But it's struggling a little bit because of the technicals. Typically, the biggest buyers of this particular sector have been the banks. And we all saw what happened with banks back in March. They were a little bit upside down from risk management standpoint. A couple of banks failed. The Fed was basically forced to essentially bail out the system, implement a couple of measures. And then from that standpoint, since then, we've seen a lack of demand from the banks. And that's one of the reasons why mortgages are struggling a little bit from a relative standpoint. But over the next 12 months, especially given where credit is being priced, we think that that is actually a very attractive risk return asset class to own. So we are overweight mortgages. On corporates, we are overweight in dollars, but in sensitivity, we're underweight. So from a price performance, if you have a sell-off in the stock market and credit spreads, they typically are related, right? Because it's basically a credit risk. It's an equity risk. Most likely they would underperform. But because of our composition, yes, we are overweight in terms of dollars, but in terms of sensitivity, we're actually underweight. So we would benefit relative to the benchmark. So net, we're underweight credit risk, overweight mortgages. Yes, we're underweight treasuries, but mortgages are government-like. You don't have the credit risk. So in total, I would say you got a high-quality portfolio with a decent carry and very bright future in terms of the expected returns going forward, unlike what we've seen in the past 3 years. So with that, I'll conclude my brief remarks here, and I'll take any questions if you have any.
Yes, trustees, I always like to say that I'm not qualified to give investment advice. That's why you have Burgess, but I do like to ask questions. And I wanted to pick up on the last theme you had, which was bright future. So if we could go to page 10. Page 10 shows the returns, and I appreciate that Sawgrass said not just a customer service rep, but a portfolio manager. So I very much appreciate when trustees explain some of the terminology that you're using, that you're a manager that's making the decisions
Right.
For the fixed income portfolio. So 2 questions. The first question is, because I've never seen it, for a 3-year period, and this has to do with what was going on with Fed raising rates. Have you ever seen on a 3-year period negative 5% return for bonds? Because bonds are supposed to be stability, the anchor, if you will. So that's the first question. Have you seen that over a 3-year period, that kind of a negative number? That's question number 1. Question number 2 is your bright future observation, which is because of the higher rates now, you're comfortable that things are looking smooth sailing with the future.
Yeah. So
the good news, bad news. The bad news is the performance in the last 5 years.
Right.
The good news is the higher rates should lead to a pleasant meetings going forward.
Correct. So first question, no, we haven't seen any observation in the past since the indices started tracking the data that you would have a 3 consecutive year. And even on a calendar, because this is on a fiscal year date basis, but even on a calendar base, we're on track to generate a 3rd consecutive negative number from a total return standpoint. That has never happened in the bond market before, primarily because we always had decent coupon in the past. Like remember the 80s when we had high inflation, but we had 15% rates or 10% rates, the good old days, right? But even in the 2000s and the 90s, you still had a 5.5% at least type of average coupon. So even though you had sensitivity in the moves of rates, the carry that you got, meaning the income from the coupon, was enough to offset that volatility of price movements. So at the end of the year, it was hard to make the math work that you would generate a negative total return. Well, in today's world, because of where we were during COVID, because the Fed was forced to bring down rates to 0, we started from a 0 interest rate base level. So when you have that type of breakneck speed, as I mentioned, we went from 0 to 5.5% in a year and a half. You don't have that coupon that you had in the 90s and 80s to offset the move that you got in the price. So unfortunately for this time period, because where we started in terms of the base level, it was hard to avoid that type of expected return. So that's kind of explains this historic move that we've seen in the bond market where everything kind of readjusted. And now we're basically back to being a little bit more closer to that normal equilibrium that you would see in the long run. But it was that period of what we call the financial repression, where we had a very low rate for a long period of time. And that was primarily driven by the monetary policy.
I would add that partially informs the discussion of the ordinance, at least on the bond side. We're expecting things to have returned to normal, which again, that will inform the conversation with regard to the ordinance that we'll be talking about.
Yeah. And to answer your second question, the reason why I mentioned the bright future is because we believe that the Fed is still targeting that 2% target. They haven't given up on that. They're fighting to make sure that the inflation expectations are going to be near 2%. And on that basis, if you look at the long-term rates, you're getting a decent 2.5% real yields. In my opinion, given the leverage that is embedded into this economy, which is typically a credit-based economy, heavily reliant on consumption, it needs low rates to really do well. That's pretty much what it comes down to, right? If you look at the demographics, the overall leverage in the system, we simply can't afford high nominal rates at this point. So I think that we're going to settle at some level lower than where we currently are. But even if we keep these current levels, we're still having a decent total return for the next years. And given the fact that you have this long-term mandate, this in terms of the maturity, the objective, you actually should be cheering the fact that you've got higher rates, because yes, you took a hit for 3 years, but if rates don't move at all, right, for the next 20 years, you'll be accruing that type of yield. And from your actuarial standpoints, you're actually better off. So that's the flip side of viewing, higher rates. Yes, sir.
You have to make room for your other guests. So
I didn't mean to be that detailed.
are there any questions?
I would like to ask one question. What do you consider normal return? When you say getting back to normal.
No, I'd say normal. If you look at the return distribution and you kind of provide that bell shape that the statisticians love to look at, and you look at the observations, the majority of those observations kind of ranges between 3.5 and 5.5. That's kind of where you've been for the most part. And we're kind of in the middle of that. So that's why I'm a little bit more comfortable now than when we had, 1% yielding portfolio that was extremely stretched. And there's not a whole lot of room there to generate excess return. But now going forward, because you got a decent yielding portfolio, I think I would say it's a bit more normal environment for fixed income. All right. Well, thank you. Appreciate it.
Thank you, sir. A motion to accept the report is read. Motion by Mr. Leonard. Second by Mr. Leary. All in favor? Aye. Hey, Mr. Madron, you're up.
Morning, Dwayne Madron, Portfolio Manager, Capital City Trust, and presentation is up on the screen. And you may have it in your packet or in front of you, which has the blue stripe on it. And we can turn the page or scroll down to the policy review. Before I get into the stance, let me just talk about the economy and what happened in the third quarter, which is what I'm here to report on. The third quarter was for equities, not a great quarter, because during the third quarter, inflation raised its head, and that caused stocks to go down. Also, at that point in time, stocks had a good run up, so they got a little expensive. Inflation came in a little hot. Stocks said, I don't like it, because the Fed chair could keep raising rates. So stocks sold off and rates went up a little bit, and which caused bonds to sell off too during the third quarter. But late in the third quarter, consumer spending and economic growth proved to be better than people thought. And that was a saving grace. And you see that in November. The market is finally reacting to the fact that growth was better than anticipated, because the consumer drives 2/3 of our economy. The consumer has been keeping the economy going because he and she are out there spending money. And how are they spending money? Part of it is pent-up demand from COVID, pent-up savings from COVID. But as a banker, we see credit card delinquencies and auto loan delinquencies going up at a fast rate. So people are using their credit cards again, and that has been driving some of the spending. And that's a concern. How can the spending keep up if people keep using debt? So that is a concern that I'm looking at, or I think about a lot. The other concern I have is that during the third quarter, or recently, maybe not during the third quarter, Moody's downgraded the outlook for the U.S. Treasury, still a AAA, but downgraded the outlook because of their lack of confidence in the U.S. to govern itself and keep its debt under control. That is always in the back of my mind. And that caused a little bit of concern in the market. Rates didn't change much, but it's the second credit agency to do this. So that had me concerned. And so, however, equities have been up high, close to their cap for the pension fund, because of the fact that eventually rates will come back down, and that will spur equities and bonds to go up again. I don't know when that's going to be, but it's very close, I feel. So I wanted to keep equities up there when the day comes that rates drop. And sure enough, on the last 30 days, they've dropped. They were as high as, I think, 5.3, and now they're at 4.4. That's a huge drop, and it caused November to be one of the best months, one of the best Novembers we've had in a very long time. So having said that, if we look at the policy review, you'll see where on the large cap equities, I'm 37%, slightly underweight, because at that point in time, equities had run up and become expensive because artificial intelligence had sort of sucked all the technology valuations up. So as 37% versus the 40% policy weight is where I was on as of November 14th. International and the rest of them are pretty much right on. I try and stay very close to Burgess's model, and you can see everything is within 0.5%, and the underweight to large cap reflects itself in small overweights in the other asset classes. So still the car's in fifth gear, waiting for growth to return and rates to fall. Any questions on the policy stance? If not, we can go on to account performance. This is the fiscal year performance. You can see the latest quarter, the equity side was down 3.7 because, like I said, inflation raised its head and stocks had gotten a little expensive, but the year-to-date number and the one-year number are the same, 14.69%. So your fiscal year equity return was about 14.69. The equity itself was 17.2, slightly behind the S&P 500 because small cap and international lagged US, and sometimes it does. And high yield bonds, however, returned 9.75, an outstanding return for the high yield section, handily beating the bond market because of rate volatility and an optimistic outlook for credit in some of the lower credit quality sectors of the bond market, which is the high yield. So 14.69, probably not back to even from what was caused in 22, but we're pretty close. And now that November is a great month, we may be back up to where we were. And then you look at the last 3 years, 6.49. In each of the last 4 years, 6.57. And you can look at how high yield has contributed over the 1 year and the 3 year and the 5 year, beating the Bloomberg aggregate. That's been a great value add. You want to turn the page to page 5, scroll down, we can see the end of October. October was not a good month because there were concerns about rates and other geopolitical events. And so the latest quarter as of October was 9.34. And the year to date, which is the first month of the fiscal year, we're down 3%. But the latest 1 year ending October, we're up 4.6. Equities are up 5.8. And because small cap and international don't do well in a struggling economy, returns are lower than the S&P 500, which tends to be dominated by large tech companies. But sometimes that changes. When the economy picks up steam, you'll see small cap jump forward because small cap right now is a little cheap or cheaper than large cap. So we're all waiting for that day to come. You turn over to the asset allocation, page 7, as of November 16th. On the equity side, we're 70% equity, which is high. It's about as high as it's been. Last week, I pared it down to 67% because stocks had gotten almost to a record high where the S&P is approaching 4,600. So I shaved off some profits last Friday. So it's now 67, and that money went into cash, which is yielding 5.2, which is nice. But by and large, the car's in fifth gear. We are waiting for growth to come back and rates to drop, in which case stocks and bonds will do well. I'm hoping that stocks will do better than bonds. They usually do, but bonds are there as a diversifier of equity risk, and they do a good job with that. Page 8 are the holdings. You can see the Fidelity and the Vanguard index funds, Euro Pacific Growth, convertible securities, exchange traded fund, and then on page 9, the Sawgrass Value and the high yield corporate bonds, which are now yielding 6. The other day I saw a Ford bond, which is BBB rated, at 7.1. Would you buy a Ford bond for 7.1? I think I might. 10 years at 7.1. So bonds are looking good. So are stocks next year, just not the last 9 months. That concludes my comments. Any questions? Okay, thank you very much.
Thank you, sir. Motion to approve by Leonard, second by Mr. Leary. All in favor? Aye. Thank you, sir. Up next, Mr. Burgess.
How are you?
Hey,
Good
man.
morning, everybody. Any questions before I begin? Okay. Let's get started. Let's just go right to page 1. You may not be able to read this, but take away from this is that we've really reached a period where the yield to maturity and the coupons available in the bond market really are at a 20-year high. And so the so-called risk premium in owning stocks versus bonds, that premium has really narrowed because of this high interest rate environment. That's good if you're a holder of bonds, and it really causes one to pause and ask, do we have the right asset allocation? Do we have enough bonds? Does it make sense to add more bonds to the strategy? And so these are the kinds of questions that we're having with all of our clients. And frankly, for the last 15 years or so, last 10 years, really 12 years, much of the talk has been on how to replace bonds and how to substitute bonds, to bring in other asset classes, alternatives, because bonds were not doing the job. And just keep in mind that bonds weren't doing the job because the Federal Reserve brought rates down for so long to such low levels, they essentially corralled everybody away from bonds, all right, over into stocks. So that's what they did. So rates came down further. And as was pointed out a little while ago, we ended up with such a low coupon environment that once rates did come up very fast, we didn't have that offsetting buffer effect of having that high income to offset the depreciation of the bonds. So next year, we'll have more conversations with you and others regarding the possibility of actually stepping back into a higher allocation to bonds than we've seen here in quite some time. All right, let's go to page 4, please. So roughly 90% of this program is indexed. So Cap Cities has put together both on the actually it's not quite that, it's more like 80% is indexed. So we have a combination of bonds and stocks that are indexed, and then we have private real estate, which is kind of an alternative that you have here. So on the top of page 4, you can see that overall the plan was down about 380,000 for the quarter. And as Dwayne pointed out, equities peaked in July. The euphoria wore off when it appeared the Fed was not done raising rates. And that's the main reason for that dip. So we had a nice year-to-date return going into July, but then we saw things start to fade off in the third quarter. The headwinds mainly came from the Euro-Pacific equity holdings and a little bit of a headwind from Sawgrass, which we discussed a minute ago. Fiscal year-to-date, the plan still eked out a gain of 683,000 or 8.2% net. And you notice that the gross net delta there is about 0.2%. That means your expense ratio is very low. It's about 0.2%. Your peers are generally closer to 0.6%. So you're running about a third the cost of your peers. And that's because they have the emphasis among index funds. When I looked at this thing 2 years ago, in other words, I took away 2022. Your 10-year number was around 8.5%. So that last year, not this past fiscal year, but the year before that, was such a devastating year for this plan and the rest of these pension plans around the country and savings plans that had any equity exposure and bond exposure, that it tilted the 10-year average down well below 8%. But our view is that things will normalize. We'll see a reversion back towards that 7 to 8% range on a 10-year rolling basis. So looking at the managers, the infrastructure program at Cohen and Steers did beat the benchmark for the 5-year period. I should mention that this product is very heavily invested among utility companies, which is creating somewhat of a challenge because utility stocks in general are very interest rate sensitive. And as rates went up last year, this past fiscal year, we saw stocks in this portfolio, excuse me, take a little bit of a beating. The convertible bond program has done reasonably well. It has outperformed conventional bonds by a large margin over the last 5 years, 8.4% versus essentially zero. So we know the bonds didn't make any money the last 5 years, pure bonds, but the convertible bonds have an equity optionality component. That is, there's an equity piece that was there to drive up the performance over the last 5 years. Euro Pacific, which has been a great performer long term here, began to find itself in somewhat troubled waters. Really began to accelerate after the Russian invasion of Ukraine. The exposure to China equities, so-called emerging market equities, began to become a challenge for them. They still have about a 22% exposure to emerging markets. Total fixed income on a 3-year basis was down 4.5 versus 5.2. I should mention that on the American Core Realty, we are not, or you are not reinvesting the dividends at this time. So any dividends that are generated are coming back into the plan to cover expenses. And this is because our view and others agree that the the office market environment continues to be under stress, and representing about 18% of their portfolio is office. Office valuations are coming down. Why? Well, because one, office developers or operators can't get financing, or they're having trouble getting financing. Number two, they're having trouble with their tenants who want to renew leases, but at a lower lease rate. And companies like my company are having trouble convincing people to come to the office. And this is a national problem, not only in the private sector, but it's in the government sector. In fact, 95% of federal employees are still working from home. You go to Washington, D.C. and look at all those buildings, office buildings that are occupied by the government. Many of them, the lights are out because there are people still working from home. The IPS, the new one with the House Bill 3 language that Adam will probably, he may mention briefly, although Anna did a very good job last meeting, is in effect. It was all done where everything's in order. And with that, I'll see if you have any questions.
So just so that I understand, so
Yes.
just keep doing, you think we just need to keep doing what we're doing as far as asset allocation goes? Just hold the line?
Yeah, that's a good question. That's something I think about all the time. Let's look at page 8. The new investment policy actually went into effect after the 31-day period. So these allocations under target represent the prior policy. But the new policy, I should point out, we stepped up the target allocation in domestic equity from 37%, as you see there, to 52%. So we are already in a period of flux in terms of reorienting the allocations. Big picture is we're moving more equities back into U.S. large cap companies. We reduced the international by 7 from 15% target to 8% target. And we reduced the private real estate target from 7 to 5. Real estate is essentially, bonds went up slightly from 22 to 24. So what we've done really is beefed up, we've de-risked the portfolio strategy, given what's happening globally. And I think a big part of that has to do with what's happening with China and Russia.
Trustees know that attorneys do not give investment advice, but I wanted to drill down on page 14 with regard to Sawgrass. And it's a 2-part question. The first part of the question on 14, looking at Sawgrass, you want to call it the rankings, is whether or not the Bloomberg US aggregate index is an appropriate index for Sawgrass. And if it is, because the performance ranking is not necessarily ideal, but you heard the reasons why. And a little bit of the context before I do the second part of the question. As Burgess pointed out, the good news is that it's a diversified portfolio from the standpoint, as you said, Burgess. You've got the high income, the Vanguard fund, you've got other fixed income and alternatives. So the 5-year performance of fixed income, which we have not seen for who knows how long, where bonds were down over a 3-year period by -5. So the first part of the question is it an appropriate index for Sawgrass? And the second one is, do you anticipate that going forward, for reasons that we heard, Sawgrass will be able to increase its performance?
Well, I'll answer the second one. That's easier. I think we're over the crest here, and I would expect to see some really nice returns in the fixed income market, triggered when the Fed decides to pivot down. When the economy really starts to really slow, you'll see a massive rally in the bond market. You'll see ships coming back into port for safety, and that money generally goes into bonds. To answer the first question, you can actually see these two, and you don't have this in front. Can you see it up there? The reason why their performance was behind the ag, quite frankly, was the fact that they have a predisposition to avoid lower quality, higher yielding bonds. But look how the junk bond market, which is a proxy for low quality companies that they don't own, had a really nice performance, much better. I mean, look at the 1 year for the high yield was 9.2. Thank God we have it here. And even for the quarter, minus point, it's that extra yield component that they did not have, which is probably part of the reason for the underperformance. You want to add to that?
Yeah, I think the IPS does restrict the BBB quality over the years, so that's been a detriment from a carrier standpoint, right? And you're comparing it to a full investment grade, which includes the BBB. So that is one element of your concern that does address that. Also, from a universe ranking, I'm not sure what Burgess is used in terms of the overall universe there. We have our own platform that we go by investment, and investment shows on a 5-year basis we're still top third on a peer ranking. So from that standpoint, that's something that probably Burgess and us, we should try to reconcile that.
Well, when you look at the one we're using is a broad. Yeah, so it includes.
Looking at a net of fee, but if you look at, for example, the dispersion, say for example, our numbers versus the benchmark, you're talking about a very narrow.
Yeah, we're talking maybe.
So at 10 basis points gives you from a medium to a bottom quartile. So you also have to put that in perspective a little bit. We haven't seen a lot of volatility because Fed has kept everything, I don't want any pain, right? So I want everything to be fun. So unfortunately, we just haven't seen a lot of pain. The only thing that we saw was back in 2020 when basically got a complete dislocation in the market, and we were one of those handful of managers that did not only perform well, but provided liquidity and allowed you to reallocate to the risk assets that were down 50-60%. And that's the way that you can actually capture the benefit of Sawgrass. That's for the fixed income portfolio.
So we knew some years ago that we felt that Sawgrass having a leaning towards quality, a high quality, we might be able to kick that up a little bit by introducing the high yield piece. And that's why it was there. And we predicted it would do better, and it has done better. It's done a lot better. So overall, when you kind of blend the two together, you get a pretty decent overall fixed income return, a 5-year return of 0.3 versus minus 0.2 if you just had left it all with Sawgrass. So that's a 0.5% difference per year on a 5-year basis. And in the fixed income world, that's a lot of money. Any other questions? I think you're okay. We'll talk later into next year about possibly pushing the bond allocation up. And it's hard to talk about that when you look at the history, but we're at a very important time here that we've made a big change in the direction. The tide's coming in. The tide was going out for 10 years. Now it's coming back. Would you agree with that?
I would agree with that.
So why don't you say that? Just say that. Don't go into all
We're-
the other stuff.
So
The tide is coming back.
in the grand scheme of things, for simple, how are we ranking with our peers? I mean, are we ranking as we expect, as we should be?
Well, given the size of this plan and the desire, I think, of this board and past boards to avoid certain types of investments that may have hurt you a little bit in the past. But I should add that avoiding private equity, for example, while private equity looks good relative to traditional equities over the last few years, private equity is now going through a difficult challenge period now, underperforming traditional equities. And we can't, and if you have them in the portfolio, there'd be no way to get out of them. You're stuck. There's no liquidity. So I think given the liquidity trade-off, I think you've done fine.
Any further questions?
Or just considering plans our size and dollar amounts we're dealing with. Is that, saying we're fine, what can you equate that to where we would rank top 50% or over 50%?
Yeah, well, we do have a ranking here right now, that on page 11, and these rankings are not great. They're below average. And the rankings are below average primarily because of private real estate. But as I mentioned to you, if you go back 2 years ago and look at the same snapshot, the rankings are actually quite good. So we've seen 1 year, that is fiscal year 2022, really foul up the long-term rankings. And if you go further in the book, and look at page 18, you can see on the left side, the fiscal year 22 results were down 16%. And that's what's really hit us on these longer term averages. The only way to, in hindsight, the only way to have avoided that would have been not being in the stock market and not being in the bond market. And those two are very important components of this strategy over the long run. Remember, everything here is pretty much priced to the market, except for the private real estate, which is a pretty small allocation. It's only 6%. But the other 94% of the portfolio is priced, there's a bid price for all of this stuff. So at the end of the year, what you're seeing here is what the market valued your assets at. But as I mentioned, in the private world, the private equity world, none of that stuff is priced to perfection. It's priced as estimated. And it would have been the only way to really avoid that big downturn would have been avoiding or not being invested in traditional stocks and bonds. Now, those same traditional stocks and bonds are going to carry you back to where you should be. You just have to be patient.
Patrick, you have perfect timing returning, because I think we're about to reach your report.
All right. Do you have any further questions? Anybody? No. Someone make a motion to accept the report from Mr. Chambers?
Motion. To accept the report. Second.
Motion and second. Lindy, all in favor? Aye. Next up, Foster and Foster. Mr. Patrick. Welcome, sir.
Thank you. I brought a little stapled handout. The this plan receives state monies. Chapter 175, a long time ago, established a premium tax for homeowners insurance in the state of Florida. And the purpose of that tax was to provide additional benefits for police officers and firefighters, mainly because you guys have to retire earlier than the general population. And you guys are a little bit of an outlier compared to how most people handle it. But I think conceptually, you guys have always done a great job, because the idea is that we're going to provide you the same benefits as the general employees. So the police, the fire, and the general are all going to get, say, a 2.5% benefit accrual rate, right? And then these state monies, these premium taxes, we're going to use that to provide an additional benefit for the firefighters over and above what we're providing to the general employees. And that, I think, is the real concept of the law that was passed like in the 30s, to do this whole state monies program. But most plans have evolved and they've argued about it and argued about it. So with most of our plans now, they keep the benefits fixed for the retirees. They keep the benefits fixed for the active employees. You would have a benefit accrual rate, and you can see that one ranking schedules that she put in the packet. You guys were on the slightly higher side. The average is about 3%. So in a normal plan, that 3%, let's say, would stay fixed unless there was negotiations and there was a benefit improvement decided upon between the city and the members. But generally, it would stay flat permanently. And yours fluctuates, but in those where it stays flat, they basically said, okay, we're going to look at the amount of state monies that you got like in 2013. And then any state monies that come in over that will be shared between the city and the firefighters. And then you would basically just get almost like a defined contribution. You would get an allocation into your share plan of, $500 this year and $500 the next year. And then that would be invested with the plan. And then when you retire, you'd get a lump sum. That's the way a lot of plans do it. Go ahead. But so your plan, if you go to the second page in the handout.
I'm sorry, Patrick, before you go, just so everybody can see, the operative provision that we're going to be talking about is that paragraph B2.
Can you make it larger? Please.
So if we come back and if ultimately there's a decision to try to tweak it, that's the language that we would have to change.
Okay.
And the goal is to make sure everybody understands how B2 works. And that's what I'm calling, for my language, a variable multiplier, which gets recalculated by the actuary.
In the last sentence, basically in the last two sentences of that paragraph.
Correct. Redetermined. And in the past,
Prospectively.
historically, it's been redetermined going up, but this past year, it had to be redetermined going down.
And then in the report, it shows other years where it has gone down as well
Correct.
over the last 20 or 18 years.
Right. So the page the chairman is looking at is the first page, and I'm sure Patrick will get to that. That shows the history. But I wanted everybody to understand. And I thank Jill for giving everything, you can read it right there, but that's the star in paragraph 2, which is some of the discussion for them.
Thank you, sir.
So the
I'm
big,
sorry, there was a gentleman sitting on the right near the door. He may have been a firefighter or maybe a retiree. Was he here for that discussion?
Just sitting in on the meeting.
Okay, all right, because I anticipate that this is an area where we welcome questions, because this is an important conversation to make sure everybody understands.
Sure.
but so this methodology this language right here has been in place since at least 1984. Because I came here in 97 when I was hired. I probably started working on your plan like in 98. And it had already been in place for some time. So this worksheet, the one that has all the numbers on it, I don't know if you can pull that one up. But back in 1984, the state monies that came in, those premium taxes, was $20,501. And at that time, I don't know what the extra benefit multiplier was, but we started having people retire and paying them the extra multiplier. So let's say it was 3% multiplier back then, and the general employees were 2.25 or something. So that extra 0.75, we started paying to retirees. So that second column there is the excess benefits we actually paid. And in the next page that has just a small chart on it, that's the current retirees as of October 1, 2022. And so the first person on the list there, we're paying them an extra $1,300 a year. That would be that 0.85 multiplier, or now 0.65 multiplier. So if a retiree is obviously getting a bigger benefit, that would be larger. So retiree B is getting $14,902 every year in that extra benefit. So that's what that or that third column is on that previous page. So right now we're paying $148,000 a year to the current retirees that are extra benefits over and above what the general employees get.
And that comes from the 175 money invested over time.
Exactly.
And trustees, if I could add, so you get that 175 money as long as Jill does her job and the board does its job, you get the money every year. And the other observation is it's also invested. And because the prior year was not a favorable year in terms of investments, Burgess is shaking his head, not just for us, but all across the state, all across anyone who is investing. So because of the way this is designed, you get that volatility when you have a negative year. So there's volatility, the state money can fluctuate, but also the underlying investments can fluctuate.
Yeah, so that gets us to the fourth column then on the big page with all the numbers, and that's the actual investment return every year for the past 32 years or 42 years there, or 38 years. And so so then on the right, so the next two columns are the accumulation of those state monies and the extra benefits we've paid. So, after year one, that 20,501 in state monies got 9% interest. So now it's 20,962 at the end of the first year. And the $721 in excess benefits we paid is now $770. So the total state monies we've gotten with interest, less the benefits we've already paid, that's really the amount we have for future benefits, right? Because that's we can't. And so at the beginning, that was 20,192. And then so the next year, we got another 20,845 in state monies. And so the accumulated excess statement, or the accumulated state monies, was 44,000, and the accumulated benefits paid out was 1,351. So we had 43,000 to use for future benefits. And you scroll all the way down and you get to the highlighted areas. And so you can see that we had a nice big jump in 2006 and 2007 there. So that was a time when we were able to bump up the multiplier. But then we had a negative 9% return in 2008. So we had to lower the multiplier after that bad return, because what it does is it affects the amount of monies we have for future benefits. See, that's that last column there is the amount of money we have for future benefits. Well, so if you go down to the very bottom of the page, you know, we had 2.7 million, 9/30/2020, and then 3.1 million, 10/1/2021, because we got a 19% return. And then the following year, we got a minus 16% return. And so we dropped down to 2.5 million. So like Adam said, you can see the state money, it hasn't really changed much in the last 20 years. You know, the dollar amounts, they've been kind of all over the place, but you got 61,000 in 2022 there. And in 2002, you got 51,000. So in the last 20 years, the amount of state monies that you get hasn't really had a lot of fluctuation. Go ahead.
I'm just pointing out through the chair that on the margin, I've got a little bit of good news for you in terms of the money that was received this year, which isn't shown on the chart. So you go to the very bottom left, you see the 61,000. That was your premium taxes that came in last year. So what about the money that came in this year, which will be used to calculate for the following year? So you went up from the 61, and the state money is going to be 71,000 and change. So you went up a little bit by an extra 10,000, which was about a 14% increase. And we have a spreadsheet of all of the clients across the state of Florida, police and fire plans. So you had a nice little increase. So next year, when we're having this calculation, it'll be working off of 60 instead of 61,000, which came in last year, 71,000. So it's not a huge increase, but that gives you some idea how two variables that fluctuate. The money from Tallahassee fluctuates, but I think the reason why people were asking questions is you had that investment loss where the assets that were accumulated, bottom right column, went from the 3.1 million, as Patrick said, to the 2.55 million. And that's a conversation we can have if we want to take some of that volatility off the table. And I'll point out to you that when you take volatility off the table, that's going to lower what you can pay out on the upside, but do you want to take volatility off on the downside? And that's the conversation.
So that was kind of to I guess kick off the conversation.
One other page to kick off the conversation, which I think the chair was alluding to, the very bottom of the first page of the printout. You want to just give everybody the context? And I don't know that we have it on the screen yet, but do you have this page? Do the trustees have the staple packet?
Yes, sir.
But basically well, go back to the big page that you're looking at there with all the numbers. So when we do the valuation every year, we have those terms like unfunded actuarial accrued liability and all that. Well, the accrued liability is basically the total value, you know, of your future benefits that you're going to get paid that you've already earned. Okay. And so that total, if you look at the bottom of that page, was 12,289,000 in the 2022 valuation. But that was for the 3.35 multiplier. So 0.7, if we had a 0.7 multiplier, that would be 2,568,000. So basically the value of everybody's accrued benefits, what they've earned, using a 0.7 multiplier is 2,568,000. And we have the 2,555,000 there in that accumulated state monies. So we have enough money to cover that 0.7% multiplier forever for basically what everybody's accrued to date. All they're going to get in the future, but only what they've earned so far. So for the retirees, that's all their money. They've earned all their benefit. So when that number goes down, then we have to lower that benefit. When that number goes up, we can increase that benefit. And so that's what happened on the bottom of the other page. 10-105, that extra benefit was 0.75.
Sorry to interrupt, just so everybody knows, so on the handout, the very bottom column, I think is what you're about to refer to.
Right. So 10-105, that and previous to that, it was 0.75 was that extra benefit. And then remember we had a bad year in 06. Actually, probably had a bad year in 05 because remember it's always 1 year delayed. And we have a bad year and then we adjust the multiplier the next year. And then we had a good year in 06, a good year in 07. And then remember we had a bad year in 08. And so the multiplier bounced around 0.75 and ended up, 4 years later at the same 0.75. But we had a lot of up and down in that time. And then 2012, we had a good year. So we were able to bump it up 10-113 to 0.79. And then the market was relatively normal for the next 9 years. So you can see we didn't change it until 10-1-2022. And a part of that is that we decided in-house that unless it was going to be like 0.05, it was probably not good to have everybody's benefit bounce up 0.01, down 0.01. So we decided to keep it the same unless there was something significant.
If I could make a comment here, you look at 2020 fiscal year. That was the first year of the pandemic. Remember? And that's when the Federal Reserve and Congress dumped all this money in the system. Even after an abysmal first quarter, you still eked out a really decent, above your assumed rate of return of almost 9%. Then the next year was unbelievable, 19%. So you had 2 years, if you kind of hook those together, you get about a 28% return. And then the next year you're down 17%. So you average those 3 years together and you're still not too far away from the expected long-term return. It's just that you came off of such a high, you went from 19,000 feet and you took a big dive 16,000 feet down. That volatility right there is what has captured everybody's attention.
Well, just to be, if I can, just to be honest with you, what's captured everybody's attention is when their paycheck showed up, they said, I'm $400 short this month. That's what captured their attention. Just being, out in the open.
Right.
So to me, we got to figure out if there's a way to figure out how to either smooth that.
There is a way to fix it.
Either a way to smooth that or fix it, I think is critical for our retirees.
Well, there's a couple of things it seems to me in looking at it. Well, there's the 1, 2, 3, the 4th page in my handout. Basically, the state has said, we're going to give you these state monies, and the members and the city can mutually consent to treat it however they want. Okay, so basically right now you guys have that ordinance that's been in effect for the past 38 years or whatever, and you guys have signed a mutual consent agreement with the city that you're going to maintain that methodology, but that could be changed at any time. So the city and the union could negotiate to change that methodology. So we're not really stuck right now. We're stuck because that's what the ordinance says, but that could be changed. So one way we could do it is that we could keep using the same method. It's just that when I look at the change, that 3.1 million down to 2.5, somebody's benefits have to be higher or lowered, right? well, we could say that retirees' benefits do not change. So only change would be for the active employees, their future retirement benefits. So whereas right now their multiplier would be 3.15 or whatever it is right now.
Let's give a little bit of background. So as Patrick showed you before, the base multiplier, which is the same as the general employees, is 2.5. That's the base multiplier. So this extra multiplier or this variable multiplier, which changes from year to year. So for the most recent year, it was, and if you look at several places, you can see it. But long story short, it's 0.65. So when you add the 2.5 plus the 0.65, you'll wind up at 3.15. But remember, last year, it wasn't a 0.65
331.
multiplier, it was a 0.85.
Right.
So that's where this is coming from. So it went down from 0.85 to 0.65. And fundamentally, what the board, this is something you don't have to make a decision today, although you might. And this involves thinking through because it's an important discussion and it will impact what gets paid out in future years. The money from Tallahassee won't change, but the way it gets paid out from year to year will change. So that's why I want to make sure everybody drills down and helps us think together on if we want to make a change. And we've got probably there are varying degrees of complexity on how complicated you want to do it. But Patrick will walk us through various approaches of how we can change. And ultimately, I don't think we have to change the mutual consent because the consent says that the plan gets to use the money. Right. The question is, how do we use the money? How do we pay it out? And I think that ultimately we may decide to amend the ordinance, which was that paragraph that was, if that's the direction you want to go, and what does an ordinance require? An ordinance requires 2 readings by the other folks who sit at the dais, right? The elected officials. And we would explain to them that if you want to tweak it, and these are going to be the questions that you'll ask Patrick, that this is not going to impact the city's bottom line. It's impacting how we're using the money, which is in the plan, to take some volatility off the table for the retirees.
Right. So the mutual consent falls into the DC component of that plan when you can't mutually consent, right? That's where the DC part of the plan comes in.
Yeah, the state said if there is no mutual consent, they set up a default arrangement and that would be a DC plan, a share
That's where that
plan.
money, okay, thank you.
But if we stuck to our current system, and like I said, every year I do this calculation and I say, okay, we have 2.5 million for future benefits. Well, we could freeze the retirees. So if somebody retired with 3.35, let's say, their benefit would stay fixed. Their benefit would not change. I would be using this extra or lower money we have to adjust future retirees. And so, so that we could still do exactly the same thing. There's no impact on the city because already we're still just using those state monies for those extra benefits. But we'd have to know that right now when we have a loss, I spread that loss over everybody's benefits, the retirees and the actives. And so that went from 0.85 to 0.65. Well, if we would have just been doing actives, it might have went from 0.85 to 0.45. See, because we're going to have to absorb all that liability just with the active employees.
What does that mean for the active employee?
Well, it's the same as it is now where their benefits fluctuate, but it's probably going to be a little more fluctuation.
But what does that mean? Make this real simple for me. I'm just a simple
But
fireman.
right now they think if we did a green sheet for them, it's going to say 3.15 times their years of service times their average final compensation, right?
Yes, sir.
It's 3.15. That's what we've been telling them on their green sheet. That's if they were projecting their retirement. So now, and it was 3.35 last year, right?
Yes, sir.
So now it's still going to fluctuate. You know, next year it might not be 3.15 anymore.
But the bottom line would be when they retired, that would be fixed and they would know what that would be.
Exactly.
So the fluctuation
they
wouldn't matter to
retired-
them. The fluctuation wouldn't matter to them. If I'm on the job 20 years, I got 5 to go. that fluctuation doesn't matter to me until the day comes when I say it's time to retire.
But if it's 20, if you got 20 now and you got 5 to go, and we tell you now it's 3.15, and it may be 2.95 when you retire, and then you're stuck with that 2.95. You know, it can fluctuate from year to year until you retire. Then
I see.
you're fixed.
I see.
But you could also go out at 3.55. You know, if the market does good the next 5 years.
I see. I see. So if they were to retire and the market is down, that's what you're at. If you're at 3, you're at 3. If you're at 2.5, you're at 2.5, whatever the number is.
Exactly.
Thank you.
That seems to me, if you want to keep things relatively the way they are, that everybody's kind of long had this agreement, we'll use these extra state monies for an extra benefit. We can keep that same system. And it's just that we'll lock in when someone retires, their benefit is fixed. That very last sentence in that ordinance would just be scratched that says for retirees will be changed. It'll just be for future retirees, not existing retirees. But the risk, like you said, for the active employees, there's less certainty of their future benefit, right? Right now, you've been working here 20 years. You've been expecting to get a certain benefit, and that could change in the next 5 years. So there's a little less stability for the active firefighters, but there'll be perfect stability for the retired firefighters.
How does that work for the retired firefighters? Are you gonna, they're gonna still fluctuate?
No, they would be fixed at 3.15 in that scenario, what it is right now. Or if we have a good year and it goes up to 3.2 next year, and then we do this. But whatever it is, when this gets adopted, when that change gets adopted, then the retirees will be fixed and never change.
Is there a way to get the, I don't know if you can calculate this, but the average from the retirees, what they retired at? Is there a way to, I don't know.
The actuary may have that kind of information.
So percentage at which time each retiree.
Yeah. I mean, the ones, well, I think, when's it retired for you guys?
Especially if you're retired, your check should be about $400 less.
Please make sure your mic is on.
It is.
Okay.
It makes it difficult, but if I were retired, I would prefer a fixed amount. And if it ended up getting extra, that would be wonderful. But I just think it's difficult for you guys to manage a budget. And the drawback is, so Chad, you guys are still working. You know, your investment could be all over the place, and when we have a big loss like this, it's going to be a bigger loss for you guys.
Yeah, the only advantage you would have, I suppose, would be you don't retire that year. But that would be your only way to manage that risk, right?
Right.
And if you look at it, I'm looking at this, and for the last 40 years, we've never had a number like -17.
Right.
And I'm sitting here trying to figure out why now. I mean, you could look at the 80s.
Because we had a huge dip in the investment return.
That's a huge.
Yeah, well, we went through a sonic boom because the Fed decided to reverse course and take rates way up fast. And that crushed us. And it crushed everybody in this industry who owns stocks and bonds. That's the problem. Now what Patrick likes to do is spread things out over time, but this is different than the traditional amortization of the other investment return experience.
This didn't smooth, right? This just took a
No.
hit.
It doesn't smooth. This mechanism has no smoothing at all.
So is there a way to smooth that ride a little bit?
Yeah,
Yeah, give me 1 second. So the other.
Hundreds of
question,
questions, sorry,
Of those,
sorry.
of the other, of the retirees on that short list, remember? There was 1, 2, 3, 4, 4 of them that retired in that 05 to 09 range. So they were in that 0.75 to 0.85. And then there was 1, 2, 3, about 5 that retired in that 0.79 range. You know, remember how it was 0.79 for like 9 years? So about about 6 of them retired during that time frame. So they're kind of all over the place, but I could give you the exact if you need it. So on the issue of smoothing, as Burgess said, remember when we do the valuation report to determine the city's funding requirements, we use that smoothing technique of the assets. So we only recognize part of a gain this year and then part of it next year and the year after and the year after. So it smooths it out. And that's another thing we could do going forward if we keep this method. But I don't think you want to do it right now because remember the market went way down. Our likelihood, I think we're over 8% this fiscal year, right?
you're over 8% for this new year. And that's above the assumed rate of return.
So I don't think now is when you want to smooth. Maybe we'll wait a couple of years and then we could start doing the smoothing from that point forward. And that would reduce some of the sharp volatility. It doesn't really change anything in the long run. You know, if the multiplier is supposed to be 0.65, you know, it's going to be 0.65. It might just get there in a slower path.
So trustees, I believe our next meeting, so the first quarter of next year, the fiscal year is over. So I think the actuary will be in a better position to tell you what it will recalculate for. And I don't want to put words in your mouth, but I think you'll be in a position to give that answer probably at the, is it February? When
Correct. Yeah.
Okay.
We'll do our calculation just like we did last year. You'll have that of the new multiplier at your next meeting.
So for that reason, I don't necessarily think it makes sense to do anything today because you'll be in a better position to make a decision at the February meeting. But
Well, the other, I'm sorry to interrupt, but the other issue is that, remember, the multiplier takes effect 10/1. So
We got to ride. this
we've
out.
got a whole 9 months before anything's going to actually happen. So we can discuss and decide if we want to change methods or anything.
The other question I had would be, what would it cost, or to what degree, what would it cost us to fix our multiplier period? Whether, you know what I mean, you follow what I'm saying? So if we picked a number like what.
Well,
you guys reached-
then it doesn't cost you anything. It's just that right now, some of the investment risk, you know, is being borne by the members, right? And market went down, so we're going to lower their benefits. Market went up, we're going to increase their benefits. So if you fixed the benefits period for now and forever to 3.15, then the city now bears all the investment risk, which is the way it is for most of our plans.
That's the way it is typically.
But they also bear the gain when it's.
Right. Yeah, positive or negative, it's going to be on the city's funding requirements. It's not going to be on the members anymore. So that's another option, but again, you'd have to negotiate that because right now that ordinance says a whole different story.
Right.
Through the chair. So the job of attorneys is to give options and sometimes to muddle and to confuse things. I do want you to know for the next meeting, what these options look like. And perhaps Patrick can bring some more information so people can see a comparison of different options. But one option is always status quo, leave it alone, because it's gonna reset and potentially it's resetting in the right direction. So you may decide to leave it alone. If it ain't broke, don't fix it. That's always an option. The second option, and when we use the word fix, I like the word lock down or lock in. Because, and really on that lock-in question, who do you want to lock down? You want to lock down just the retirees, if we're going to amend the ordinance, at 3.15 or 3.2 or whatever it may be in February. So do you want to just lock down the retirees? Or do you also want to lock down the retirees and the actives? So that's an important decision. Who do you want to take the volatility off the table for? Do we only do it for the retirees or do it for the actives? So that's one big decision. And another discussion is, as the state money increases in the future, the majority of my plans have what I refer to as a funded defined contribution share plan. That's the word we use for it, a share plan. Is it very easy? You take the state money, the growth of the state money, and you just divide it up between the members.
Right.
So that's something else to give some thought to. If you lock it down in future years, and these are conversations to have with Patrick, that as that premium taxes, the 175 money from Tallahassee, as it keeps increasing, and you heard, the prior year it was 61,000, this year it's 71,000. So over time, as there's more development and there are more houses, and as the taxes go up, and this is money from Tallahassee. It's not money that the city is imposing with taxes. It's the money that Tallahassee pays us based upon this tax on insurance. So, if we decide to fix it, there's a conversation about what do you want to do with the growth of the money going forward. And the majority of my plan, not saying it's right, not saying it's wrong, but just giving you options. Put it into what we refer to as a share plan, where the members just share it. It means it gets divided up, and Patrick can walk us through how a share plan works as an option after you lock it down. And are there any questions for me from what I just summarized?
Yeah, I would like to see those options for sure, so we can make an informed decision.
Can I ask a question related to what you said? What is the impact on the city though? Nothing, I mean, can you explain?
So that is a good actuary's question, but to summarize what I think Patrick's going to tell you is right now the risk of the volatility is borne by the retirees and the members, because it can fluctuate from year to year. Right. But if you lock it down at 3.15, if you lock it down at 3.2, if you have multiple bad years, the city's funding obligation would go up in bad years. But as the chair was pointing out, in good years, the city contribution will go down. So it may add some more volatility to the city contribution up and down, but I'm not aware of many other plans where retirees, and remember, this is what the ordinance says, so there's nothing wrong with it. That's why I don't like the word fix, because we're not fixing something that's broken, because there's nothing that's broken.
We're in compliance.
We are in compliance, we're doing what the ordinance says, the board's done nothing wrong, and I want to make it very clear in the minutes that there's nothing to be fixed that's wrong. But if we wanted to redesign the way this benefit works, we could lock down the multiplier, and to the city's observation, and I have never met it, but I'm assuming you're either in finance or
Finance director.
okay, so it did not surprise me that the finance director asked that. It's a very good question. So, and then Patrick's going to give the real answer. But what I'm describing is that I'm not aware of many other plans where retirees have that variable. There are other things that change for retirees, but here the multiplier gets readjusted. So there will be years where the city contribution is going to go up. There are years where the city contribution is going to go down. So it's not costing the city more money. It's just adding more volatility. And Patrick can give you the actuarial answer.
Hey, I don't even need to say anything. That was very, very good. Yeah. And as far as the share plan, the state monies would be fixed in a sense for the city. Right now they offset whatever comes in from the state. If we did the share plan, then increases in state monies, a lot of times it's shared 50-50. So if 71,000 is what we got this year, we could freeze it at 71,000. And then anything that comes in above that would get split 50-50, where if we got 81,000, then the city could use 76,000 and the members would get 5,000 into the share plan. So it
just to be clear, you'd be splitting the growth,
Right.
if that's what we're talking about.
And and then the city would use their portion to fund the pension.
exactly. The benefits that are already there.
Right.
And as far as the members portion, some people allocate it equally. So if you got 25 firefighters, they each get 1/25 of it. Or you can do it again by credited service. So somebody has 20 years, they get 20 shares, and someone has 2 years, they get 2 shares. So there's 2 different ways to share it in the membership. But to the city, it doesn't matter because it's kind of like now. That money is just going into something that's for the firefighters. And it doesn't really affect the city long term.
Trustees, because there's a lot of thinking that's going to be involved, and I'm not sure of the trustees, what position folks have. But I think it may make sense for you to make available, if the finance director, for example, has any questions for the actuary, to give the actuary the permission, if you will, to answer questions from finance. Likewise, if there are firefighters that are going to be involved, and again, I'm not familiar with the organization, but for example, there may be a union president or whoever, to allow questions to be answered. That way, if the board wants to make a decision at the next board meeting, and also to invite, right, perhaps union leadership and or other city attorney or city representation, so that way people all have an understanding, because it'll be a big change if you make that change, and there's no right answer. But I think the chairman used the word inform, and that's one of my favorite words as fiduciaries who want to make informed decisions. So I think that whatever we can do, that way folks understand what we're looking at. So that way people won't look over their shoulders and blame you for a decision. And again, there's no right answer, but to give access to the actuary so everyone can be informed going into that meeting.
Mm-hmm. You guys have any further questions as it relates to the ordinance?
And trustees, I'll also add, I think we're going to have the same conversation with the police at their board meeting, because it's the same issue. So this is the sunshine law now, because this is an item that trustees will be addressing going forward one way or another. You can't talk about it with each other, but you could talk with the police chair. Any of the other board members can talk to the city. You just can't talk to each other because of the sunshine law.
Certainly.
So it's okay for me to call Patrick if I have.
Absolutely.
I just can't be a conduit between 2 trustees. I can't say, well, he said this and that kind of thing. So, I mean, at the very least, for the next meeting, you'll have the new calculation. And then I guess I'm not sure if you want anything else from me for the next meeting.
I would like to see a comparison between a fixed multiplier for the retiree and then all participants. So the active and fixed, or the active and retirees together. Please.
So one scenario is just leave everything the way it is. And what I'll do is that normally we wouldn't do a change if it was like, unless it was going to be like 0.05 or something, but I'll waive that. So if it's 3.15 now, and this results in 3.16, I'm going to do that. Just so that we can see the magnitude of changes. And then I'll say, okay, what if we only make the change for future retirees? So that might be 3.18. That way you can see, like you said, the impact it's going to have on current retirees and future retirees. Does that sound good? So I'll do it under the normal scenario, and I'll do it under the one where the retirees will be fixed, prior retirees, and future retirees will be adjusted.
And then we can adjust the math as we need to, if we decide to fix a multiplier, look at what a multiplier would be fixed at. So for example, our green sheet now says 3.29. That's how you do the math. I think that's how you do your math. I think that's what our green sheet says now.
Well, it was, but now it'll
was.
be 3.15.
Right, I understand. Yeah. So we can do the math as that adjusts.
Well, and as far as, if we want to negotiate a fixed multiplier, I mean, right now everything's based on the 3.15. But like I did think about like if I did just a quick study this morning. If we wanted to do a normal benefit change. And so if if we wanted to do it for the future retirees and instead of 3.15, make it 3.25. Disregarding all the state money stuff. If we just said we want to go from 3.15 to 3.25, it would cost 1.4% of payroll for the city's funding requirements. So, that gives you an idea of sensitivity. So if you wanted to negotiate a multiplier that was different from 3.15, then, the city's cost is going to go up or down.
Trustees, I wanted to add that in addition to the scenario requested by the chair and what was just described by Patrick, I think it might also make sense, Patrick, to have on whatever options you give, a share plan option. And I'm not recommending anything. I just want trustees
Let's
to
see
have different opportunities to look at different options. And so that would be a share plan with the growth of future money going into what we call a defined contribution share plan. So right now you have, if you look at your packet, look at the very end, you have section 2-250.61. It's the last page of your packet. So this is the ordinance, the city code. So right now you have the design of a share plan, that just you're not funding it because you're using the money for that variable multiplier. But you could, as we said, use the growth of the money to just do a per capita, meaning everybody gets an allocation. And Patrick, you want to describe, because it comes better from an actuary, that if you have the share plan, how the share plan works for actives versus how the share plan works for retirees.
I mean, generally, we don't give share plan money to retirees. Generally, it's just the active employees who are working really the year that money was collected, right? Because that money is collected this year from the citizens, and then you get it paid it next year. And so we usually don't give it to share it with prior retirees. So it's shared just among the active members. And then that accumulates almost like a 401k. So when you retire, you might get $100,000 or, that, who knows, from the share plan as a lump sum, kind of like a drop distribution. But then there's no future benefit for you once you draw that money out. It's like a defined contribution. Does that answer the question?
So I want everyone to realize there are lots of options, and there's no option that's better than another. These are options. They all have advantages and disadvantages. So the scenario that Patrick described, that if you lock down the benefits for actives and for retirees, if you locked it down, and if you said future money is going to be used for a share plan, and we'll split 50-50, for example, with the city, with the growth of the money, you also have a decision whether or not you want to share future premium tax money with retirees. And I will tell you, the majority of my plans, as Patrick said, retirees don't get share benefits. It's just the actives who share in the defined contribution plan. But you could, and remember, any firefighter is going to retire one day, and they're going to become a retiree.
Sure.
So you may decide to share with retirees, which I would be totally okay with that. And the point I wanted to make, that if you are putting in, if you do put in place and amend the ordinance to put in place a share plan, which doesn't cost the city money because you're locking down a benefit, there'll be volatility. But right now they're not getting the state money anyway. Right now you're using the state money to fund the variable multiplier. So we're not changing how the share money gets used. We're changing how it gets shared. So the point I want to make is that if you decide to have a share plan for both actives and retirees, the retirees would get what I'll call a 13th check or a share plan check. Usually Patrick will tell us when he would have it calculated, but a retiree would have a flat monthly benefit during the 12 months, and they would get a once a year share distribution. That way their monthly benefit doesn't change, but what will change for them is that bonus check or that 13th check. Everybody follow?
Yep.
And they're actives, right? So the money's getting divvied up. They would have a share account. And every year you would be able to see through Patrick
how much that share balance has increased with your proportion of the money for a particular year. And if you're here for 10 years, you would have 10 years worth of share money, 20 years of share money. And we'd also have to have some discussion about how would you want to invest that share plan money? And I would tell you, most of our boards defer to the expertise of our investment consultant and just let the share money get invested the same as the portfolio. I'd look to see how many mutual funds. I don't want to use adjectives, but it's a fairly well diversified conservative portfolio. So these are the big heavy lifting questions to think through from your next meeting. How do you want to change the ordinance, if you change it at all? And do you want to put in place a share plan for the growth of the future money? And if you do a share plan, you want to share that money with both actives and retirees.
In which case you would divide that out by 1/30 or whatever.
And either it would be equal allocation or relative.
Years of service or
Yeah.
whatever.
Mhm.
And then you would have a fixed multiplier that both retiree and active employee would know what's coming.
Right, and when we say fixed multiplier, it's a fixed multiplier, means and you're locking down the multiplier until the next, union contracts are usually 3-year contracts. So the city and the union can always negotiate to change it in future years, but it would no longer be an actuarial return determination based upon the market. It would be a negotiated decision if you ever change it in the future. But everybody understands that distinction? Understand.
So Patrick, we would need to, we've got to put what we want to do in place by October 1st next year, right?
Well, I mean, ideally, because that's when the next change is going to happen under the normal method.
And the union contract has just been ratified for 3 years in October. So it would mean union changes as well, contract changes.
I don't know how it works around here, but can that be opened up at all?
It
Or,
can. Those articles can be opened
because otherwise we'd be stuck for 3
if
years.
they're willing to open it. The city and the union agree to open, they can open the contract
Okay.
for those articles.
Well, that was a lot of information, but I wanted you guys to be able to ask questions. And so you can help your own members too.
Yes, sir.
And like Adam said, feel free to have the members or you guys call me anytime. This is what I do. It isn't what you guys do for your job. So feel free.
Quick question, if we were gonna have a vote down the road in reference to retirees' benefits, is this something I have to excuse myself from?
So trustees, let me answer that question, which is an excellent question. These are all good questions. So this has to do with voting requirements. And because we're not saying that, and I'll have this conversation with the city attorney, but because we're not giving any favorable treatment to one particular retiree, we're not giving favorable treatment to one regular active. It's a decision that would apply across the board to all retirees and to all actives. The only difference is retirees or actives. I do not think that I would ask for anyone to excuse themselves, and there are all kinds of reasons.
I just want to make sure.
And that's what the voting conflict laws say, that if it's of general applicability, you don't have to excuse yourself, which would then trigger a separate form that has to be submitted to Tallahassee. So because these are questions of general applicability for all retirees, my answer is no, you would not have to excuse, for the same reason why the chair wouldn't have to excuse. I know we've got some other items. The attorney's report is going to be really quick, but Patrick, and I don't want to speak for the chair. Do you want to just real quickly rattle through the other items of the actuary's report?
Well, we did 175, we did mutual consent. And Jill provided that comparison that I talked about. You guys have that in your packet of all of our plans. The Division of Retirement, they sent a letter approving the valuation report. We have to send it up to them to get approved. but they recommended lowering that investment return assumption. But that exact same language we've gotten in every letter for the past 3 years. So, they just want boards to be considerate of lowering that assumption over time. But we talk about that with you guys on a regular basis. We can talk about it when I present the valuation report in February. So that's nothing to be alarmed about. And then the last item was COLAs. I think there's been questions about possibly doing COLAs either for active or for retired members. And basically it's going to cost money. So I could do the study, if you guys want to spend a certain amount, I could design a COLA. Or if you just want a 1% COLA, I could tell you how much that's going to cost. So that's just something, I guess, that's on the table right now for discussion.
Just so that we can understand what it would look like, if it's even possible,
Well, I think Jill provided a study we did for the general employees a few years ago that kind of shows different options and what the impact would be on the members. But that just gives you an idea anyway.
Thank you, sir. You have any further questions for me? Accept the motion to accept those reports. Motion by Lindy, second by Leary. All in favor? Aye.
Aye.
Mr. Levinson?
Trustees, I'm going to give a quick attorney's report because there's nothing you need to do on the attorney side. I want to begin by thanking Burgess because I think the idea and Jill of doing this workshop is phenomenal. So I very much welcome the opportunity. And Anna from my office and everybody says hello. So the items that are listed, and it looks like it's a lot, and this is because of all the work behind the scenes by our trustee administrator. So 7A is this memo. And I'm not going to read it to you. If you have any questions about it, I'll leave my telephone number. You can call me. But the Division of Retirement in Tallahassee, and Anna talked about this, just released these rules. And these are rules for House Bill 3. And you all remember how House Bill 3 says there's a magic word, pecuniary. We're investing based upon pecuniary consideration. We don't need to say any more, but we have to now file in Tallahassee the revised investment policy. And here I'm thanking Burgess again that we are ready to go. So we have our memo. If you have any questions about it, go to the next, please. The next piece of the attorney's report, which is the template. So the template has the name of our plan on it, and Jill will be taking that template, and she's going to be taking the investment policy, and she's going to be loading it up into the portal that the Division of Retirement created. And Jill has already registered with the portal, so she is good to go. So she's going to be making sure we load the information up to Tallahassee. So no actions required by the board because Jill's all over it. And then the last item, which really doesn't apply to us, deals with proxy voting. So I will let Burgess if he wants to go into any more detail. But if we had equity managers that we own shares of stock directly, then this is a letter that we would send to those equity managers who own stocks when it comes to voting proxies. But because of all of our stocks, as I can tell, are in mutual funds, it's not directly relevant to us. So I wanted to pause real quick. Are there any questions about the attorney's report and how Jill will be filing that information that I just mentioned into the website for Tallahassee, that we are in compliance with House Bill 3. We do not mix investing with politics, ideology, or any other social considerations. We're investing on a pecuniary basis. Any questions on the attorney's report?
Not as far as that.
And I look forward to, with Anna, answering any questions that you might have for the next meeting about the various designs. And as was pointed out, there's no urgency at the next meeting, but these are important decisions. So we want to make sure the city understands, labor and management understand, and trustees, most importantly, understand, because you're the decision makers here with this collaborative process. The last thing I want to mention, and I'm not sure if anyone was going to bring it up, but we want to talk about administrators and options on administrators.
Yes, sir.
Okay. So I had the chance to meet Jill this morning, and I think you've been working as administrator for 4 to 6 years. So, and then I don't want to make an announcement. If you want to make an announcement.
Well, yeah, everyone knows that I'm, by next October, I'm retired. So, and that the city had originally budgeted for an administrator, a pension administrator as a separate position, and the board had agreed to pay for it. Since then, the commission has changed its mind and its budget, and that position is no longer in the budget. So when I leave, whoever replaces me will either do the dual jobs, or the other option is to hire an outside administrator.
And that's what I want to talk about real quick under the attorney's report, and it's not number 9 on the agenda. And it's the same question that the other boards are going to have to think out loud about. So what I'm going to point out to you, and I think we dual notice the lunch meeting for all 3 boards.
Yeah.
So in fact, we could talk about it if we wanted to, at that lunch meeting. But when it comes to the options across the state of Florida, there are about 500 pensions for cities, police, fire, general employees, 500 of them. And some cities do what you do, which is you use a trusted, loyal, dependable city employee, usually in HR or finance, sometimes in the chief's office, fire chief or police chief. But you have a sturdy, reliable person who does the plan administration. There's another approach, and again, there's no right answer, but increasingly with the plans I work with, we see third-party administrators, a TPA, third-party administrator. So the third party, and this is not an easy job because you gotta hit the ground running and understand what's involved. Because Tallahassee looks at our state reports and you can mess things up if you're not, equipped to do it. So if we're gonna, and this is a decision, this is a conversation to have with the city. If there's city staff that we think can sort of step in, it may make sense to start getting them up to speed so that you can start training whoever that person may be. But there's another option, which is the TPA. So I just last week sent out an RFP for a plan in South Florida. So there are in the neighborhood of less than a dozen companies that serve as they are full-time administrators. So they do this job and do it from multiple plans. So they've got all kinds of expertise because that's what they do. That's their bread and butter. So you have to pay, right? You wouldn't be paying anyone as our administrator from the city. You'd be paying the third-party administrator. You'd have a contract with them, and you'd have to decide if that's the direction you want to go. It may make sense for all boards to hire the same company. In fact, you could do joint interviews. If you do an RFP, all 3 boards meet. If you get 8 responses to the RFP, you might decide, because that's a lot to interview, you might decide to meet and look at the list because you have until October, and then bring in 3 to 5 and interview the 3 to 5. And you ask them all kinds of good questions, and we can do that later. But it's an important decision to make, which direction you want to go. And thankfully, Jill let us know well in advance, and so that way you can think through that process. So the last point I wanted to make, it's easy for us to do the RFP, if that's the direction you want to go. The harder part is interviewing and deciding who you want to hire.
Can you give an idea of the price range?
Right, that's the main.
So you save money, frankly, if you use the same administrator for all 3 plans, because they get familiarity with the finance department and with the actuary. And it's a function of the amount of assets and the number of retirees. And from what I could tell you have, less than 2 dozen retirees. So the answer is it depends. Some are more expensive than others, and they have more bells and whistles. So some administrators, they'll have internet access, and they'll be a little bit more sophisticated with allowing people to have internet access. Others are more straightforward, and I hate giving dollar amounts, but
Come on, go ahead, give it a shot.
5 to 35, where they at?
Yeah,
I would
that's a
say
reasonable,
neighborhood of
that's a good range.
ballpark.
Yeah.
2 to 4,000.
But
What I remember.
so to your point, though, we don't always get as lucky to have somebody like Miss Jill. So when Miss Jill retires, if we were using a third-party administrator, we would just continue to march on. They have someone in place so that we're not relying on one person. A company would take care of our plan administration.
Right.
They would meet our deadlines. Our retirees would have access to those people.
So I'm not only going to agree with you, I'm going to very much agree with you that the TPA would usually have at least 2 people who are familiar with the plan. Because, you get to decide when you want to schedule meetings, and if they just have one person, there can be conflicts. So they usually have at least 2 people very familiar with your plan, and they're professionals. This is what they do for a living, whereas this is a part-time assignment for Jill. So, that's why it's going to be an important decision, which administrator, if you decide to do that, or if it's going to be a city employee that you bring in, it's an important administrative decision. So that's why it makes sense for the chairs and the city to give some thought. Maybe you want to, let's talk about this. Maybe you're going to want to say, and it doesn't have to be today, but at the next meeting, to authorize an RFP. And maybe it's too soon to do that now, but the sooner you do the RFP, the sooner you're going to see what the costs are, and the sooner you're going to see the options in terms of the administrators. And then it's gonna be up to you. When do you want to schedule a meeting to winnow down the list from 10 to 3? And then when do you actually want to vote on who to hire? Because I think you do want to bring them in and you do want to meet with them.
Gio, when did you say you were retiring?
October next year.
And I'm just curious if the city gave any explanation why they didn't want to refill the position?
I didn't hear him.
Is that a commission decision?
Yes, they re-evaluated the budget after they passed it and they eliminated a number of things. That was one of the things they eliminated.
And that was under commission direction, so, that's our process and we
Sure.
can, being that it is under commission direction, we can always, submit better information, or more information, so they can give better direction that would address the needs of our pension boards and also ensuring that when Jill retires, that there's continuity, because Jill had already was trying to get that position filled around January, March. So we already have tentative plans that she's trying to have her person there already in March, so she's here for 6 months working with that situation.
But just a point of clarification, it's not in the budget. But but the plans could budget, because the plan they have their own budget. The plan could pay for the administration.
We don't need
That-
the city, we don't need the city to
The
do
city
that.
could provide the resource just for discussion,
We
and the
do.
plans could pay for it.
Let Jill respond, I'll come back to Jill.
Yeah, the original budget was that each plan would pick up about $7,000. Whereas currently your plan pays 7,000 for administrator, it was gonna go up to 14 for the year. Because the city was paying 25% of the plan administrator because they wanted to use that person outside of just pension, they were willing to pick up 25%. That's the part that got dissolved. And they refused to pay the 25%.
25% amounted to how much?
So, and actually, then the 3 pensions together, I think amounts to almost 50,000.
Yeah, this 25% was maybe 15,000.
Through the chair, this is where the attorney can simplify things. So these are good conversations, and the majority of plans in Florida where it's not the city that's providing a half of an employee or a third of an employee. It is totally appropriate, which is Burgess's point. It is totally appropriate, just as the pension pays the attorney, just the pension pays the actuary, that the pension would pay whatever that monthly fee is for a TPA, if that's the direction we go.
Correct.
So right now, the city is paying some of the salary, but going forward, if you do a TPA, it would be the pension that pays it like a regular expense, and that gets captured as part of the valuation, as part of the operating cost. So at the end of the day, the city pays it, but it's being paid by the plan.
Additionally.
Do you have any further?
TPA reports protected.
That's something else. So I'm smiling. The city is correct that the TPA works for the board.
Right. So we can hire them, we can fire them, we can make the adjustments.
And you have to provide the space for them and the tools for them too. Remember, I use the printers, I use the network, I use the copying, you're paying for some of that in there, but you're going to have space also for that person in order to service your current people, much less your retirees, who many do not work through email anymore,
Point of
don't have printers.
Ms. Jill, so I'm clear, you mean if we were to hire someone in-house, a place to house them here,
Yes,
a city employee?
yes.
Understand?
And of course, that's the cost.
Of course it
Yes,
is.
and an additional cost.
Right.
Is there,
I'm sorry, go ahead.
is there any reason why, or is it too early to go out for an RFP now so we have some idea?
It's never too early. In fact, I would concur that if you wanted to do a motion today to authorize an RFP, which I can get out next week or, this week, that way you would You have access to that reports for the next meeting, the RFP responses. And then if I could make a quick observation about your comment and Jill's comment, that you would lose a little bit with the TPA of having the closeness, the hand holding for retirees. Because right now, retiree can knock on the door and figure out where Jill is and talk to her face to face. If you do a TPA, and this is advantages and disadvantages, the TPAs will be at board meetings, and you could ask them to schedule office hours, maybe every couple months. They'd have a couple hours, usually before the meeting or after the meeting, but you would not have a footprint in Palatka if it's a TPA, because their office would be located wherever their main office is. They wouldn't be using your computers, they'd be using their own hardware and equipment. So that's where you save a little bit of money because you don't have to give them an office. So just remember, that's a trade-off. If you hire an outside TPA, you're losing a little bit of that intimacy and that closeness, but you're bringing in a team of administrators that this is what they do for a living.
And also, that remote, the retirees would now have more remote interaction, which is in the social setting.
And they also would bring, so there's the remoteness, but also tools, because some of them are big companies,
Right.
that they have extra resources. So these are trade-offs, which is the reason why I think it makes sense to ultimately interview. If you get, as I said, 8 responses, and if you winnow it down to 3, to interview the 3, but you also need to know from the city, is the city going to provide, or is that an option? That if you can find someone who can step into Jill's big shoes.
We're working with our city manager.
That concludes the attorney's report, trustee. Thank you.
Would now be the time to make a motion for an RFP to find a third-party administrator.
Don't we have to organize with the other boards before we do that?
So the decision about what to do with the result, I agree, would be in collaboration with the other boards, but the decision to, in fact, I think that if you do the motion today and it gets voted on, I have a feeling, without making any promises, that the other boards will probably decide to follow the lead. So there'll be 3 separate RFPs, which they'll all get together, so that the RFPs, they can, take that into account if they're going to respond.
Motion made by Lundy,
Second.
second by Mr. Leary. All in favor? Aye. None opposed. Motion passes unanimously. So I'm going to make a motion to accept the report, the attorney's report. Mark make a motion to accept, second by Leary. All in favor? Aye. Thank you, sir. On to quarterly expenditures.
It's the year end, fiscal year end, it's not just quarterly, these are all the expenditures for the fiscal year. And I just need a motion to accept them. Any questions?
Trustees, if you do wind up bringing in a TPA, we're going to have to adjust the budget, which is fine. Budgets get adjusted. Just be aware that it will cost a little bit more if you do a TPA.
Mr. Levinson, you estimate 2,000 to 4,000 per board per month?
Per board per month. And that depends upon the negotiations. It depends which one you bring in. And that's a very back of the envelope, sir.
But they do have 18,000, looks like in there, correct?
Right now they have 7,000 in for the pension administrator. We can go back to that budget.
Make it larger so you can see it.
Oh, and by the way, I will mention to you, because Foster and Foster's in the room. Patrick is a humble guy, and he doesn't try to sell you anything. He's an actuary and he's a professional. But one of those big administrators in Florida happens to be Foster and Foster. So they have the actuarial services, so you know and love Patrick from doing your number crunching, but they also have another arm that does plan administration. And the advantage, if you were to use Foster and Foster for plan administration, is they're very familiar with the plan already because they do the actuarial work. But everything has advantages and disadvantages. And one of the disadvantages of using Foster and Foster as both the actuary and the administrator is that, it's a checks and balances. It's not an issue, just it's an advantage versus a disadvantage. So you would probably save a little bit of money if you use Foster and Foster, but you may want a separate entity, and there is no right answer. And that's the reason why I think it makes sense to bring them in, to interview them, to ask them the tough questions. And I think you would do well, really, with all of the ones that we were familiar with. But Foster and Foster, and again, these are the questions you asked, that does an excellent job as plan administrator. That's Farrell and a bunch of other team members.
And are those some questions that you can help us ask?
So either Anna or I would attend remotely for your next meeting, but we can put together a bunch of questions that you could use when you interview. And it should be self-evident when you look at the documents. You're going to get packets from that RFP with all kinds of bios and all kinds of nice pictures and glossy information. And I also want them to send a PDF. That way you can look at the PDF. And remember, you can't talk about it sunshine law with each other, but our fire chair could talk to the police chair or the general employee chair. Also, you could talk to the city, so it can be collaborative, just not with the same trustees on the same board.
Yes, sir. Understood.
And sidebar, I've worked with Foster and Foster for 12 months.
And that's the reason why it makes sense to do the interviews. So it would be easy today to say, let's hire Foster and Foster, but you have to know compared to what.
Right. Yes, sir.
So right now we're on the quarterly expenditures and I just need a vote.
Motion and second. Motion passed.
You've already seen the budget revisions. The budget I brought back down to what? From the 14 back down to the 17. Wrong one. Down to the 7. So, if you want to vote on that, if you want to wait, your budget, we're not spending the 14 that is in the budget. We're not going to spend it. Whether you want to leave the budget the way it is for the rest of the year until other decisions are made.
Trustees, I will tell you that most of the administrators that I work with will add a little bit of an increase from year to year, and they also add cushion. And we do know that there'll be more of an expense if we do head to, and remember that this budget doesn't mean we're spending money with the budget. It's a planning tool. So I have no objection to, putting in a little bit of cushion, particularly since we know that there's a good likelihood that we're going to have to pay more for administrative services.
So we could leave the budget alone instead of vote on revising the budget.
So can I ask a question? Do you have, the budget that I remember from before that they did already vote on?
Not
Is
in
that
this
the-
packet. This is
Mm.
the revised, bringing
the
it
only-
back to the old.
Okay, and the only change is that the budget that they've already voted on, it had 14,000,
Yes.
correct?
Yes,
So therefore, the budget that's in existence right now approved would be the 95 plus 7, so it's 102,300. Got it.
That's
Thank
right.
you.
so we're not going to change the budget then that.
Yeah, motion to accept as presented.
Second.
That's the part about luncheon.
Check on public comment or not.
Again, you should ask if you have a comment.
Anyone here for public comment? Motion to adjourn.
Second.
Aye. Thank you. Thank you, guys. Thank you. I appreciate it.
This meeting is continuing into the luncheon meeting, the educational training, so it's still being recorded.
So I'm sorry, it's hard to be glad you're making it. Good job.
Nice to meet you. Hey. The mayor. Mayor. Not a mayor. Letter. The information happened here.
Yeah.
Stick around, that's it. That was so loud.
It wasn't, no doubt, no doubt.
We said fire and police.
No. Was it? They motivated one of your old counterparts.
What your meeting is. Some more offices and driver. You're. Got a lot of bigger priorities in Miami, et cetera. We represent all over the state of Orlando.
See you. Yeah. You all right? It's good to see you. Well, yeah.
We lock in a lot of discounts, but they're really I'll serve.
I got something out of this. Yeah, they were like.
We've got about an hour of education. The sooner everybody gets their place and gets seated, that's what you'll start cracking open. Everybody needs to dig in. You are. I can arrange that. Man to me, he says he's still in there. That's what we do. Does this really? The entrance music, right? You know, plays. Yeah. Not sure if it's gonna get. Okay. Don't worry, Toby ate his way out here. And then I said, thanks later. I'm like, hey, let's check. No, we have problems. And I'm going to give us this one. So the mayor gets to be in the middle of the. Good. How you doing? Great. I can give everybody a 5-minute notice to get your place. I went to Rotary and they. I saw the pizza. Let's stop, I mean, maybe you said. No matter what we read. My bias. How much time do we have? On everybody gets actually. I didn't get a breakdown. Eventually gonna get more service. More or less even have anyone. Or do you want to swear people might? What you do when you see it. Come on, Superman always sits next to him. You make some very call the bag.
Maybe.
Remember that was a lot of used to call the money that walked in with the second or whatever. Also, here. I can find out. Right now.
Okay, good afternoon. I'll kick off the education session. I'm Dwayne Madron from Capital City Trust in Tallahassee. And so I've been asked to explain our role in the police and fire plans. So basically, we are the money manager for the plan, but we also custody the assets. In other words, we hold the money through a company called Reliance Trust Company. They're a big trust custodian. So that's where the money is. And so my job is to follow as close as possible the strategic model that Burgess Chambers has designed based on historical returns and try and add value to that model in small ways. I have a range that I can operate within, and it's called, typically in the investment business, we call it a core operating range. So if Burgess says 40% stocks, I can deviate maybe 5% in either direction, and each asset class has a range. So my job is to find out pockets of inefficiency where I can take advantage of, let's say, fear in the market when stocks go down, buy stocks when they're cheap, or trim them when they go up. So if right now, currently we're about 35% equity, whereas Burgess model is 40% equity. So we're a little bit underweight because stocks are expensive. So basically, my job is an asset allocator, and I'm looking at stocks versus bonds versus cash. And I'm taking into a wide variety of things to make that decision. So it's not a formula. It's really the team at Capital City Trust, myself and Seth Clark, and some outside consultants that help to determine the valuation between asset classes. And that tells me when to overweight or underweight an asset class. So here are some of the things that we use or consider. They're fundamental items that many money managers will use. The yield spreads between stocks, bonds, and cash. So for instance, bonds are yielding 5%, let's say. I have to consider that. Would an investor want to go into stocks if they can earn 5 or 6% in cash or a CD? 3 years ago, it was an easy decision because investors were earning 0 and they went into stocks. But today, bonds are starting to compete with stocks. So that's an example of yield spreads between asset classes. Another thing we look at is economic growth forecast. Economies go through expansion, recession, and contraction. And each one of these parts of the business cycle, stocks and bonds react differently. We look at consumer spending trends. Is the consumer in debt? Has the consumer been saving? Stock valuation, we have an external service called Holt Financial. They're owned by Credit Suisse Bank, and they use a discounted cash flow model for stocks, and they're able to tell us what stocks are cheap and what stocks are expensive, or is the market expensive, or is the market cheap? So we depend a lot on Holt. They're quantitative finance valuation gurus. There's about 20 of them. Half are in London, half are in New York. And through Holt, we ascertain valuations for stocks. We also look at yield gaps between stocks and the 10-year treasury, which is very wide right now. The yield on stocks is low. The yield on the 10-year treasury is wide. That would indicate to me that stocks are fairly expensive. We look at the price to earnings ratio going forward. That's an estimate of what earnings are going to be in the future versus what you pay for them today. We look at the price to book. We look at the enterprise value of a company. That is, if you had a yard sale and you sold the company in your front yard and you divided that by sales, what would the ratio be? The breakup value, enterprise value. Future interest rate forecast, price to sales, which is a nice one because it doesn't involve earnings. Sales are what they are. Free cash flow yield, which looks at the dividend plus the free cash flow that a company is throwing off, can tell you if a company is a cash cow or a wealth destroyer. So it's a wide variety of things that I look at. And I just wanted to throw that out and see if there's any questions, because our role is really, we're heavily dependent on Burgess Chambers to give us the guidance on the overall asset allocation, and we just try and add value on the edges. So that sort of completes my presentation. Any questions? Yes, sir.
Go ahead. It wasn't a question, it's more of a comment, and it's also a warning. And the comment is, in South Florida and all across the country, frankly, we have seen identity theft and sophisticated and whatever. It's Cat City Trust Company. So what does that mean? Maybe that'll be the question. But the background is that I could give examples if trustees want to talk about it later. And this doesn't require any action bias, but this is, I want to plant that seed, and finance knows all about it. And I know the trustees in general and their administrators are aware of the bad guys and guys out there want access to this money. And that's the reason why the job of the administrator and the job of the trust company is to make sure, and I can give the horror stories of what's been happening in the last couple of years with direct deposits, with to go through the list of money being stolen from plans because it's inadvertently fishing. So every precaution that can be taken these days is a well-deserved precaution. But I wanted you to react to that.
Oh, sure. Cyber theft. Well, as far as the money that's custodied at Reliance Trust Company, we depend on Reliance to keep the assets safe. And I don't know their exact procedures. I know they have some level of fiduciary liability insurance. I know that Capital City Trust Company has fiduciary liability insurance. Now, I guess the question is, if someone steals the money, who's liable? Can they make you whole? That would be a question for Reliance Trust Company. And I don't know the exact recipe for how they would make someone whole if there was cyber theft. I do know at Capital City Trust Company, it's impossible to move money electronically. If there's a check that needs to be cut, two people have to sign it before it goes out. And they have to verify with a voice identifier before they cut that check. Yep.
Controls, but just planting the seed that there are protections and checks and balances.
Yep.
And when it comes to email for individuals, be hyper vigilant.
Right. So again, before checks go out, two people have to sign it and they verify with Jill in person. They call Jill and say, is that okay to send these checks out? So that's one way a trust company prevents cyber theft, because let's say a brokerage, if someone gets your username and password, they can move money. Not so at Capital City Trust Company. Not one client at our trust company can move money on their own. They cannot do it. It has to be done with a voice recognition over the phone, and two people have to sign off before the check goes out. But again, I think the follow-up I would like to do, Jill, is get you more information on Reliance Trust Company and their cyber theft procedures.
Go ahead. I'm sorry. Since we went there through the attorney, when was the last cyber audit that your company has performed?
We have a corporate security division of about 5 people at Capital City Trust, at Capital City Bank and Trust. They do it every year. And they're constantly looking for things like money laundering, identity theft. And I'll give you an example. We had a person walk in with a $500,000 check to open an account. That person had stolen the check out of somebody's mailbox, stole their identity, and tried to open an account at the trust company. Well, the second time they came in to sign the paperwork, we had the police waiting for them. So it does happen. And I've had phone calls from people posing as clients. We've had phishing email attempts to get money. Again, we have to call and verify that that was actually what the person wanted. 2 people have to sign the check. But yes, every year we do an audit every year.
I guess I'm asking questions to make sure that we understand electronically. Are there any weaknesses? Did they identify any weaknesses within your processes?
No, not to my knowledge. We also go through training constantly on this. I just went through it last week.
Thank you, sir.
Mhm. Any other? Okay, who's next?
Burgess?
Thank you.
Good morning, good afternoon. I was going to make a comment about Cap Cities, which is very favorable. The concept of open architecture, which is very valuable. Oftentimes when you work with a company, they are very dedicated to their own internal proprietary products. But the nice thing about Cap Cities is that they're willing to go outside of their own theater and bring in products that are competitive and cheap. And so, 360 some odd percent of the assets are actually passive with the police and the fire plans and with the general plans. So this emphasis on passive has been a very useful way to cut costs. Now, the general plan is not with Cap Cities, but we've been able to get the same cooperation with used to be Sunbank, and that was BB&T, and now it's Truist. All right, let's go ahead and start on this picture. That's our corporate office in downtown Orlando. And so if you look at the middle of page there that looks like a triangle. It looks like the bow of a ship. That's where my office is. We're going to talk about asset allocation. This is more strategic. What Dwayne articulated very nicely was his job to be tactical. So if we set a target allocation, let's say 30% for a particular asset class, he uses their research and their team to decide throughout the cycle whether they want to underemphasize or overemphasize that asset class. We have a bond manager here today. They do the same thing. They may overemphasize mortgages within the bond portfolio or overemphasize corporates. So they have the same kind of internal role of being tactical. So if you go to this page, this is the background of pension funds. Look, we all know we're trying to make somewhere around 7.5% over the long term, and there's a way to do it. And we've been pretty good at it as an industry. If we let everything happen naturally, here's what's natural. Historically, corporations grow their earnings at about 7% per annum, maybe 6.5% per annum, and they pay about a 2% dividend. So add those two together, you get about a 9.5% nominal equity return. In the bond market, it's somewhere around 5% long term. So you take those two numbers, that 7 and that 5, and add them together with the right ratio, and you get somewhere around 7.5%. So that's where that 70% equity, 30% fixed income, that's where it all came from. There's an organic, natural basis for asset allocation. Now, the next level has to do with correlations. How do you find assets to blend together to reduce the overall volatility? If everything you're investing in is perfectly correlated, then you're gonna have 100% of the volatility in the market. If you can cut that volatility in half, then you can have more pleasant meetings and not have to discuss the pitfalls of volatility. And that's what we're trying to do. Now, before we go deeper into this, I want to mention for those professionals who are here, they've had a tough time, especially the last 10 years, because we've had these asymmetrical environments that have been driving capital returns. So we've had a tremendous tailwind of lower interest rates that the Fed has had in place to keep the economy from tipping over. This is very unnatural. They did this to prevent a depression. And it really started in I guess, 07, 08, 09, that period of time. Rates started to come down. And then we saw the next tip, which was in the early part of the COVID cycle. And then we saw rates come down even further. And then all of a sudden, we saw the Fed change direction and take rates back up again. So that asymmetry that nobody really can harness in terms of predicting has made, we'll just say, modern portfolio theory is somewhat upside down right now. Let's go to the next slide. Now, this is something that we all studied in school. I went to public school. I started looking at this in second grade in Orange County. Go back up. That's a joke. See if you're awake. But the idea is if you move more into equities, pure equities is purple, away from pure bonds, which is the brown color, the light brown color. As you move into that northeast quadrant, you're developing a higher rate of return expectation. And then the horizontal axis, which is standard deviation or volatility, is associated with that. Higher return, higher risk. That's the idea. And you can see that what is highlighted in that red box is that famous 60-40 blend, which has worked very well for a long period of time. It didn't work well in 2022. And we've talked about this already. It didn't work well in 22 because stocks and bonds became perfectly correlated same time. Okay. I think that tsunami is over. Let's go to the next page. Now we're talking about correlations. And if you look, for example, 1 means perfectly correlated. you can see that, and something around zero means there's no correlation. So if you look at intermediate term bonds, go over 2 boxes and then look down below, that's large cap stocks. The correlation is minus 0.01. Well, that's good. They're not correlated at all. Intermediate bonds and long-term corporate bonds have a correlation of 0.85. You just expect they're both bonds, so forth. So next page. This is another way to look at correlation of the left-hand side, number 1. See 1.0. That's what the correlation profile looks like graphically. And then all the way to the other side to the right is a perfectly negative correlation. I used to say this joke at the state conference all the time. This is why they don't ask me to speak anymore. But when you have when you're dating, you have a beginning of the marriage, you're perfectly correlated. And at the end of the marriage, you're negatively correlated. Now, next slide. This is another way to look at correlation, pairing up different, we're talking about really bonds and stocks and different allocations. Next slide. So time horizon is important. And you can see that over short-term time periods, you can see the volatility. And there's a good example of it. 100% stocks. Here's a 1 year holding period. Historically, we've seen results as low as minus 67%, as high as 24%. But as you go out way off to the right, 5-year period, you can see that the variability is much less, is much tighter. Next slide. Yeah, time horizon and risk profile. So portfolio risk appears to diminish over time when you average the ups and downs of the market. We talked today quite a bit about 2022 fiscal year, a horrible year. But if you spread that out over 15 years, the returns look much different. Next slide. And this is another way to look at it. This is the different holding periods and the variability. So there's the 12-month holding periods. This goes back to, may go back to 1926. Yeah, 1926 to 1922. You can see that the variability of stock returns. The average has been about 10%, but you can see that on over 12-month rolling periods, we've seen as high as over 150 and as far down as 60 some odd percent. So the longer the averaging of these compounded returns, the tighter the spread, and you can see that compounded return there of about 7%, about 10%. Next slide. Actually, let's back up again to the previous slide. So if you look at those at the bottom, you can see the different allocations. So you have 75%, 25%, 50-50, 25-75. As you would expect, as you reduce the amount of equity exposure, you're reducing the overall expected return, and as well as the variance, positive and negative possibilities. And then, of course, you go to 100% bonds. I used that term 5% a little while ago. That's the long-term average expected return for bonds. All right, now we'll go to the next slide. Well, because of the financial engineering that's been going on for quite some time, and the desire among firms to generate more fees, more options, we've seen more and more substitutes enter into the marketplace. And I remember when I first got involved in this industry a long time ago, 35 years ago, the state of Florida would not allow you to have more than 20% in equities. And they had to be all rated A or better. No international was allowed. And all the fixed income had to have an A or better rating. So there were very few choices available at that time. No real estate, no commodities, no infrastructure, no convertibles. None of that was allowed. In fact, the mid and small caps weren't allowed because they didn't have any ratings. Fixed income over time, we've seen that develop in Florida and nationally. High yield is permissible. Foreign fixed income, bank loans, and tips are also permissible. So we've seen a lot of engineering in the last 35 years. Next slide. Equity substitutes have ventured into we'll call it the alternative space. Alternatives meaning alternative to traditional stocks and bonds. Alternatives, though, have certainly made people a lot of money, those who are the purveyors of these products. They are, generally speaking, leveraged, which enhances returns. It also enhances losses. The fees are very high. In fact, after the meltdown in the market and the Great Recession in 08, 09, many of the hedge funds just disappeared. They went out of business. And a lot of the young purveyors of those products, they also disappeared. They didn't get sued. They just moved into their homes in East Hampton, I guess, and Amagansett, and disappeared. But many of them are coming back. But they're not pushing hedge funds because that's a bad word. They're pushing private equity. People seem to be more comfortable with private equity. In the fixed income area, core private real estate is very widely used in the pension area. They tend to be core, means that they are stable properties. They're not being leased up. They're not going through some kind of remodeling. They're stable, say above 90% leased. There are some long, short credit type products out there, which we don't get involved with, that are also fixed income substitutes. Some market neutral hedge funds. Those are designed to, these are people who place a bet on it that a company's market value will go down. Doesn't that seem counterintuitive? It seems sacrilegious to me. Why would you're betting you're going to make money if the company has problems? And you also invest in companies you think that they're going to go up in value. So you try to match off those returns and make money both in up and down markets. Private credit, big area of growth. These are portfolio managers that underwrite loans like a bank would, but they make their covenants and requirements of the loans are very different, much looser than banks. Next slide. Yes, sir.
Because it is a public meeting, if anyone ever asks for the minutes or the recording. These are not recommendations you're making, but you're just surveying the landscape that some of the bigger plans have gone into these.
I'm surveying. That's right. Thank you, Adam.
Bigger plans. Went back to 2008, 2009 when you introduced real estate.
Yep.
That was not a traditional investment.
No, it wasn't, but it was permissible and it was not complicated. Now, this, to your point, Adam, this goes back to 2001, I think, through like 2022. Those colors show the different types of the different types of alternatives and how they have kind of worked their way into the overall mix around the country. You can see private equity at the end of 22 represented 13%. I should mention that you go to Texas or California or New York, teachers, these big state plans, state of Florida retirement system, they tend to have a larger stake in the private stuff. A traditional Florida pension plan has a pretty small stake in private equity. I know of a couple clients or not clients, but plans on the south part of the southern Broward, Palm Beach County area that have as much as 25 to 30% in private at this time. Hedge funds still have about a 5% allocation overall nationally, although I don't see them in Florida that much. Real estate is at just around 10%. The plans here today are right around that 5, 6, 7% area. I don't see commodities anywhere. I don't see commodities as a real long-term investment. I see that more as a trade, and it's very influenced by geopolitical events, not stable. Fixed income nationally is about 24%. And then public equities, that means stocks that trade on daily on an exchange are around 43%. You remember I told you when I started 35 years ago, public equities was about 80%. So it's about half of what it was 35 years ago. Next page. If we're gonna diversify in any direction and these alternatives, it's important that you understand what you're getting into. If you're trying to replace income or growth, what kind of risk is there? And a lot of the risk that's inherent in these products are not clear. And really, there's a fourth box that's not here, is conflicts of interest. The private products are not regulated the same way as the products that Dwayne, for example, invests in. They're not under the Act of 1940 type of regulation, so they're looser. This is changing. Elizabeth Warden is way behind this and trying to get changes there. Next slide. Oh, more statistics. So this goes back to 2008, which was really, we had another 9 months left in the Great Recession equity sell-off, but you can see the relationship here. You have returns in the vertical axis, and you have volatility in the horizontal axis. And there are two circles there. The yellow circles represent returns, we'll say below the 60-40, and the blue returns are asset classes that did better. You can see the best performing asset class during this period of time. This is really, I said 9 months before the end of the Great Recession, is that blue little triangle up there. You see it? You know what that represents? Go ahead. No, this is for extra credit. I want everyone to look closely and understand that's large cap growth stocks. So this is technology. So tech has been the leader of the domestic equity market since 2008. In fact, U.S. technology large cap companies have been the best stocks to own in the world, quite frankly. And then if you look at the right below that horizontal line, the hash line, it's a little orange triangle. You can find it, Jill. That's it. What is that? It says MSCI EFI. That's international. That's Europe, Japan, Australia. Look how poorly it has done relative to where's the S&P 500, by the way? That elusive bogey. You see it up there? It's the yellow balloon. Look how superior the returns of the S&P 500 have been to international. Isn't that amazing? And you're looking at 14 consecutive years until this last fiscal year, international underperformed the S&P 500. So the point of this is asset allocation is important, but also it's interesting to see the dispersion of returns. Tremendous, isn't it? Next slide. So if you look at at these different asset classes that we've just saw previously, you can see how they measure on a consecutive periods of time. And let's look at the very bottom here, the Bloomberg Aggregate Bond Index, and we see a number of periods now where this particular asset class has underperformed. But keep in mind, this is due to what the Federal Reserve was doing and driving and keeping rates down for too long. And now I think we're at the turning point of that. Let's go to the next slide. Well, we talked a little bit about best and worst case scenarios already. James mentioned the Wilshire REIT index, the 2007 to 2009. It had a worse return of minus 50%. So you can see some of these assets really have volatility that's really hard to understand. S&P 400, which is the mid cap U.S. stocks, worst case minus 31%. Next slide. So if we have an expected return of 7.5%, this simulation of a sample plan shows that over the last 10 years, the blue represents a balance between stocks and bonds versus just pure equity with pure risk or pure growth or loss. You can see how balancing or mixing the different asset classes reduces the range of returns from positive to negative, but it also gives you a sense of how you manage risk. So page 18 talks about risk and reward. If you're looking at market risk premium, that's the expected return, the nominal return minus the risk-free rate. Right now, the risk-free rate is around 5%. Had been 5% in a long time. So expected return on the stock market, let's say it's still around 8%. 8 minus 5 is 3. So that risk premium is gone. That's what we were talking about earlier. The bond market is so strong right now. I'm talking about on a forward yield to maturity basis and looking at the coupon and duration, much more powerful argument you could make to bonds today than you could make 5 years ago. I'll skip this one. And we'll go to page 20. And this is another way to look at these indexes. And this is a little boring, but we have a bond manager on, no offense. But you can see that the index itself is very high quality. The majority of the assets are 66% invested in U.S. government securities. Then you have just under 4% in AAA, and you have AA, single A. So everything is triple B or better, investment grade. And then the next one is sort of a similar analysis, but this is looking at the maturities. 70% of the maturities are inside of 10 years. The reason why this is interesting is that when your bond manager is looking at what to do with the money that's being generated, the income that's being generated every month, being redeployed. And so when you have 1 to 5 year maturities, you're getting money obviously back faster to reinvest than in the 5 to 10 area. Well, we can look at page 22 briefly, but for some of you who may find it mysterious how bond managers actively distribute money, the latter concept really has an actuarial significance. Is Patrick still here? Because there was a time when companies would develop allocations that would match the allocations that would match the outflows or the expenses of the plans themselves. So you can see all of these little laddered investments are generating current period income in an attempt to match current retiree expenses. And then the bullet, and everything's kind of crunched around that 10-year, very concentrated. And then the barbell. The barbell is an attempt to maybe not make a big judgment call on interest rate direction or Fed policy. So I think a lot of what we see out there is more a combination of bullet and barbell. Next slide. We talk about this at every meeting. We talk about the benchmark. This is a simple equity fixed income, 60, 50, 70 kind of allocation on the equity side. And as you saw, have you seen some of the earlier graphs, the more exposure you have to equities, the higher the expected return, along with higher volatility. And then the last one, this is very interesting. So there's a concept called yield, we'll just call it the yield spread. But when high yield bonds become very, very cheap, meaning the yield is very high, because you know the coupons here, price of the bond goes down, and that means the effective yield goes way up. It goes way up in periods of distress when people are very worried about a depression. So this is proof that when the markets are really in bad shape in terms of investor fear, those indicate equity bottoms. Now, these are 3 illustrations of when that has happened. 2009, it turns out in March of 2009 was the bottom stock market. We had clients that were asking us, would it make sense to put everything into cash? This is after they lost all this money. They're just given up. So in May of 2009, we pushed all of our clients, convinced them to move back into equities. And the timing was good. It wasn't perfect. It was a couple months after the bottom. You never know where the bottom is until it's passed, but it's behind you. But it worked out. But what's interesting about 2009 was that the bond market had actually, the high quality bonds had actually gone up in value during that period of distress. So the money that was used to go back into equities came out of the bond portfolio. In 2022, when we saw both stocks and bonds come apart, the problem that we had and everybody else had is how are you going to go back into the equities? Were you going to sell the bonds at a loss? So many of us decided just to kind of ride out the storm because there was the high correlation caused both stocks and bonds to lose money at the same time. And with that, that's your education for today on the topic of asset allocation and strategic planning of a defined benefit pension plan. Now, there must be some questions. Thank you. That's pretty sweet. Any questions from anybody, even professionals? All right. Well, we've used up all of Adam's time. Where is he? He's getting ready. How much time do we have, Jill? 1:30. Oh, 1:30. Got a lot of time for the lawyer. He charges by the hour. No, it.
Well, we.
governed by, the 112 as a responsible. So I refer to chapter 112 as a patchwork of statutory rules governing public trustees, public officials, public employees, and compliance with chapter 112 is mandatory. But we do not get to choose what we want to comply with. We are required, and that frankly, the job of the person is to make sure we're jumping through all of the hoops in chapter 112. And the next bullet element is that we comply with chapter 112 at every board meeting. As long as Bill does a great job of doing their job, we have minutes. And we're keeping track of the sunshine law and all these provisions. Many of them are grounded in chapter 112. And we regularly comply with chapter 112. And so the main point I want to make on this slide is that a lot of us are familiar with our community. Which presumably is obviously code, but it's that's the why you also have to be complying with chapter 112. Are there any questions about what chapter 112? Very broad set. Going to the next slide. So you don't have to go into detail here. The takeaway is that for chapter 175 and 185, they get benefits on top of 112. The 112 gives minimums, and then the police and fire get money from Tallahassee. So the general police don't get money from Tallahassee. So police and fire, they comply with the minimum of 112, and there are additional requirements that we also have to comply with for police and fire. And there's often a common misunderstanding. Police and fire, like, no, I don't have to worry about 112. I have to comply with 175 if on fire, or 185 if 185 is police. And the answer is no. Everybody in the room is complying, you have to be complying with chapter 112, in addition to 175 and 185 if you're police and fire. Are there any questions about the
Fraction of how the three statutes work together. Okay, so we're just going to do a couple more, and I don't want to. Maybe you'll give me a 5-minute warning because we're already at 1:15. So the next slide is to give you an idea of how 112 is organized. And we are not covering all of this. But as you can see, part 1 of 112 governs conditions of employment and travel and retirement. That's all a subsection of chapter 112. You'll see that part 3 of 112 is the code of ethics for public officers and employees. So, that's a very detailed section, which we don't have time to talk about, but just so you have an idea, the ethics requirements for public officers, that's part 3 of chapter 112. And I'll give you a quick example. So, from time to time, for this board, things have been pretty smooth and things are quiet, and that's the way we like to keep it. But there are issues that other plans have, and I'm fortunate that you guys have done such a great job, you guys and gals. But there are other cities where we've had to do forfeitures, for example. And the forfeiture provisions, when a public officer commits a crime relating to their job, that forfeiture provision is in 112. That's part 3. And I could give you all kinds of horror stories about what it means when you have to deal with a forfeiture. But again, this is a survey of what the statute deals with. And then part 7, we could spend hours talking about the actuarial requirements. And when Patrick was sitting here earlier, when he gives you a valuation every year, that's what Patrick is doing. He's complying with the detailed provisions of chapter 112 part 7, which has various requirements for actuaries. So that's where that's coming from. It's coming from chapter 112. And by the way, finance has other provisions that may be very familiar with certain things in 112. So that's an organization of how the statutes are organized. The next section we can skip, but the Division of Retirement, who pays us the police money and the fire money, where do you think their authority comes from? The Division of Retirement? They're based out of 112. So long story short, it's an important statute. We deal a lot with chapter 112. And I'm mentioning at the bottom where it says, if we go to the next slide, organization. So one more. Okay, so at the very bottom bullet, I like to joke about this. I use the example of Alice in Wonderland. So whenever you have a lawsuit with Tallahassee, and some of my plans have had to go into the trenches, and we've had fights with Tallahassee, those fights are usually taking place under what's called the Division of Administrative Hearings, DOA. So some of you may be familiar with DOA. DOA deals with workers' comp, and DOA deals with other legal issues when you're fighting with the state government, for example. So the point I'm making, and that's a question that's on the test, and you can see it right here, that some of what the attorneys do is we're in regular court, which is circuit court, but we also deal with the Division of Administrative Hearings, which is DOA, if we ever had a match or a dispute with the Division of Retirement. And they do look at our valuations from the actuary, and there's these new requirements that we've talked about at board meetings that we now have to comply with, if you want to call it House Bill 3. And there's, I'm thanking Jill because she's in the process of loading the new information to the new portal, but this all falls under chapter 112. So any questions about the organization of the statute? Let's do maybe 2 more slides, and then we'll take a break. And I do want to answer questions. All right, so let's go to, let's end with this one, the Code of Ethics. So the slide number, and they're not numbered, but it says Code of Ethics at the top. So this is, again, just giving you some idea, and attorneys don't memorize this, but this is part of our job, is to make sure that the trustees are complying with standards of conduct, making sure, and let me talk about, this is a good example. And some of the trustees may be aware, the flyer talked about it. It'll be on the agenda for the other two boards to discuss. But Jill has been our administrator for in the neighborhood of 6 years, 4 to 6 years, and she does a great job. But I don't want to, you want to make the announcement? So there's going to come a point in time sooner rather than later where she's going to have to step down because life moves on. So a question is going to come before the boards, which is, do we want to try to find another Jill to fill those shoes, someone from finance or from another city department who can be borrowed for however many hours a week you work for the pension boards, or do we want to go out and hire, and there's no right answer, a third-party administrator? And I'll talk about this at the other board meetings. So when it comes to making these decisions on if we're hiring, if trustees were voting on hiring an administrator, and my last name is Levinson, right? So if I were a trustee, and lo and behold, I'm bringing before you another company with me, a relative, that's a nepotism issue, right? So you can't be, so long story short, there are nepotism requirements when you're going to be voting on an administrator or any other contract. So that's coming out of the statute. Voting conflicts, we talked about Form 1 disclosures. Every year you do your Form 1 disclosure as a trustee, a public officer, and when you leave, you do the Form 8, which is, I'm sorry, it's the 1F. You do a Form 1F the year that you leave, and if there's a voting conflict, you have to disclose it, and that's a separate form. So again, this is all coming from Chapter 112, and it's the job of the attorneys to help you navigate it, and you can see what the statute numbers are. So you'll see the 112 is the chapter, and then the dot with the number is the subsection or sections in 112. So this is where the attorneys bread their butter, pension attorneys. And I think I told you that would be the last slide. So let me pause for a second. Have I spoken too quickly? Are there any other broad topics we want to talk about under Chapter 112? I'll also throw out to you that a little bit more background, and I'm happy to talk with anyone. If you want to talk about the FPPTA, I'm happy to talk with you about the Division of Retirement. I'm happy to talk to you about the way that the attorneys work with the other professionals. And unless there are any questions, and I do encourage questions, I wanted to end by thanking Burgess for putting this together, and Jill for everything she does. Right, and maybe the most important thing I can say, trustees, the most important thing I can say is there is no such thing. This is the definition of being a fiduciary. And I've got slides in here that talk about fiduciary duties. We're not going to cover them. But the most important thing I can say is ask questions. The job of Burgess, the job of the attorney, the job of the actuary is to answer your questions and make sure that you're comfortable with those answers. So never be afraid to ask questions. And I'm going to leave my cards if anyone wants to call with questions about the slides we didn't cover. But that's really the definition of being a fiduciary. You put aside your mayor hat, you put aside your firefighter hat, your police officer hat. You are a trustee, you are a fiduciary for this plan. And when you have questions, it's our job to answer those questions and make sure that all the pieces fit together with the checks and balances between the different functions of the different folks who work for the board. So it's a pleasure working with you. It's a pleasure meeting you. And again, I'm filling in for Anna today, and I'm always available, and Anna's available to answer any questions. We will not charge if you want to call about the presentation, but thank you so much, everybody.
I think they all graduated, didn't they? Did they all pass?
Yeah, everybody gets full credit.
Okay.
And it's in your investment policy, which is coming out of where? Chapter 112.
Right.
So your investment policy has a sentence in it or so that you are encouraged. You're not required to attend conferences. And what we're doing today is we're bringing trustee education into the room. So thank you for that opportunity.
I heard you trying to say you didn't feel for coming up with one. Did you hear that?
So what the attorney said is we will not charge to answer questions.
I guess we will have to get. They never know what they've done with my investments. I know it's very. Okay. So there, that's why I know actually.
Okay.
Yeah.
All right. Thank you. Thank you.
Let's start putting together the annual.
The annual report is put together by and in coordination of the. Final handling of, because really it's a document generated by the city. Did I do all right?
Very great.
1:30.
Remind everyone, we're still being recorded. We recorded the training and we're continuing to record.
The trustees, since we're being recorded, I can mention it because it's, we shouldn't mention it until we get called to order, but basically we're already called to order. But the main items where we have to do the heavy lifting today are under the actuaries report. And that's why we're going to have to put our thinking caps on. And also I teed it up earlier, but there's going to be a question about administrative services. So those are the two action items, if you will, administrative services and the actuarial subject. But everything else, the attorney's report should be relatively quick, and Burgess's report and our money manager, our fixed income bond manager's report does not require any decisions today, unless you wanted to make decisions. Madam Mayor, I had mentioned that the main action today in terms of decisions is going to be, the heavy lifting, so to speak, is going to be under item 6.
Welcome, everybody. I'm going to open the meeting. Roll call, please.
Scott Nance,
Here.
Matt Newcomb,
Here.
Mayor Carrera,
Present.
James Snowden.
Here.
Thank you. Has everybody had an opportunity to read the prior meeting minutes? The motion, do we have a second?
Second.
Okay, any questions? All in favor? Aye. Any opposition? Thank you. On to the Sawgrass Management Report, Mr. Gilla.
There you go. Good afternoon, everyone. I'm Liren Gila, Portfolio Manager at Sawgrass Asset Management. Before I begin, I'd just like to thank you again for the opportunity to manage your fixed income portfolio. It's an honor for us. Before I get to the details of the presentation, let me just kind of give you a quick update on the state of the bond market, and then we'll get into the performance, and then we'll talk about the outlook going forward. It's interesting because we just experienced a once in a several decades, I would think, in terms of what we saw with regards to the total return. Last year, 2022, was a really bad year for bonds. And the expectation at the beginning of this year for our market was that essentially we were going to have a nice year, a nice bounce back, and the rates were going to settle, but that actually didn't prove to be the case. We continued to experience more volatility with rates. Most of that is primarily driven by the inflation expectations, the lack of stability of the inflation. Recently, we've had some volatility in that regard, but I'm very convinced that based on where the macro economy is right now, given the leading indicators that we're looking at, whether it's the leading indicators, like the shape of the curve, some of the leading economic data, the soft data, they're all pointing to the economy slowing down. The most recent jobs number came a little bit softer than expected. The inflation, the most recent print came at 3.2%, a little bit better than expected. So the overall trend of the inflation is going in the right direction. So from that perspective, we think that the inflation has peaked. It's going to level near 2% over the next year or so. So if we look at the inflation break even at 2% and a 4.5% nominal rate, we think that's actually a pretty good value for the bond market. So from that standpoint, if we look at the numbers, we've had some, subdued numbers over the last couple of years, but looking at the yields, looking at the current numbers, I think that the expectation for the bond market is going forward, we're going to have some pretty decent returns. On page 10, we've got our performance numbers updated as of 9/30. So you can see here, year to date, we've had an underperforming period for that time, but on a fiscal year to date basis, essentially very close to the benchmark. On a 3-year basis, pretty much close to the benchmark. And on a 5-year basis, if you look at the nominal numbers, we're a little bit ahead of the benchmark. So we kind of stayed close to the benchmark, thinking all this time that the inflation is transitory, looking at some of the fundamental data. So essentially, we haven't really added a lot of value. But going forward, we think that given the current state of the markets, we think that the value for the bonds it's pretty reasonable given where everything else is trading. If we look at the portfolio characteristics on, let me just look here, page 16. The current yield to maturity of the portfolio is at 5.5% as of 9/30. If we look at these numbers on a historical basis, I would say these are pretty attractive numbers. We're looking at the highest rates that we've seen in the past 20 years. And given the fact that the likely trend for the economy is to soften going forward, we think that this is a pretty good place to be in the context of the overall asset allocation, especially given where relative valuations are in the other pockets of the asset classes, such as equities and private credit. You've got a pristine asset quality asset class, such as bonds at 5.5%. You're finally getting paid to own a very high quality asset class that does provide that true diversification. If we're talking about a potentially an increased probability of a recession going forward, you can count on this part of your portfolio, the bond market, to protect you in the down market, but at the same time, you're also getting paid for it. At 5.5%, that's a very good carry in the context of where we've been over the last 20 plus years.
There's a question, but Chair will permit me to. What I'm like you to share with the board is if we're seeing rates at levels not witnessed in 20 years, favorable rates, put that in context with duration and how we can expect to see these better returns forward, let's say over the next 5 years. What's the mechanics of how that actually plays out?
Yeah. Well, so 5.5%, that is your income for the year. And that is composed of the coupon that you're getting plus the difference on that price. If the coupon is less than the yield, right, you're getting there's a difference there. So the yield captures the difference between the yield, the price, and the coupon. So that's your true income, 5.5%. To Burgess's question, if we happen to have a rally in rates as a result of, let's just say the recession is hitting the economy and everybody's buying bonds again, the risk haven is back. So and rates go down by 100 basis points. If you look at that, the second line item, what's called the effective duration, that is the measure of the price sensitivity to rates. So in other words, just for ease, let's just presume if that is a 7 years, that means that for every 100 basis points move, the price change of the bond portfolio goes by up or down 7%. So if we're factoring in 100 basis points move lower in rates, the total return, expected total return for the next 12 months, it's going to be 5.5%, which is your carry, plus that price change, which is 7%. So the total return for the next 12 months might be 12.5%, which is really not that bad considering that, this is a very high quality asset class, very low risk, a true diversifier.
Let me ask it another way. Very good answer. Let's say that you knew with precision that the Fed was going to lower rates by 250 basis points, say retrace half of the increases they've done in the last year and a half or so, and that would start occurring in about a year and a half. If you knew with that to be exactly the case, would you then extend the duration in anticipation of that?
I would, correct.
And explain to them why, I'm not suggesting you do anything, but why would that be important?
Well, as a matter of fact, we have increased the duration recently in anticipation that the Fed will pretty soon start cutting rates, and the market has already started to price that in to a certain degree starting next year. But to answer the question, if I knew for a fact, if you knew that the Fed was going to cut rates, obviously they don't control the entire list of maturities that are available in the marketplace. So in other words, they don't control the 30-year, but they do control the short-term rates. But empirically speaking, that does have a huge impact on the direction of the 10-year. Because when you think about when you buy a 10-year bond, you're essentially buying the expected Fed funds rates, 10 years from now. And if the Fed is giving you the communication that we're going near zero, then there's an increased incentive for the street, for the participants to actually buy that paper. So most likely, even the longer term securities would really participate with the short-term rally that is given by the Fed. So in that type of environment, you actually want to increase duration because you will get a much better total return due to the price increasing even more because you've got higher duration.
And just after the chair, this is one last question. If you were giving an assignment right now of $1 million, round numbers, and you were told that the board has an expected rate of return of 7%. What is it here right now? 7.25? Let's say 7.25, whatever. And you were given latitude to go down, let's say a double B, 7.5. How close could you get to 7.5 or 7? Let's say 7. How close could you get there with your yield of maturity of 7%? How close could you get right now with it just new money?
Well, you can try to. What you're saying is, can we immunize the liability or the cash flow, expected cash flow to the beneficiaries, given the current long-term available rates in the credit side?
I don't want to go that far at this meeting, but that's another discussion.
Okay.
But I know I agree with you on that.
Yeah,
But
I think in terms of the market, what the market allows right now for, say, a triple B type quality average, you're looking at a roughly 150 basis points spread to treasuries. So if you do the math, you're getting, close to, low 6s, 6 1/8, 6% on most of the triple B bonds.
Now that's forward. And you're buying those issues at par or at or below par?
Sometimes the market allows us to buy some heavy discounted, the legacy production that came a couple of years ago. So you can actually buy it at 70 cents in the dollar, which means that you also minimize the reinvestment risk of that.
Is the yield curve in the proper, is it too early to do that?
I don't think so, because typically the empirical data shows that when you have the yield curve inverted, what I mean by that, when the longer term maturities are yielding less than the short term maturities, so that's what the market says is the yield curve is inverted. Typically, that's a sign that the market is front running what is the expected path of rates, which means the rates are going to go lower. At least in the previous cycles, that's always been the case. So it's never too late to do that because the duration will benefit, even though the 30-year is not going to go down as much as the 2-year because the yield curve is inverted. But from a price standpoint, you will get that benefit in terms of the total return. So yes, you will get rewarded for that if we think that the rates are going to go lower because inflation is going to settle around 2% over the next couple of years. Now, the big question is obviously, what is the view on the inflation? It's been a little bit, sticky lately, and there's all kinds of speculations in terms of, are we back in the 70s? My view is that we're not back in the 70s. If we look at the demographics, the technology, globalization, this is a service-based economy, a credit-based economy, and a lot of the the fundamentals, the way our economy is running, it really needs low rates. Otherwise, we can't really afford it. But that is to be seen. So in terms of our view, we have a very strong view right now that yes, over the last 5 years, essentially, unfortunately, these 3 dreaded years in the bond market took away the entire gains that we got over the last 5 years. So if you look at it on a 5-year basis, you're essentially flat. Okay, so it's kind of like this lost period. But on the flip side of that, the bright side of that is that going forward, you're looking at least if rates don't have any changes over the next 12 months, you're looking at a 5.5% carry with a very yield portfolio with a very high quality approach, a true diversifier to your total allocation. And so because of your long-term mandate, you actually would benefit from this. You're actually better off. Yes, you took the hit. It took 3 years to take that hit. But going forward, because you have long-term mandate, you're going to be yielding at 5.5% for the next decade plus, right? Assuming that rates don't move from here. So from an actuarial standpoint, you're actually better off with these higher rates.
That's a very, it sounds profound. But it's true. Pension systems across the land are in a very interesting, favorable position right now, thanks to the Federal Reserve. The question is, are they going to take advantage of it? And a lot of plans are so dug in with private products, private equity, private credit, they can't pivot into bonds.
Yeah.
There's no liquidity. But you don't have that problem.
And also in terms of from a tactical standpoint, where we feel a little bit strongly here, we've kind of matched the index, as I mentioned, from a relative performance. So, it is incumbent upon us to do a little bit, better in terms of generating more alpha for your portfolio. But given how everything is kind of trading at this level, how tight the credit spreads are, and we're talking about an elevated probability of a recession in the near term, we have taken the active approach to be underweight credit risk from a sensitivity standpoint and shift that overweight to mortgages. We like mortgages at these spreads levels, especially the discounted mortgages, the production that came a couple years ago where everybody, I locked in a 3% mortgage, you probably locked in a 3% mortgage. All that production went to these lower coupon buckets, and all that paper is trading at 85 cents, 80 cents in the dollar. Well, if you buy it at that really heavy discounted price, which is historic, by the way, I've never seen a mortgage trade at that type of price. Well, now it is. What you get there is you actually get no credit risk, right? Because it's guaranteed by the government. The biggest risk for mortgages is the prepayment risk, right? When we buy a house, you lock in the mortgage, and you've got your mortgage broker in speed dial, right? So when the rates go lower, you're gonna call your broker and want to refi. Well, when we refi collectively, the person that actually loses in that equation, that math, it's the holder of the mortgage security because you're putting it back at par, right? If you're buying the mortgage-backed security at a heavy discount, you don't have that prepayment risk. So from that standpoint, you've got no credit risk, a very minimized prepayment risk. We actually like that security. You get a decent carry, and it's a very good quality asset class to have. One of our rationales to go overweight that sector, and we've done that over the last couple months. So again, in terms of what to expect, for the next couple of years, I think, as I mentioned, we've had a period of very historic type level performance in terms of the absolute numbers. That the year of 2022 will be remembered for a long time in terms of what can happen to the bond market. We're also on track to generate a third year of maybe this will be a slight negative return, but nevertheless, it is a negative return, which has never happened in history. But I think the days of having these types of numbers in the bond market are pretty much over. And we should expect a bright future for bonds, given these current rates, given the fact that the inflation will be anchored at near 2.5%. So you're actually getting a real yield. You're getting a 2.5% real yield. So I think the outlook for bonds is very bright going forward. And you should be looking forward to this. You get a decent carry in your fixed income portfolio. So with that, I'll conclude my brief presentation, and I'll take any questions if you have any.
Well, do you have any questions?
Oh,
Anyone else? Okay, thank you.
thanks.
We need a motion to approve the report. The motion is second, all in favor? Aye. Any opposition? Thank you. Mr. Madron, please.
Okay. Good afternoon, Dwayne Madron, Capital City Trust, Tallahassee Portfolio Manager. And we have this packet, which may be in front of you. It's also on the screen for the third quarter performance. And we go to the page 2, inside page. Before I start talking about the asset allocation, I'll make some general comments for the third quarter. It was not a great quarter for stocks or bonds. Inflation raised its head, and that scared the stock market. So that's been the story for a very long time, the fear of inflation and the fear of the Fed continuing to raise rates. So, however, towards the end of the third quarter, consumer spending and economic growth started to come in better than expected. So that was sort of the saving grace that brought the stock market up a little bit towards the end of the third quarter. So not a great quarter simply because of the continuing narrative that inflation was moderating, but then, oh, no, it's not. It's going back up. It's not under control. What are we going to do about this? So there was a good amount of fear in the summer. And in general, I'll say that, a comment I want to make is consumer spending has been sort of saving everything. Consumer spending has been strong. Everyone has a job. Wages have been going up in some industries, like UPS just got a raise. United Auto Workers just got a raise. And so consumers are spending, and some of it was from the pent-up demand and pent-up savings from COVID. But now we're seeing where credit card debt is going way up and delinquencies are starting to happen. Auto loan delinquencies are starting to happen at a fast rate. You probably read about it in the news. And so what concerns me is, can the consumer spending continue? That's going to be the next bugaboo or big elephant in the room that we have to work through. So seeing that, I pulled back on large equity stocks, underweighted them because of the fact that stocks are expensive historically, and the fact that the consumer, which drives our economy, is tired. They're starting to use debt. And I wonder how much more spending can they do? So if you look at the asset allocation in front of you, the policy review, you'll see where large cap equities are at 38% versus the policy percentage of 40. Now, last week I brought it down to 36 and put it in cash, which is earning 5. Otherwise, I'm pretty much in line with Burgess's strategic model. I like to stay very close to it unless I have a very good reason not to. And so I'm within range, in compliance with the operating range. And if there's no questions on that, I'll go on to the next section, which is account performance, page 4, where it's this is at the end of September 30th. The latest 3 months, the latest quarter is minus 3.66. Like I just said, it was a rough quarter due to inflation and some fears that inflation was not under control. But the year-to-date number, by the way, is the fiscal year-to-date. That's locked down for the actuarial purposes, was 15%. Equities were 17%. Underperformed the S&P 500 a little bit because of small cap and international stocks. However, high yield did very good at 9.75. So for the year ending 9/30, 15% for equities. That does not include bonds, and I'll let Burgess go over the total return. But 7% for each of the last 3 years, 6.7 for each of the last 5. Not bad considering we had a minus 20% year in calendar year 2022. So I'm anxiously awaiting for small cap to come back. When the economy starts growing again and interest rates come down, you'll see small company stocks come up and you'll see international come up a little bit. So I'm looking forward to better returns from the small cap and international section. The next page over, page 5, is simply the returns at the end of October. So in the new fiscal year, the first month out the gate is not good. We're down fiscal year to date minus 2.99. Equities were down 3 because October was a bad month. November has been the best November in years. November, I think stocks are up 9%. which is incredible because interest rates are coming down. The Fed has signaled that they are done raising rates and stocks responded to that. So I'm optimistic the next 11 months will be very good because bonds can offer total return of 5 to 8 or 9% if rates come down. So I'm looking for the next fiscal year to be quite good. Asset allocation, 2 pages over, page 7. This is on November 16th, this is the value of the equity side, 72% in equities, which is now about 69 because I trimmed it last week. Still up there, the cars in 5th gear in anticipation of stocks doing well next year when interest rates come down and growth picks up. So I definitely want to have a healthy dose of equities because your actuarial return is above 7. And to get to 7, you have to have equities in there. The next page over, page 8, is just a listing of the mutual funds that are mostly index funds. So you by and large own the market. You own the stock market and you sort of are a buy and hold investor. We make very little changes. We're long-term strategic investors. We invest based on long-term historical assumptions. And that's why you see a lot of mutual funds instead of individual stocks. And that continues on to page 9 with the Sawgrass and the Vanguard High Yield Fund. Any questions?
Any questions?
Is this the plan policy or your policy? The allocation?
He's following the plan policy.
Okay, all right, I know you said your policy.
The same thing.
He's tactical in that from time to time, he'll underweight real estate or overweight domestic equity. He does that from time to add value.
I just wanted to add, building on your question. Remember, I was talking about chapter 112 Florida statutes. Guess where the statutory requirements of the pension boards have to have an investment policy? Where does that come from? Chapter 112. And you can decide how you want to allocate it. So you control that policy, but you do it under the dictates of the statute.
Thank you.
Who?
Okay. Was that a motion?
Yes.
We have a motion?
Second.
Second, all in favor? Aye. Any opposition? Thank you.
Thank you.
Mr. Chambers?
Yes, Madam Mayor, pleasure to be here. And do you remember that slide I presented to you that showed the best returning asset class since 2008? Remember that?
Mm-hmm.
What was it? Technology, right? Large cap growth. And S&P 500 wasn't very far behind it. Let's go to page 8. I just want to make sure you didn't have to take the class over again, okay? Just go to page 8. These target allocations Mr. Nora was referring to, these are from the policy that was updated in August. It went into effect 31 days afterwards, which is September, actually October. So this is actually technically the old numbers, but I'm going to tell you what the new ones are. So the domestic equity target now is 52. It went up by 5%. And to do that, we took 3 away from the convertible bonds, and we took 7 away from international. We took 2 away from private real estate. So we brought that from 7 to 5, and we added 2 to fixed income. So well, our feeling right now is that the world has changed. The globalization that we've been indoctrinated about since China became a member of the World Trade Organization is changed. It's upside down. Our trade with China has dropped in half in the last year. In fact, I bought some $50 running shoes the other day. They're made in Vietnam, and the same brand, which I bought a year ago, were made in China. So you get same company. So you already see this transformation going on in the supply chain. The Russia-China relationship is disturbing, and a number of companies have, U.S. companies and European companies have disinvested from Russia, and we've already seen the disinvestment that's going on in China right now. I don't know how it's going to play out, but it's the reason why we brought the international allocation down from 15 to 8. Now, Europe and Japan are the bulk of this international equity marketplace. But Europe's in trouble too. Germany's in a recession right now. Glass prices are too expensive. Germany needs a lot of electricity to operate, and their electric costs have gone through the roof. So guess what? Where German companies are moving to? They're relocating to the United States. So that's one reason I'm very bullish on the United States. So those are the changes that we made recently there. Then let's jump back to page 1. I'm just trying to plant a seed here about bonds. Now, we've been talking about bonds all day. I've been doing this a long time. The BCA is 35 years old, but I've been in the business of about 40 years now. And during that 40-year period, I've seen bonds go from 18% to 0. And then we've seen bonds go back up. So my career, I've seen an entire secular decline all the way down to 0, and then a quick pop back, sort of a quick cycle back to where rates were in 1969 when we landed on the moon. That's where we were, right where we are right now, the interest rates. But the risk premium, that is what you can earn, yield you can get from a stock versus a treasury, is so small now that it begs the question, why don't we have more money invested in bonds? Now, we have a very good, you've got the bond manager here, very compelling evidence that going forward, we can expect at least, what's your yield of maturity here, 6%? Right around 6%. And along the way, if rates do take a dive because the Fed decides to put some more heat to the furnace, we could see 7% easy 5-year annualized returns in the bond market. Is that possible?
If you did the math on a 1%, let alone 2%. So yes, it is possible.
Well, if you average that over 5 years.
Yeah, it is possible.
So we're going to be talking more about lifting perhaps some money back over to the bond side. And in the last 10 years, all of these plans have been looking around for alternatives to bonds because the bond yields were creeping down, the coupons were creeping down, and now it's flipped. And it's flipped very quickly. So that's just kind of giving you a heads up there. The public sector and the private sector are a little bit different. The private sector, these are corporate pension plans, are moving at warp speed right now to immunize. They are actually carving off chunks of their liabilities now and selling them off to insurance companies to just take those responsibilities off their shoulders. We can't do that here, but we can talk about the concept of de-risking is really, I think, the best way to look at it. If we can de-risk, stabilize volatility, lessen the likelihood of retirees wondering why their annuities bouncing around. If we can do things like that, then we're doing our job. So we're going to try to educate you more on that next quarter. On page 4, I'm not going to go into a lot of detail here because we've already heard it, but I will say that you did have a decent fiscal year at 8.4% net, that you beat your assumed rate of return, which is 7.5. Good. I would say we're off to a good start this quarter right now. What do you think? Where are we on the equities, you think, so far since October 1? +4. Okay, what about the bonds?
Low positive single digit.
Low what? 2.5. Okay, so maybe we're up around 3 something year to date. So for this quarter, that's not bad. That dovetails really with the expected return. Now, the 10-year number looks disappointing at 5.7% per year, but it's all because of 1 year. I looked at this 2 years ago, same report. I should have brought it, but go to page 18. This goes all the way back to 2005. These are fiscal year returns. And 1 year, 2022, messed up the whole party. And it's important to understand that the asymmetry is so rare, it's not likely to happen again in our lifetimes. That is, where interest rates would be pulled way up by the Fed very quickly with a backdrop of very low coupon to stabilize the bond market. At the same time, the equities collapse. So we had both a collapse of equities and bonds. And that's why we got this double, it's really a double shot here. All right, it's a 357 shot twice at the guy instead of once. And that's what happened to us here. But if you look on page 17, you look at the model, the strategic model, results have been very close to it. So the strategy put us in a position where we were going to get walloped here. There's just no way around it. I mean, I'll take responsibility there, but I don't think any of us knew that the stocks and bonds would go down at the same time with such a large magnitude. I don't think anyone saw it coming. Only people that really survived this a little bit better than us were programs that had a lot of private money, private equity money, for example. These are companies that are in a trust or partnership that aren't marked to market. So the real value of those companies is not known. It's predicted, it's estimated by the general partner who's got a conflict of interest, Adam. Elizabeth Warren is all over this. And I think at some point, this is all going to open up and we'll see regulations that are badly needed to fix this problem. But those are the only funds out there that did better. Now those same funds are having challenges because those private equity are being marked down, and their year-to-date returns are way behind the returns that you've seen in the equity. So it'll come around. You'll do much better in the future. Back to page 4. Just a couple remarks on the manager reviews. Cohen and Steers, which is the infrastructure manager. They are beating their benchmark, but I should add that about 45% of their portfolio is invested in utility stocks. And utility stocks, these are really good companies, strong balance sheets. They can pass on their costs with rate increases, high barriers to entry, bulletproof companies. The problem is since they're dividend type stocks, they're very sensitive to what happens with prevailing interest rates. So when interest rates shot up, utility stocks were not attractive anymore. People would say, I'll just sell my utility stocks and buy the 6-month treasury, make 5%. And that's exactly what happened. But once rates start to roll over and we see rates go back down again, this sector will rally and will do very well. The last thing I wanted to mention to you, those of you who are still awake, on page 12. Sawgrass is here, so we'll talk about Sawgrass. Clearly, over the last 5 years, last 10 years, the returns have been very low. And I think you now understand why. Most of this elimination of 10-year returns happened in 1 year, happened in 2022. But I should also point your attention to the high yield piece, which was added here as a complement to Sawgrass. High yield, by definition, represents companies that pay bonds that pay a much higher yield. They're lower quality, but we were more bullish about the economy than others, and we like high yield with an expanding economy. With all the injection of stimulus, we weren't too worried about the economy rolling over. That's why the 1-year return for high yield was 9.4% versus a flat return for high quality fixed income. So if you look at the totals, the global fixed income, we combine the two together on a weighted basis. You see that the high yield, although it's a pretty small portion of the total 2.6, it had a material impact and it was favorable. The last thing I want to mention is right above it is American Core Realty. Now, we like real estate long-term for pension plans. In fact, your mayor is an esteemed realtor, I understand.
Esteemed?
Is that true? But what happened was American Core, even though everything he owns is very high quality and they have very little leverage, their leverage is only about 19% of the portfolio, the total trust. They have a 20 some odd percent, 19% allocation to office buildings. Now, I can't get my staff to come to my office. I've already told the Highwoods, the owner of the building, that we're not renewing our lease in a year and a half. We're either moving out or we're downsizing probably 75%. Sawgrass already did that. We're ahead on that. But the corporate office owners can't get banks to lend them money. They can't refinance. They can't occupy their space, so they're downsizing. And they're going to their landlords and saying, $30 is too much. We want to go back to 18 a foot. So that pressure is what's the main reason why we're seeing these negative returns. We've had 4 consecutive returns negative in American. If you go back 2 years ago and look at the same portfolio returns with other clients we have, their 10-year number was around 8.5%, 9%. Just this past year, it's just crushed private real estate. What's going to happen going forward? We're going to see more pressure, and that's why we suspended the dividend reinvestment program. So the dividends that are coming off of this real estate product that heretofore were being used to buy additional shares, we're getting the money back here. It's coming back to the bank to pay expenses. Once this market stabilizes, then we'll go back to the dividend reinvestment. That's it.
Thank you. Do we have any questions? Mr. Davis?
Curtis, what's the overall, and we know that we have, I guess I can use the term underperformed in the last quarter.
Yes.
And
last year,
and we have been, I guess, the latter part of October and going into November, the market started to come back.
Yes.
So what's the overall health?
What's your overall what?
Overall health of our portfolio?
You mean hurdle rate?
Yes.
7.5%? Is that what you're talking about? Yeah, 7.5%, and it looks like we're right around. We've hit 3% already since October 1. That's pretty good. I mean, if we can keep this pace, and of course, everybody's listening to what the Fed's going to do. Even the Fed governors are now debating on what they're going to do. There's so much going on. I mean, you've got Ukraine, you've got Russia, you've got China, you've got Taiwan. You know, China was supposed to invade Taiwan 2 years ago. Yeah. This is supposed to be a done deal. It didn't do it. There's a lot going on that we can't control. But I do know this, the U.S. is still got a lot going for it. And a lot of people want to invest here. They want to move here. They want their kids to go to college here. They want to have their medical treatments done here. We have a great legal system. We have too many lawyers. But I'm very bullish on the U.S. and more bullish than I have been in a long time vis-a-vis the rest of the world. That's because the challenges in Europe and the challenges in Asia are more and more money is funneling back into the United States economy. And that's why I'm pretty optimistic. I think this year that we're in now, I think you're going to beat your hurdle rate. You did last year. I think you'll do it again this year.
No, the Feds they're uncommitted on inflation. You know, they're saying this is lowering that kind of thing, but they have not committed to say, well, you know, we're coming out of it yet.
You know, much of the credit has gone to the Federal Reserve. But quite frankly, and you read a lot more than I do, and you do too. And you do too. The supply chain was all screwed up, and that had a lot to do with inflation, and a lot of that's been sorted out. The impact of what the Fed's been doing, we really haven't felt that yet. It takes a while. There's a delay.
And inflation came from 9 to 3.2, on its own, not the Fed did it. To Burge's credit, that's a long lagging type of policy, right? It takes about 2 years for that to really see the full effect. So you haven't really seen the full effect of the Fed's move.
That's right, a lagging indicator.
It is a lagging.
What has I think baffled all the economists, both at the Fed and private economists, is that they didn't recognize that there was so much liquidity, so much money floating around since COVID. It's still being spent. And there's this velocity of spending. I mean, I drive all over the state of Florida, and I can't tell you how many pickup trucks I see with ladders dangling off the top. There's work out there. There's so much work. They can't find the people to do the work. This economy is very, very strong. And and I think it's going to remain strong for quite some time. And I think, you know, the Fed's just going to have to be patient. You think the Fed's going to raise rates again? What do you think?
I think they're uncommitted. They're just not committed one way or the other.
Yeah.
I think that they're just, I think they're waiting on different reports to come out to make a decision and all, but you know, I wish they were ahead of the game rather than lagging the way they're lagging.
Well, I'll tell you, there's so much, the military complex is on fire. It takes a long time for government contracts to really start. I mean, it's 3 years at least lead time, sometimes longer, but they're just getting geared up now. And so there are a lot of high paying government military contractor jobs that are going to be going on for years and years to come. So the economy has a lot of legs on it. So this area starts to soften, this area softens, the EV market dries up in Detroit, but then you have these other parts of the economy to take up the slack. So I think overall, inflation is going to decline because will continue to decline from, where is it, 3 something, 3.2, something like that? It will because the supply chain has been, much of it has been fixed. By the way, I'll leave this with you. The container from China to the West Coast during COVID, it was $18,000 to pay for a container full of stuff. Okay, now it's $2,000. $2,000. The demand for Chinese goods is drying up. That's it. Thank you.
Thank you. Anybody else have any additional questions? Okay. Yes.
Further answer to the question you were asking about health of the plan. And I think Burgess was answering from the portfolio management perspective. But when Patrick comes up, I want to make sure Patrick mentions, and we have it on the screen. There's a series of useful information. These are the spreadsheets that list foster and foster clients. So another way of measuring the health of the plan is your funded ratio, and there are various ways of slicing and dicing. But Patrick, I'm wondering if you can talk about, to answer that question about health, the funded ratio of 80, and this is a year old, so the number will have improved for reasons Patrick can describe. 88.4% funded, and Patrick can translate that for you. But the quick answer is, from my vantage point, that's a very healthy plan. And as a matter of fact, you're in the middle of the pack for reasons that Patrick can describe. So just make sure that you do get a chance to look at that very useful information. Thank you.
Thank you. Before we go on, do we have a motion to approve this report?
To approve the report is presented.
Second.
Second.
Motion is second. All in favor?
Aye.
Aye. Any opposition? Thank you. On to Foster and Foster report.
Well, for Burgess or for Adam's point, yeah, that's a list of all of our clients in Florida. and their funded ratio. And funded ratio, your goal is to be between 80 and 100%. And so you guys are at 88.4%. So you're very healthy in that regard. And, you know, the median is 88.2. So you're in the top half of our plans in Florida as far as funded ratio. And that looks at the assets in the plan compared to the accrued liabilities, the benefits everybody's earned, you know, the value of everybody's earned benefits. So that means you're in great, healthy shape. Did that answer that question?
Yes, thank you.
So then on the agenda, it says 185 ordinance. I don't know if you want to pull up that. There it is. You're fast. So this is the ordinance for the plan. And this has been in effect for at least 38 years. It basically says that the police officers get the same benefit as the general employees, which is right now a 2.5% benefit accrual rate. And they get an extra benefit based on the accumulated state monies, because the state monies are intended to provide additional benefits for the police officers over and above the general employees. But the good and bad part of this whole thing is that sentence in the middle of the page that says the redetermined percent shall be applied prospectively to retired members and beneficiaries of deceased retired members. So every year I look at the assets and the accumulation of state monies, and I determine how much of a multiplier can be funded with that. And sometimes it's good, sometimes it's bad. So in 2021, you guys had one of the best years you've ever had in the market. And so we were able to increase the multiplier. And then in 2022, Burgess mentioned you had the worst year you've ever probably had in this plan. So we had to reduce the multiplier. And so on, there's that one-page handout with the percentages at the bottom.
While they're trying to find out, are we still on 5-year smoothing or?
We're on a 5-year smoothing for developing the city's funding requirements. But this method of accumulating state monies and benefits, it was maybe it didn't make it into the agenda.
6A.
No. Well, I had done a handout shortly after the end of the fiscal year because the retirees' benefits went down. And so I provided like a one-page explanation of the history and basically said that every year we look at the accumulated state monies. And so we accumulate the state monies with interest. And we compare that to the accumulated benefits we've already paid. Because remember, we're paying the retirees that extra benefit. So we basically just do a long-term calculation of what's the rolling state monies that we've gotten with interest and compared that to the rolling benefits we've paid with interest. And so that difference then is what we can use to fund the future benefits. And so it's not as much heavily dependent on the actual amount of state monies we get each year. It's more dependent on how well we do on the investments. And so 10/1/2011, that extra multiplier above the 2.5 from the general employees was 0.54%. And then in the next year, it went to 0.59%. And the next year, 0.61. And it's bounced around. But in 2022, it went up to 0.65. So it went up because we had that great return. And then this year, it came down to 0.55. So the actual benefit to the police officers is almost exactly the same now as it was 10/1/2011. So it does fluctuate, but it's really remained fairly level overall. The problem is that this year was the one year it went down from 0.65 to 0.55. So the police officers that were retired really felt it in this particular year. And so in the fire plan, we talked about, ways we could possibly change it. And one way we could change it is that we could just lock in the multiplier when you retire. So if you retire at 3.1 multiplier and your benefit is $3,000 a month, then that benefit will remain fixed for the rest of your life. And then, what that means is that when we have these increases or decreases in the state monies, then we're going to have to adjust the active members. So future retirees. So they're going to have a little more volatility. Right now on their green sheet, it would say 3.05%. That's the multiplier right now. But it could change to 3.15 next year or 2.95. And then once they retire, it would be fixed. Whatever it was when they retired, that's what they would get. So that's one way we could continue to use the same method and just have a little less, no volatility for the retirees, but there'd be more volatility for the active police officers. That's one way that we talked about it. The other way is we could just fix the multiplier for everybody. If you pull up that ranking schedule of all of our clients and pull up the multiplier piece. But you guys are a rare exception where your multiplier fluctuates every year. Most all of our plans, the multiplier is fixed. So if you were at 3.1% benefit accrual rate, you would stay at 3.1% benefit accrual rate. So we could just fix that in stone. And really what that would do is then it would put a little more risk of investments on the city and not on the members. That's the way most of our plans work. But you guys have that ordinance that's been there since the 80s that says how we're going to do it. So you would have to negotiate with the city, the police officers in the city, negotiate and say, let's fix the multiplier and let's not do that exercise every year where we evaluate what the new multiplier would be. That's another way we could deal with the situation. So, next board meeting, you guys will get the new calculation because I'll do the 10/1/2023 evaluation and we'll see if that multiplier fluctuates at all. And so as a part of that, I'll do the regular calculation and then I'll do one where we just change active employees. And so you could see the effect that would have if we did that. And then we'll do one where the multiplier is fixed.
Oh, sure, I'm sorry. Yes.
So the fire department, I'm just trying to understand this, the fire department's at a 3.35 multiplier. And based on what we have here in this form, I know that it's changing this year to 3.05, but in this form it's at 3.15. For the fire department to be the multiplier that they're at, they negotiated that, I'm assuming through the fire.
No negotiations. They're the same as you. So we just look at the accumulated state monies. They probably just get more state monies. You know, that can happen where the fire department gets more than the police.
For the 185 is higher, or for the higher for the fire, right?
Yeah, the police got $85,000 in 2022. And the fire, I think, got around 70 maybe, but I think they have a smaller payroll. I don't know how much.
Retires.
There's a lot of different factors. And their multiplier, yours went from 3.15 to 3.05, correct? And theirs went from 3.35 to 3.15. So theirs went down 20 basis points, 0.2%, and yours went down 0.1%. So I mean, they're just two different plans that have a different effect. But there was a higher multiplier, but they had a bigger reduction this year than you guys did.
So for us to, I'm trying to make sure I understand this, right?
Yeah.
For us to, I guess, deal with changes in this ordinance, I know that the city commission has to approve those things, we can't deal with that. But it would be our police officers, I'm assuming, would have to negotiate that with our commission and with our city manager, because our group, not us in management, but our officers have unionized. So that would be something that they would need to bring forward in their union contracts, I'm assuming.
Yes. So these are excellent questions, and this is exactly why I want to talk about this with you. And there's a lot of heavy lifting if you want to make changes. And at the last meeting, the finance director was here, so we had a conversation with the finance director, and the firefighters have the same topic that you have. So this is a good discussion. So going back before I answer your question, that chart shows all across the state the multipliers, and the multiplier is how the benefit gets calculated. So for fire, you can see fire was a higher number, and it had to go down 20 basis points. So fire was 3.35, and fire this year is going down from 3.35 to 3.15.
Mhm.
You know, for you, the chart lists you at, for Palatka Police at 3.15, and you're going down this year to 3.05. And the reason we're having this conversation is I know on the fire side, there were some people calling up and saying, wait a second, why is my monthly benefit going down? And we want to make sure the trustees understand why. And then your question is going to be what to do about it. And that's where I can come in. So the answer is there are going to be several options that the firefighters ask the actuary to look at. And you may want to look at those same options for your next meeting. So I always like to say that one option is to do nothing. And I've got good news for you. So we'll talk about various options. And I don't want you leaving today until we all understand the various options. But the first option is do nothing, because that is always an option. And here I have a little bit of good news. So the first bit of good news is that the markets, and this isn't me, this is the markets have recovered. So in a way, things tend to correct themselves, right? The other thing is, part of this is your premium tax money. So the number that Patrick gave you was the money that came in last year. It was $85,727. $85,727, your money from Tallahassee. Well, we just got the check over in August, September, and the money increased to $99,810. So you had about a 14% increase. So you got more state money, good news, and your investments returned nicely. So that's gonna result in an increase. We don't know what it's gonna be yet, but you know, it's gonna be heading in this direction, not that way. So one option is just to see where the numbers come out, and maybe you don't want to change anything. So that's always an option. What's the second option that Patrick was talking about? And I don't like to use the word fix. And the reason I don't like to use the word fix is because fix assumes that there's something broken. And the way your ordinance works is that it's going to fluctuate based on good performance and good money from Tallahassee. You get to increase that multiplier based upon bad performance and bad state money going down, then the multiplier has to go down. So there's nothing broken that needs to be fixed, but you could change it. So the word I would use instead is, instead of fixing it, to lock it. In other words, lock in the multiplier. And that's what would require, now finally getting to your question, we could amend the ordinance. What is the process to amend the ordinance? Instead of having this variable multiplier, which can change every couple of years. And the one page that we didn't have that Patrick was mentioning showed the history of how it's moved around over the last 2 decades. So if we wanted to lock it down, and I'm happy to have this conversation with the finance director, with the city attorney, and et cetera, is it would require an ordinance. And before that ordinance goes forward, it does have to be either union and the city negotiated, or the parties waive bargaining. And if they waive bargaining, it does not have to be negotiated. And the big question that was coming from finance is, what's it gonna cost if we wanna lock in the multiplier, so the multiplier wouldn't fluctuate? And the answer is, it's the state money that pays for this. So you could lock it in without any, let me say that again, and it's really for Patrick. You could lock down the multiplier without any city cost, because we're using the state money, but that would result in potential fluctuation in the city contributions. So if you lock down the multiplier in good years, and these are the questions to talk about with Patrick. If you lock down the multiplier and you held it in place, you fixed it in place, in bad years, and remember that's why we do smoothing, so that would minimize some of the fluctuation. But in back-to-back bad years, the city contribution might have to go up a little bit. And in very good years, or better than average years, the city contribution would come down. Because that's what's happening now, is the retiree has to bear the volatility in the multiplier. But we could lock it down, and again, ask Patrick those questions. What would it cost? And I think he's gonna tell you it's not gonna cost you anything. Meaning you're not gonna increase the city contribution, but that volatility will come into play in the city contribution rather than the retiree multiplier. Does that make sense? And then if you do decide that you wanna lock in the multiplier, there are other questions about how you wanna go about doing it. And that's the scenarios that we talked about with the firefighters.
Yeah, I mean, the two basic scenarios are, do you just lock in retirees, or do you lock in both retirees and the active police officers? I'll show you both of those scenarios when I come in February. And as far as, you know, I think the city understood the ramifications, but in your example, you know, let's say we lock in the multiplier at 3.05. Then if state monies go down to $10,000 a year, you know, your benefit is still the 3.05 multiplier. So now there's less money coming in for the city to use. So that would increase the city's funding requirements. So again, but it could happen the opposite. Your state monies could go way up like they did last year, and then the city's costs would come down. So it just puts more of the risk on the city. But the risk being on the city is the norm. You know, as these guys can attest, Burgess and Adam go to a lot of meetings. And this is one of the first times they've had this discussion about benefits for retirees going up and down. It just doesn't happen. So, you know, the risk that the city is bearing would be the same risk that, I almost said Jacksonville, that's a bad example, but, you know, any other city around here is dealing with.
So to understand your norm is for it to be locked in, not to be a variable.
Correct. I mean, you guys are kind of, in a sense, you're ahead of the game. You know, you're doing really what the intention was. Take this state money and use it to give an extra benefit to the police officers. So what you're doing, like Adam said, isn't broken. It's actually kind of a novel idea, but it's certainly not the norm.
Before we discuss like a rate for a set to lock, can we get like the last 10 or 15 years of those rates?
Yeah.
Percentage was?
Yep. I'll send you that sheet that I was talking about.
Pretty consistent at 3.1 or 3.15.
Yeah, so 10/1/2011. So that was 12 years ago. It was 0.54, so that would have been 3.04. And then it went to 3.09, 10/1/12. And then it went to 3.11, 10/1/13. Then 3.16, 10/1/14. stayed there for 2 years, and then it went down to 3.13, 10/1/16. And then it went down again to 3.10, 10/1/17. And then it went up to 3.15 in 2022. So there's a 5-year where nothing changed. And then this year it went down to 3.05. So like you said, the whole range has been anywhere from 3.04 to 3.15. So there hasn't, or 3.16. So there hasn't been a huge fluctuation, but it has had dips and increases.
Yeah.
So I want to make 2 points. One point is, this is the sunshine law now. So trustees can't talk about it with each other, but you could always call the administrator. Trustees could always call Patrick. You could always speak to our office. We're happy to talk to you. And, you know, your chair or police officer could speak to firefighters. You just can't speak to one another. So that's one observation. Second observation is, there are a range of options and there's no right answer because it's what you want to do and what you're comfortable with. And there's nothing broken that needs to be fixed, but you can take away that variation from year to year. And that's why I said earlier that, you know, you may just, it hasn't changed dramatically. Maybe you'll leave it alone and wait for it to come back, but you'll know better in February. So what are some of these other options, which we haven't yet talked about? So I'm wondering if you want to tee up the idea of a share plan, just to introduce that concept, which is what we see most commonly around the state of Florida, is a funded share plan, which again, doesn't cost the city money, because we're talking about how to use the money from Tallahassee. So if you wanted to tee up, and this is a subject, if the fire chair were here, you know, we had a very detailed conversation with the fire chair, which we're happy to do, to understand these nuances, if you want to do a version of a share plan. So, you know, Patrick.
Well, and you know how I said you guys are almost ahead of schedule. So, you know, for the past 20 years, as long as Adam and Burgess and I have been doing this, a lot of cities and say police officer unions have argued that, well, the city isn't using that state money to provide additional benefits for the police officers, you know, because they haven't changed those multipliers. Even if state money went up, the city didn't change the multipliers. So there was lots of arguments over the years. So a few years ago, the state said, all right, you know, we're tired of you guys arguing. And if you guys can agree on how to use state monies, the union and the city, then we're fine. That's called a mutual consent agreement. And you guys have signed a mutual consent agreement right now to keep it the way we've always done it. But you could change that mutual consent agreement. But in the absence of a mutual consent agreement, they basically drew a line in the sand of the 2013 monies. And so if you were getting $100,000 a year in 2013, they said, okay, every year now the city can use that 100,000 to offset their funding. But anything that comes in over 100,000 gets shared between the city and the police officers. And that's where the share plan idea comes from. And so what it is that let's say you get 150,000 the next year. Well, then the city can use 125,000, the 100,000 frozen amount, plus half of the difference. So they could use 125,000 to offset their funding. The other 25 would go into a share plan for the police officers. And then that basically is like a defined contribution. That money just goes, it gets allocated to you. Let's say someone gets $500 this year, you know, one officer gets $500. And then usually that money stays invested with the plan. So you might get an earning, you might grow to $510 the next year. And then the next year you're going to get more state monies. You might get another $500 allocation. So now you've got $1,030. And then it just accumulates. And then when you retire, you get a lump sum, kind of like a drop balance. You just get one lump sum. If it's $80,000 in your share plan by the time you retire, that's what you get as a lump sum. So the multiplier would stay fixed at the 3.05, let's say, and that benefit would stay the same. The city would know that they can use say $100,000 a year in state monies. And then anything that comes in over that would get shared. And that's essentially what a share plan is. And that's what most of our other plans have, because they've argued and they can't come to an agreement, and they just use this default share plan approach.
So, Patrick, how do they track their individual share balance?
Well, once a year, we reconcile the whole thing, the actuary. And so now you guys get those green sheets that show you your defined benefit. You'll also get a white sheet that says, here was my balance at the beginning of the year. Here's my balance at the end of the year. And it would show your vesting. Usually they apply the same vesting schedule as the pension plan. So if you have 10-year vesting, you would have 10-year vesting on the share plan. And then let's say you leave at 8 years and you had an $80,000 balance in there. We just, that's called a forfeiture, and we reallocate it to all the other members. So it's a zero-sum game for the city. All that money goes in there and it gets invested and paid out to the retirees when they retire. But there's no risk to the city for it. It's just shared among you guys. That's one nice thing about it. You're going to give them the risk on the fixed defined benefit, but you would relieve them of any risk on those excess state monies.
What happens if you enter the drop? What happens to the balance?
Well, for share plan purposes, you're actually an active employee. You're an active police officer. So if the active police officers get a $500 credit that year, you would get a $500 credit that year. It's really kind of dumb because we, as the actuary in the pension plan, someone goes into the drop, we treat them as retired. But when the state set up these share plans many years ago, we asked them and they're like, no, drop members are active employees, so they're treated like active employees. So that's the way it works in the drop.
Trustees, we're throwing out a lot of information, so I want to just re-summarize some of what we've put on the table. We're not making recommendations because this is thing that labor and management have to decide what they want to do. And the board, by the way, can make recommendations and serve as a constructive part of those conversations. So we're not telling you what to do, obviously, but we want to have you understand what the options are and to ask the good questions. So as I said, the first option is do nothing, wait to see what happens in February, and maybe if it ain't broke, leave it alone. But if you do want to take away this volatility where the multiplier potentially changes every couple of years, if you want to lock it in place, there are ways to do that. And you have to understand how you would want to go about doing it, advantages and disadvantages. And you have the opportunity, and just to put numbers on it, the money that came in this year from Tallahassee was $99,810. So the share plan would only apply to growth of the money over the $99,000, because we're going to use that $99,000 to figure out what the multiplier is going to look like next year, and maybe it's going to go up from 3.05 to 3.10, or maybe it's going to go back to 3.15. I don't know, right? So what we'll know based upon the market, and we'll know based upon the $99,800, where it's going to land for the coming year. So we can leave it alone. But if you decide that you want to lock it in place, you have to decide what do you want to do with the growth of the money. So one easy solution, and Patrick used the word default. That's what the legislature came up with. They said if the parties can't figure it out, if labor management can't figure it out, you use a Solomonic, you split the baby, 50-50, the city gets half the money and the members get half the money, and the member money goes into the share plan. The share plan is basically a 401k, the defined contribution balance. And when you leave, if you're here for 10 years or 15 years, every year, money is going into your little account. And when you leave, you get a lump sum of the share money. So we've seen that's become very popular the last couple of years. And there are various ways of dividing up the shares, which at some point, Patrick will also want to talk to you about share distribution formulas.
Yeah, essentially there's really only two that people use. Well, three, I guess. But one is everybody that's actively employed gets an equal share. So if you got $25,000 in there and you have 25 police officers, everybody gets $1,000. Or you could say, base it on credited service. We like to reward credited service in this plan. So someone who has 20 years of service would get 20 shares, and someone who has 1 year of service would get 1 share. So that way you still take the 25,000 and divvy it up, but the person with 20 years of service gets a much bigger amount than somebody with 1 year of service. And then, as Adam said earlier in the other meeting, you could give some of it to the retirees, which would kind of go along with what you're doing now, where market does well, we actually increase the benefits for the retirees. So you could incorporate sharing some of that money with the retirees if you wanted to.
And all active police officers who vest become retirees. So that's the reason to share the wealth, if you will, with the retirees. If you wanted to lock it in place and wherever it's going to land, 3.1 or 3.15, and then what do you do with the growth of the money in the future? So that's the share plan option.
So if we opted with the vesting option, does that go from the employee's date of hire, since this is something just starting? We have a lot of people that will be leaving in the next 3 years that are vested by our department.
Oh yeah, you would get credit back to date of employment for purposes of vesting in the share plan.
But it's a big decision that if you do want to do a share plan, as Patrick was describing, you have to have a share plan methodology. And the two most common is everybody gets equal shares, which means a young guy or gal gets the same share amount. And it's going to start very small. It's the future growth of money. So it'll start very small. So it's not going to be a material difference. But if you do it based upon years of service, a 20-year guy gets a 20-time allocation compared to a 1-year officer. But eventually that 1-year officer is going to be a 20-year officer. So what it does is it encourages people to stay longer. If you allocate based, it encourages longevity.
But if they're not vested and they leave, they would not get any of that money. They would just get what their investment was into the retirement plan like they currently do.
Correct.
Share.
But they would still get their own contributions back.
Right.
Correct.
They're forfeiting that.
Sure. Without
Exactly.
city's contribution, if they were not vested.
Well, and this money is for the share plan is really state monies. So they wouldn't get any of those state monies back. Just like they don't get the city's monies back when they leave.
Yeah. Any additional questions on that?
One last question, and that's that in February, you're gonna present something that would show us some basic numbers on stuff.
Right. I mean, I would, once a year I come and do the valuation report and show the city's funding. And as part of that, we always do this analysis of what is the multiplier going to be for the next year. We always do it ahead. And so I hope that I warned you guys when I came last February that the multiplier was going to change on 10/1. There's question of, I guess, if I really made that clear, but in February, when I come, I'll tell you if the multiplier is changing starting 10/1/2024. And so as a part of that, I'll also run a few other scenarios now that we're talking about maybe changing the way we're doing it. So I would show you, what it would be if we had locked in the prior retirees and only adjust the active employees. So that then if it's going to go from 3.05 to 3.1, that might actually go from 3.05 to 3.15 because we're sharing it only with the active employees, not the retirees. So the actives are going to have more volatility on the upside or the downside. So this past year, the retirees would have stayed, and then the active members would have a bigger reduction. So I'll show you that to see what a normal year would look like if we went to that other scenario. And then I'll show you what it would look like with the share plan.
How would that be paid out to retirees though, if they did the share plan, including that? Would they get an annual payout?
Yeah, just a one-time, once a year. See, you guys are getting it into your account and you can't get paid while you're still working here. But the retiree could get paid immediately. That $500 allocation or whatever it is, they could just get that paid immediately.
But if they got that paid, I'm just asking some silly. If they get paid that immediately, but the next year there's a loss, does that affect them at all?
Well, really, the share plan has two issues. So does the current one, but one is you get an allocation each year based on the state money that comes in. So let's say that $100,000 is the frozen amount, and that one year we got 150. Well, if the next year we got 100, nobody would get any allocation. And so the retiree would get no money. But the active members would still be earning money on their balances that are in there. So that's the difference between the retirees and the,
Came at less than 100, then that would be the city's burden and the active members' burden.
exactly.
I think it's useful to understand why the conversation is taking place. So on the fire side, which had a bigger reduction, they went from 335 to 315. It went down 20 basis points. That was a modest increase, a modest decrease. So there was at least one retiree that his monthly benefit went down by $400 a month, which is impactful. So if you were to lock in the multiplier, you won't have that fluctuation in the monthly benefit you get as a retiree. Right? But if you lock it down, you're not going to get the upside, or the multiplier might creep up from, the highest it's been for police is 315, if I'm not mistaken.
Or 16, yeah.
I'm sorry?
16, 316.
316, but over time, maybe it'll keep creeping up, 317, 318. But if you lock it down, what do you do with that extra money? That's where the share plan comes in.
Yeah.
So there are lots of moving pieces. We want to make sure you understand it. There are no right answers. You'll get all kinds of scenarios from Patrick. Do not discuss it with each other, but you can talk about it with the city attorney, with labor council, union council, et cetera, et cetera. And we're always happy to play a constructive role. And the last thing I want to emphasize is that, that retiree who was asking about that $400 decrease, there was nothing improper or incorrect or broken. That was the way that the plan was originally designed. And if we want to change it, which we don't have to do, if we want to change it, we have to understand the advantages, pros and cons, but nothing was done improperly is my big takeaway.
But you could still do a program where we locked it in. If they were able to negotiate it with the city, they could still do a lock-in and then do the share thing.
Correct.
Or just let the city do what they needed to do with that.
Yeah, you guys can negotiate however you want. If some plans, some plans say, okay, we've got a nice 3.1 multiplier and we're happy with that. And the city can use all the state monies that come in each year, as long as they don't touch our benefits, So some places have negotiated that. So it just depends on, you guys can negotiate however you want. It's very flexible.
Does the pension fund have total autonomy over the 185 money?
No.
Okay, so therefore it has to be negotiated with the city as well, right? So one of the things that I would suggest, first of all, is to bring back several scenarios, what it looks like to be locked in and that type of thing. So, but also like to see what it looks like to do nothing. But I think it's an opportunity as well for you guys to have that conversation with the current retirees and see what the fluctuation has been like over the years and how has it affected them economically, and gather that information as well. But I think the city commission also need to know that we're actually looking at this 185 monies and that kind of thing, and looking at maybe doing something different with it as well, so that if we decided to do anything, I don't want to be caught where nobody said anything to us. We got to, do a study and another study and another study before making a decision.
Well, one thing to note on all that is that, the benefits just changed October 1st. And then there would be normally scheduled to possibly change October 1st, 2024. So, if we have a good discussion at the February meeting, that's still over 6 months before, so that we could talk to the city commission and you guys could worry about negotiating it we've got some time
Mhm.
for that
But
process.
I agree with Mr. Norwood that we need to provide that information in as brief but succinct way as possible, so everybody that's going to be involved has an understanding of the impact to each group, whether it's the city, the retirees, or the current employees.
And the interim city manager and the finance director were here during this whole discussion
Okay,
in
with the
the
fire. Okay.
fire pension
Okay.
meeting.
That's helpful too.
And that was another takeaway from the last meeting, as we said, let's invite to the next meeting, the February meeting, where
Mhm.
the data will be available.
Mhm.
If labor wants to be there, or union president, for example, the HR director, finance, so that way people will get
Mhm.
informed. And that was the key word leaving the fire discussion, was we want informed decision-making. And the other point was, although you can't talk to each other because it's the sunshine law, we wanted to make Patrick available, that if the finance director has questions for Patrick, that way they're not getting dropped, you know, the report falls on the day of the meeting and no one's had a chance to look at it. So to make Patrick accessible, likewise, our office is always happy to answer questions.
And I would also suggest, Madam Chair, too, is that we invite the city commission to this meeting, rather than make the city commission meeting with this presentation that you may have to do at some point.
That seems
Make the meeting longer, make this meeting longer rather than the city commission meeting.
I'm all for that. Sounds good. I'm with you.
Well, and I think all they have to do is notice it as a commission meeting also, right? So that they can
Right.
have more than one person there and talk
Oh,
about it.
excellent.
No, so, yeah, the public notice, yes.
We can share the last observation, then I'll be quiet. Optics is important so people understand. There's nothing broken that needs to be fixed.
Mhm,
These are
yeah.
options.
And again, as long as that's clarified or explained to every group that gets this presentation, I think that would be helpful.
Well, thank you. I'll stick around and as Adam said, I mean, please feel free to call me directly if you got any questions about this.
Thank you. Do you have a motion to accept the report? Okay. Okay, motion and second, all in favor? Aye. Any opposition? Thank you. And so now we're on to Mr. Levinson.
Trustees, I'm gonna give you a 1-minute attorney's report. Everything is good. I've got other plans where there are fighting and lawsuits, but things are nice and quiet.
Wait, before we go to.
It's not counting the intro.
Before we go to the attorney's report.
Yes.
Wasn't that supposed to be some information that we were supposed to discuss around COLAs as well? From the last meeting?
Yeah, so what Jill did there, she put it in your packets,
Right.
is really, you know, COLAs are very wide open. You know, some plans have a 3% automatic every year COLA for life. And some plans have a 0.2% COLA that goes for 5 years. And some plans just do a one-time COLA. So there's lots of different scenarios that you could pick. But Jill just wanted to show you, this is a study we did quite a while ago for the general employees, but it shows how it would affect a particular, you know, retirees. So basically, if you guys are interested in it, you know, I could do a study of, you know, if you say you want to spend 1% of salary or something, I could develop a COLA with that. Or if you wanted to say we want to do a 1% automatic COLA, I could tell you what that would cost in contributions. But there's really a wide variety of options for a COLA. But this is just one possible scenario there.
The city's overall budget.
Oh, yes, absolutely.
Correct.
Yeah.
Not the retirement.
I know you guys are concerned about COLAs and we wanted to know some actual numbers, because you get some questions from retirees and all. So I want to make sure, I guess my intent from bringing it up, even though it is on the agenda item, is to make sure that we get you guys whatever information you need to go back and have those conversations, whether it would be information that was sent out around COLA, was that enough information for you guys? Okay.
Well, are you talking a one-time increase or a every year increase?
I think a lot of the phone calls, after guess a lot of the phone calls that were received, at least I know for me and possibly for Jill, were based around the changes that occurred to the actuary, and how some of the retirees' checks had gone up. They saw an increase. I believe that was because of the actuary, not because of the COLA. Correct me if I'm wrong, Jill.
Right, that was this issue.
Yes. Then now it's gone down. They started seeing it. And, because most of the guys that are retired were at the PD when I was much younger. And they know that I sit on the board now. They started calling me. I believe they started calling Jill, and I was just looking for answers because I was like, I don't know. They didn't split that real well.
Well, what I can do if you want is, it sounds like it's more like a one-time increase to help because they reduced, right? So that sounds like more the predicate of the question. So I could do a study for your next meeting that says, what was it cost to increase everybody by 5%? And then that way, all the current retirees, not future, just the current ones, a flat 5%. And that would tell you, oh, if the city's costs are going to go up by $10,000 a year because of a 5%, it would go up $2,000 a year if they do a 1%. I'll give you just one study of a flat increase for the retirees. That would give you information, that would be helpful in case you wanted to, if the city was considering possibly doing an increase. A permanent increase every year is very expensive, like what's on there. But a one-time increase, bring them back up to the 3.15 or something, that's a lot less expensive.
Patrick, what's the cost? What's the estimated cost of the study?
Well, I'll do it as an impact statement. Well, our minimum cost is $1,500. That's what I'll charge.
$1,500 blue study?
I was about to ask, we need to make a motion for that, Brett.
Yeah, yes, we would.
You're going to have all those other options on the table too,
That's
that
what I
might
was thinking before
satisfy
we-
the,
Yeah, that we need to,
That would be in February. right?
yes.
yeah.
Maybe we
So
can
we should wait on this because locking the multiply would eliminate that variation for folks and that concern about a COLA.
There's no motion.
Thank you. Mr. Levinson.
Trustees, again, I promised you a 1-minute attorney's report, and I do want to talk about another issue that we'll deal with Jill at the bottom of the agenda. But Anna from our office says hello, and a happy new year to everybody, happy holidays. So what is the attorney's report? If you go to 7C, you'll see, and we talked about this at prior meetings with Burgess and with Anna, the Florida legislature adopted House Bill 3. And the key word from House Bill 3 was pecuniary. And you remember we amended our investment policy to say that we only invest like a laser based upon pecuniary considerations. That's making money risk-adjusted return. We do not invest based on politics or ideology or other social factors. We're focused on making money and doing it prudently. So we had to amend our investment policy, and I want to thank Jill, because what she did is she signed into this new website that Tallahassee created, the Division of Retirement, and she registered, and they just went live, I think it was yesterday, with the portal, so we can now load our new, and if you look at 7C, this is what I call the template. So we're going to take this template and Jill put our name at the top, and we're going to attach that to the investment policy that you worked on with Burgess. You're going to load that into the Division of Retirement's website, and we are done. We will have complied with the requirements. So we're taken care of, checked all the boxes. Are there any questions about House Bill 3?
No. Any questions? No. Okay.
Well, Steve, that concludes the attorney's report, but I do want to talk with you about options. And do you want to do that now, or do you want to wait till number 9?
Well, let's stay with the agenda and go with quarterly expenditures.
So these are the quarterly expenditures, but they also include the whole year because this was fiscal year end for the pension. nothing unusual. You can see budget versus actuals over on the right-hand side, for total investment, for total admin costs. But I need a motion to accept them.
Do we have a motion to accept the report as presented?
A motion to accept the report is provided.
Second? All in favor?
Aye.
Aye. Any opposition? Thank you. Okay, Mr. Levinson, on to the change of removing the full-time pension administration.
Right, that was originally at our last meeting, the budget went through to the commission with the pension administrator as starting in January. Since then, the budget has changed. The commission changed its mind, removed a lot of items, of which one of them was the pension administrator. They were going to pay 25%. Each of the pensions were going to make up the other 75%. And that increased, at the last meeting, increased the budget for the pension administrator over another $7,000. It has now, the new budget is back down to the $7,000 for the pension administrator, since they're not going to be hiring anybody. But I will be leaving in next October, and one of the discussion items for the fire pension was discussing an RFP to go out to explore the option of having a third-party administrator.
What was the discussion with the general employees?
That's going to happen at 3:30.
Oh.
Okay.
Question, and I thought I heard this, during the training, something about this, or they had decided, I just never heard it. Would there have to be multiple RFPs, because each pension board would have to do its own RFPs? We couldn't all agree on,
One, essentially.
one general RFP to go out, and then we discuss it all together.
So these are excellent questions. So let me back up a little bit. And the first thing I want to point out is that there are various ways of doing plan administration, and we've got big shoes to fill with Jill. So what you don't want to see happen is that Jill is not here tomorrow, and then the city has to, train someone to fill that job. If it's going to be a city employee, usually from HR or finance, to be trained as administrator, they should start training that person over the next year, between now and October when you leave. But that's one option. And increasingly what we're seeing, especially with bigger cities, is just hire an outside third-party administrator. That's what TPA stands for, third-party administrator. And I can tell you that the fire board sent an RFP or authorized the sending of an RFP. We do these all the time. And you'll get, for fire, in the neighborhood of, I'm going to guess 8 or so respondents will come down. And the question is, if you do want to, decide to hire a third-party administrator, as opposed to using someone from finance or HR, who would be a part-time city employee, if you do want to do a third-party administrator, then that's a lot of people to interview. If you wanted to bring in 8 firms, if they all respond, but I think usually it's 3 to 5. The sweet spot to do interviews, 3 to 5. But it's an important decision, because that administrator, is working with the plan. That's a very important job to make sure we get our money from Tallahassee every year. So I do recommend that if you do the RFP, follow with fire, you could meet together with the fire board, and that's the savings. You don't have to do it with fire, but if all 3 boards send out the RFP at the same time, that allows the respondents to say that if all 3 boards hire the same administrator, that you're all going to save money because of the efficiencies and economies of scale. And I'll also point out that you'll be doing a favor to finance, because they won't have to work with 3 different administrators. So it makes sense for the boards to team up, if you will.
Absolutely.
For sending out the RFP at the same time and meeting to screen it down to 3 or 4, and then to decide who to hire. But each board has the autonomy to hire whoever they want. And with regard to the cost, so these are reasonable, appropriate expenses for pension. So the city wouldn't have to allocate from the city commission, this is what we want to pay. It would be the board would pay, and that becomes part of the city cost, the normal cost for the year. So at the end of the day, the city does pay, right? But it's not a separate city budget item. It's the cost of operating the plan, just as it is for the attorney or for the actuary. Everybody understand?
That's a question. You represent not only your firm represents not only the police pension, but the general pension and the fire pension, correct?
Yes, sir.
As do all of our investors. Everybody here works for all three investments?
No,
No, we don't work for the general.
No?
and neither does, Dwayne.
Okay. Just trying to wrap my mind around how we would.
Come together on,
Yes,
so
together on.
so to speak.
You may not, and it's not gonna be a dramatic savings, but I anticipate there will be savings, particularly if the boards keep meeting on the same day. And I like to use the expression advantages and disadvantages. The advantage of the way we have it set up now is Jill is accessible to retirees, she's accessible to the city, everybody knows her. If you bring in a third-party administrator, you're not gonna get regular office hours, maybe they come in, and then these are the questions that you would ask them. They hold office hours before the board meeting, they can meet with people after board meetings, but they're gonna be located elsewhere in the state where their main office is. So they're gonna have advantages, various tools, and then some of them are big companies with sophistication. But one of the drawbacks is that, and it's not necessarily a bad drawback, you're not gonna get that same face-to-face interaction that you do with the way we currently have it designed.
Okay, one more question. If we do the RFP, like fire's wanting to do, and I'm hoping general will want to do it as well. Is there a way for all three boards, or did you already say this, that all three boards can come together to do these interviews at the same time? Or is that a sunshine violation?
Not if it's publicly noticed, we can do that.
Now, one more question is, who would be doing the RFP?
So for fire, our office does these all the time, for actuaries, for various other folks who work with boards. So I would take, I did one last week for Miami Beach.
Yep.
So I would take off the shelf an RFP and I'll send it out to the cast of characters, the big administrators. And the city, by the way, if the city attorney or the clerk's office, different cities do it differently. Some cities use third-party services to advertise. So however, the city may or may not want to advertise it, but I will send it to all the administrators who do work in Florida. I will get it to all the administrators. And then you're right, functionally, as just the infrastructure of how you want to do it, I agree, it makes sense for all boards to, and that's, it doesn't have to be done overnight, we have till October, but I think it's at least two decisions. The first decision is either together or separately, decide who you want to interview, bring down the list, and either separately or together, do the interviews.
What's the cost associated with doing something?
We don't. So.
I mean, the RFP.
So the RFP is basically done. All I have to do is put your name on it, and I have to put the number of employees and the number of, there's some description. So that'll take either me or Anna, I don't know, an hour or so, and then I send it out with emails, and I'll CC Jill. So to do the RFP is an hour or so of attorney work. But then if you want us to attend those meetings, and you do a special board meeting, right? Or maybe you do it at the regular meetings. So I don't know that there's really any major cost if you do it during the regular meetings, but some boards decide to do a special meeting.
I have to make a motion or have discussion, I guess I should say, about this, because if we can go to the third party, I would like to see us looking at doing it, because it's just like we discussed before when we were going to do this position. We as a city have a habit of doing more with less. And that becomes very burdensome. It's been burdensome for Jill. And if we put it off on the next person who replaces Jill, like he said, she's got big shoes to fill. Jill's on top of things. And if there's firms out there that this is what they do, then I think it's something we should at least RFP and see what the costs are associated.
Well, I definitely think it's worth exploring, and I think, again, Jill would still have plenty to do, and her successor will have plenty to do without this responsibility. We're obviously not heavily staffed in the finance department, so certainly we need all the resources we can get.
Absolutely.
I just think we just need to understand the cost both ways.
Well, I agree. So with that said, is there a motion to move forward with the RFP process and course around, to have a better understanding of us. What is the motion that anybody wants to make at this point regarding the RFP?
Jill, what was the motion made by fire so that we're in line?
They authorized to have the attorney make an RFP and send it out.
And
Just because it's not, an RFP is not binding. until
Right,
you make
it's just a
decision.
request for proposals, yes.
Well, what I would move then that we, I guess what I would move then that we do is join the fire pension board and their request for an RFP.
I would second.
We have a motion and a second. All in favor?
Aye.
Aye. Any opposition? Okay, thank you.
Let's see if I could share one other quick bit of information
Sure.
that I shared with fire. There are these big third-party administrators in Florida. One of them happens to be Foster and Foster. And Patrick isn't here to sell anything. It's not my job to sell anything, but I want to let you know that one of the ones we'll send it to is Foster and Foster. So in addition to being an actuary, they also have an administrative arm.
But it's a different arm. It would not be Patrick, obviously. It's a
Correct,
different
correct.
branch of the
So-
company. Right, no, I know. I just wanted to make that clear, though. I think. that
So
was
advantages
clear.
and disadvantages. An advantage of using them, I think, is that they're going to be very cost competitive because they are your actuary. But I want you to be able to compare when you shop around. That's what you do, is you make
Mhm.
comparisons, apples to apples.
Mhm.
So what do you lose if you use Foster and Foster's administrative services arm? And, you know, again, there's no right answer. So if they do turn out to be the least expensive, you're losing a separate set of eyes by a separate company, because it's the same company that would be your administrator and your actuary, but still under the contract, they're fiduciaries, and it's not a problem, but just be aware that some might prefer to have an independent administrator as opposed to administrator. And there's, you know, if you went across the state, you would see that a good number of plans use Foster and Foster both as administrator and actuary. So these are the sorts of things that you'll discuss when you make a
consider.
decision.
Okay.
I just want to make sure that we do understand it's not just based on cost, it's also based on services provided.
Mhm.
Yeah.
Absolutely. Okay, thank you. Any further discussion on this item? Going to open the floor to public comments. Anybody here for public comments?
I can do public comment.
Okay.
Because I remembered that the general employees did a more recent study for a cost of living adjustment. And they looked at doing a one-time 5% increase for all the retirees. And that cost the city 2.9% of payroll. So just so you guys remember, I said I could do that study for you. I mean, you have different retirees than they do, but that just gives you an idea of the impact.
Thank you. Is anybody else here for public comment? Seeing none, using public comment. Any other business?
I do have business and meeting dates, and they've been noticed in the newspaper. There is one change to our normal business meetings. It's in June, when there's a conflict with this room. So the police pension board meeting in June would be meeting at 11:30. That's June 4th. But I'll be, the next
out.
meeting in February is normal time.
Okay.
Can we make sure that that's on the agenda as a change in meeting times and dates?
Yep.
Okay.
Any other business besides the meeting dates? Okay. Do we have a motion to adjourn? Okay. Thank you all.
Thanks, everybody. Happy holidays.
Happy holidays.
Been a long day, hasn't it? Thank you, guys.
Nice to see you.
Yeah, it was nice to see you. Thank you.
No problem. Have a good day.
Thank you too.
Have a good night.
You
You too. Looking good.
It has nothing to do with you.
No,
That part that's been sort of held up.
Burgess?
Yes, sir.
Jay, have a good holiday.
Hey, nice to meet you. That's all.
I'm not tall.
honestly,
No, I'm fine. I can squeeze through. But I'm not tall.
Happy holiday.
Happy holidays.
I remember you were looking at. Did you look just at?
but you know what, probably.
I remember that discussion. I think it's like.
Very small.
Sure, sure.
They pay the newer stuff.
And-
It's on your. Oh, yeah.
Sure.
The other two. Solution.
You need some help? You going around here? You got-
Retirees more comfortable.
Yeah.
Have a nice holiday.
Right. Well, and inflation, not so much right now, but it has been high, so.
And once, it's supported on what the tax bill is. Yeah, that's on the agenda today for COLAs. It's on the agenda for COLAs. It'll be discussed. Yes, that's why it's on the agenda. The COLA for retirees. Yeah, that's one of Patrick's, what he's gonna talk about.
Wanted to introduce myself. I met these two guys.
You'll see Joe.
Total number 5. Yes. I have to look that up. I believe it's at large. Because your position is, Yes, we have a quorum. And we are all mic'd. We're live.
Ready to go then? All right, we'll call the General Employees Retirement Plan Pension Board meeting to order. First order of business, roll call.
Jonathan Griffith,
Present.
Tammy McCaskill, Alan Bush,
Here.
Brett Dennis.
Here.
We have a quorum.
Thank you. Has everybody had a chance to review the minutes from the last meeting, August 29th? If so, is there a motion to accept?
Motion to accept.
Is there a second? Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Passes unanimously. Item number 3, Foster and Foster report.
Well, good morning, good afternoon.
Good morning.
Not really morning. It's been a long time.
I know.
Discussion of COLAs. You guys have had periodic discussion with how the effect on inflation,
Yes.
you know, and the retirees benefits are. But we did actually do a study 2 years ago. And we looked at if we did a 5% increase for all the retirees, just a one-time increase. I mean, it would stay that way, but they wouldn't get every year increase. That was going to cost the city about $110,000 a year, or 2.9% of payroll. And then we also looked at giving everybody 1% for each year they're retired. So if they've been retired 10 years, they would get a 10% increase. If they were retired 2 years, they would get a 2% increase. And that one was about $170,000 a year, or 4.5% of payroll. So really, I think we just were keeping that discussion going today. If you guys have any questions or discussion.
I guess I have a question. That money, does it come out of the fund, or you said it comes out of the city? The city would pay that amount, not out of the fund.
Well, it would come out of the fund, you know, every month the retirees' payments come out of the trust fund.
Right.
But you know, when we do the evaluation, which we'll be doing in February.
Yep.
We look at the assets and we develop the liabilities, project everybody's future benefits. And we use that to determine the funding requirement for the city for the next year. And so if we give everybody an increase, well, now their liabilities are higher, their projected benefits are higher. So it increases the city's funding requirement.
So it comes out of the fund, but it's gotta be replenished.
Correct.
Okay.
But they don't replenish it immediately. We spread it out over time when we do a benefit change like that.
Well, but I thought I heard that it would cost the city $175,000 a year. They'd have to put that into the fund each year, starting the first year we approve that. Is that right?
Correct. Because, if you look at let me look at your retirees. You're paying them about 1.8 million, about $2 million a year right now.
Yeah.
So if you give them a 5% increase, that's $100,000 a year.
Well, it's a serious issue. I know that Jonathan knows that I've looked back at this just for the last 5 years. And the Department of Labor and Statistics says that the cumulative effect of inflation is about 23% over that shorter period of time. So it's a definite concern for folks who are on a fixed income. I get that. Someday I'll be that guy, right?
Right.
Yeah.
No, and especially, for quite a while, inflation was real low.
Yep.
But then all of a sudden it just shot up. So like I said, this is the time I'm sure that these retirees are feeling it the most.
You
I've
said,
had comments
go
from
ahead,
some
Mr.
of the
Bush.
retirees, and they're very concerned about what's gonna happen to them in a couple of years, the way things are going. They've been cut down to where they can't make it ends meet, so to speak. I don't know why they called me, but they did.
So sit right there.
Oh, you're a retiree. So
Yeah. I'm involved in that group, so I don't squawk too much about it.
You were making a note that different scenarios were a percentage of payroll. That's the percentage of our current payroll, correct? Or is it percentage of what's paid out to the retiree?
Well, like I said, it all impacts that valuation report. And when I do that valuation report, I determine the funding requirement as a percentage of payroll. So in currently, the city's requirement in the current year is 30.8% of payroll. So that's how I calculate the numbers. And so that's why I use that as an answer for the question of how much.
And that 30.8 is the city's contribution this year, correct?
Right.
So what is the percentage under scenario 3, the increase?
Are you looking at that? Does it have a page where it shows the impact?
Yeah.
It shows the accumulated benefit, but I don't see the percentage. Yeah, I'm looking at that page.
I didn't see it either, but I can look real quick.
Persons, if I could add through the chair a while after the voting. As a board, you can jump up and down and scream COLA all you want. It's not gonna happen unless other things fall into place.
Yeah.
So in order for the COLA to actually go into effect, the city would have to agree to amend the ordinance to do it. So how do you connect the board thinking that's a good idea to the city amending it? So today we only have 3 trustees, and there's a total in the ordinance of 5 trustees. So you all have to vote together if you wanted to vote. 3 of the 5. And the 5 trustees, by the way, are the city manager, 2 that are appointed by the city commission, a general employee elected by the general employees, and then the at-large member who's selected by the other 4. So that's how you make your 5-member board.
Right.
So if there was interest in trying to move it along, at best, what you can do is give a recommendation if you wanted to vote to recommend it, but you don't have to do that. Another thing you could vote to do is either to refresh the study if you thought something needed to be updated, or to authorize the actuary to get together with the folks that put things on city commission agendas and see if there's a temperature on doing it. So, you know, that's the way going forward.
Those are our choices, huh?
Who sets the agenda?
So that's fine. Right.
Yeah.
That's, everyone understands
Okay.
that. Appreciate that. That's how these things could proceed if that's how you wanted to do it.
How did the other boards vote in terms of, were they in favor of a COLA? Did they specify a recommendation of what type of COLA?
So the other boards have a different issue, and I think it's important that you understand the difference.
Yeah.
So they didn't look at the COLA head on,
Mhm.
because they're looking at a different issue. So let me give you a minute,
Mhm.
and Patrick can give you more.
Yeah, yeah.
But the 1 minute is that the police and fire plans get money from Tallahassee. And because they get money from Tallahassee, in a way, that's a supplemental benefit that they get. But because for various reasons that are long-winded, their supplemental benefit had to actually go down because of the market going down. So what they're authorizing the actuary to do is to give them scenarios to turn off, if you will, this supplemental benefit and to lock it into place. So they're going to be looking at plan design issues, but not COLA issues.
Okay.
Yeah, so back in 2007, I believe is what this one is from. We did look at a 1% starting 5 years after retirement. So scenario 3 was 1.58. 1% was a 4.4% of payroll increase for the city. So that scenario would be more like 7% of payroll increase to the city. But that's based on a 2007 study. But it would be different if I studied it today.
What does FRS offer in terms of a COLA adjustment?
Europe. FRS used to have a 3% annual COLA.
Mhm.
When in 2011, when the markets were falling apart, the Great Recession, the legislature cut that out. So the quick answer is FRS used to have a COLA. It no longer does. But from time to time, there are always bills that are introduced to bring it back. But right now, there is no FRS COLA.
But I think, if I'm not mistaken, that there is still a COLA based on your service before 2011. But if you retired now and you had 10 years in 2011 and now you have 12 more years, so you have, 23 years or something, then you get a prorated COLA based on how long you were there before 2011. I believe that's how it works. Yeah.
Back when I was on the board, when we were talking about this, and I went out in 2000, the very first of 2008, we thought the city was just too small to be able to have a COLA, not knowing what was going to happen down the road. So what we did was simply each year we came back and said, okay, we can afford to, the commission would say we can afford to do this much or that much, and that's the way we'd handle it. It's a one-time shot. Then you don't have to worry about down the road.
Just for this year, nothing future.
Like what?
Just for
Yeah.
this year, nothing future.
Yes.
Right? Yeah, just kind of a lump sum.
Yeah.
Yeah, we call that ad hoc COLA, and a lot of cities do that periodically when
When they get
either if they have the money
Yeah.
to do it, or if they see that the retirees have been a long time without an increase.
In this case, I don't think they've had one since I went out in, say, January 1 of 08.
I don't think you have.
This one in 07, did it pass or no? Do
I
you?
don't believe so.
No.
No, it didn't, because you don't have automatic.
Oh, yeah, right. Yeah.
How does your, I guess, actuarial evaluation get affected if the city was to say we want to fix the percentage contribution every year and not use that to balance the pension in essence? I know that's probably not the right term to use, but if we were to look at recommending a COLA, especially something that wasn't ad hoc, but something that was kind of institutionalized, how would we have the reassurance that it wouldn't just in essence increase the percentage to the city as a whole every single year? Is there something that happens when you look at valuing the pension to make a recommendation every year?
That's just it. We look long-term when we do the evaluation. And so we will project all the future increases when we determine the impact on the city's funding. Now, that's not to say that if if city hired, 400 new employees, then the dollar cost obviously will be higher because you're giving everyone COLAs every year. So that percentage of payroll, it shouldn't really be affected. That's the part of the valuation report. That I can't guarantee because obviously market goes down, well, then the city has to contribute more, and vice versa. And if, these are all based on mortality assumptions. If all of a sudden everybody lives to 120, then we didn't value high enough for that problem. So things change all the time, but that's why we do evaluation every year and adjust the city's funding. But ideally, when I do the study, I'm looking at all the current membership, all their future investments, so that the cost is built in. When I say the cost is 2.5% of payroll, ideally it should stay 2.5% of payroll.
If you did it every 2 or 3 years and it was just for that year alone, of course, you don't take it away or anything, the increase is still there. So you're paying what? We don't know, 2 or 3% or 1 or 2% every 2 or 3 years.
Yeah, and that's when they did that study 2 years ago. They said a 5% increase.
I don't know that you could handle a 5% in the city.
Well, so they could do a 3% increase, and it would be 3/5 of the cost. Because that's the nice thing about an ad hoc COLA, is that it's linear. So you know, 5% or a 1%, the 5% is 5 times as expensive because it's just a one-time increase to the retiree benefit. If you do the automatic, well, then a 5% automatic is a lot more than 5 times the 1%.
That's
Because it compounded.
Sure does. Yep.
Well, what I was thinking was a review every 2 or 3 years, and whatever the city could afford, that's what they would do, 2 or 3% or whatever, or 1 or 2%.
You don't want to. You want to be careful of that situation, because if you say, every 3 years we'll look at it, and if inflation's been high or whatever, we'll give the COLA, then I have to value that. Oh. Now, every 3 years, the city's going to give a COLA, so the cost will be higher.
There had to be an understanding that was for that year and wherever they were at, and then in 2 or 3 years, look at it again.
Exactly. I wouldn't codify it. I would just keep that in the back of your head, and every 2 years you would look at it. You don't want to say that it's part of the policy of the board or the city or something, because then I might have to fund for it now. If we think it's going to happen every 3 years.
So we have, I know it's an old study, but what does the rest of the industry do? I mean, what's the industry standard when it comes to COLAs for a defined benefit pension?
Well, the thing is that he mentioned FRS and that in 2011 they eliminated it.
That's the standard then, huh?
So a lot of my plans had COLAs, but then in 2008, the market went down. So, because lots of plans were in good shape before that, so they could afford the annual cost of living increase. And so they were very prominent or prevalent before that. And I still do, some cities have implemented automatic COLAs for various reasons, they negotiate. But new automatic cost of living adjustments have been very rare lately. But I would say, we don't have that on the statistics, do we?
No, I
I'd
just,
say that roughly 50% of my plans might have some sort of a cost of living adjustment. Maybe it's less than that.
I could see why the city wouldn't want an automatic increase because they don't know what's going to happen next year. But what if it was something that was based off of performance of the fund? The fund is well funded and it's increasing. I mean, couldn't it be tied to that? Couldn't it be tied to that?
We're dealing with another city, Hollywood Fire, that has what's called a 13th check, and they say, okay, if the investment returns are above the assumption.
Right.
So let's say we have
Yep.
a 7.5% assumption.
Right.
If we get 8.5% this year, well, we'll give that extra 1% to the retirees. So it's like a 13th check for the retirees.
Gotcha.
Which isn't a terrible way to do it. But we will have to, like, if our assumption now is that we're gonna get 7.5 every year.
Yeah.
If you put in that type of provision where you're gonna give away some of it,
Right.
now we have to assume 7% per year, which will increase the city's cost. But it will provide a mechanism that's automatic and it's only in the good years.
Yeah,
Right?
yeah, right.
So it's not a bad overall concept, and we could implement a concept.
And it kind of limits, well, it does limit how much the city's contribution has to be.
Yeah, so if the city's, we have a bad year.
Yeah.
And the city's costs are gonna go up, then we don't give a
Yeah.
check back.
Right.
So it is beneficial on that.
I like that.
So I'm just gonna rephrase some of our options real quick, but then I'd like to make a comment about where my head is. We can obviously make a recommendation for a COLA. We don't have to recommend a specific formula. We could just say we're in favor or not in favor of, and, you know, direct that to the city commission to make a decision. We could ask for another study, have it updated. I was just looking, and I think we are below the median as far as sponsor contributions, but I'm not saying that as a good thing. I think,
Actually, I have the sponsor contributions up on the screen right now. We're
Yeah.
at the higher level.
well, scroll down. No, scroll down. Yeah. So the average is 34. We're below the average.
Yeah, that's true.
But I mean, that's my point,
Mm-hmm.
is I'm in favor of looking at a COLA, but I personally don't look at our pension plan as a 401k. So it's always been told to me as a defined benefit pension plan. However, I'll acknowledge there's some things that have happened in the past few years that I don't think we can ignore. You threw out that statistic, the 20+%. Yep. And I think people are feeling it. I'm just concerned that we're going to make that 30% number without realizing it jump closer to 40 or 50 in about 10 years time. And
That is a concern.
yeah. So again, I've got a defined benefit pension. I've got a Roth and I have a brokerage account because I know that I have a defined benefit pension.
Right.
Defined benefit. So, I mean, I'll put it out there. If y'all want to put a motion forward, I'm in support of looking at a COLA, but I think there has to be some restraint exercised with it. And I don't think that just this needs to be updated. I think we need to look at the actual implications on the retiree. Because what is 1% going to do? We may not be able to get to the actual difference, the impact. And it may just look like, you know, here, we're giving you a few cents to make you feel better. But again, I'm in support of it. I just have my concerns.
I think that what we ought to do is let the commission look at it each 3 years or so, 2 or 3 years, and decide whether they have the wherewithal to do it, rather than call it a COLA and make it automatic. Because you don't know what kind of trouble you're going into down the road.
Well, if you wanted to, just talking out loud, you know, we did this study 2 years ago today, pretty much. And it had two different one-time COLA options, 5% or 1% per year retired. And it shows them about the impact on the city's funding. So you could say, you know, the board has realized that there's been 23% inflation, and they would recommend that the city look at doing a one-time increase for the retirees. And you can provide them this letter, which gives them an idea of how much it would impact them.
Where is that letter in our packet?
It's not in the packet.
Oh,
but
something we previously received. Well, how do y'all feel about that?
I just don't want to see us get in trouble down the road, but I do want to see an increase for the people that are retired that are being sinking further and further. They see that what they started with and what they got now. And God knows if Biden wins another term, they may be giving money back.
I think it's
If you want it for, you said 2007 was the last time, at least 2007, since they've gotten an increase.
Yeah, that's when I left.
That's statistic also.
Stop that.
Not just the last 5 years, but the last 25 years.
Yeah, that number's gonna be much higher. Yeah, yeah.
I don't think you can go back retroactively and give increases to keep
No.
people up for those years.
No, you're not going to, not ever gonna do that. But they paid with dollars that were valued higher than the dollars that we're paying with now. If you look at it. Yes, sir.
Like that, you've got lots of options and perhaps deciding how much ammunition or how much options you want to give to, the commissioners and then to the manager.
Yeah.
So just to summarize those options, versus always do nothing.
Yep.
There's also the easiest with regard to full options, which is a one-time increase. That's pretty straightforward and give you a really good idea based upon the study 2 years ago. Just a one-time, and then they'll revisit maybe in the future years. That's what I'm calling an ad hoc one-time COLA. And then you've got varying degrees of expense. So another option that Patrick mentioned was a true 13th check funded with actuarial gains. And you would need a study, Patrick, if you wanted to have the city look at that 13th check paid with actuarial gains. It does have to be actuarially funded. And that's actually a lawsuit in Hollywood about they did not properly handle the 13th check. So that's increasing cost. Yes, 13th check funded with actuarial gains. In good years, you can pay out a 13th check. There may not be many years where it's paid, but there may be consecutive. It all depends upon what the markets are going to do. And Burgess is very important in this.
Yep.
And then the most expensive of this range of COLA options is a true guaranteed fixed COLA, which the FRS used to have, and now they've eliminated.
I think that what they ought to do though is to do this periodically. Take a look just like they would do now and see if it's something they want to think about.
So before I ask one of y'all to put together a motion, I believe there's general consensus to recommend for a one-time COLA, but I would appreciate it if the motion would consider some, at least guidance to the city commission on what to consider. So do y'all have anything that you want to discuss in that regard? Is it the impact on the plan? Is it the impact on the city as a whole's finances? Also the impact on the retiree? I mean, what do we want to articulate here?
Well, I think all of it comes to play. It affects the plan, it affects the city, and the individual.
Do we want to request the report prior to it going to the commission, or do we just want the recommendation to go to the commission and give them the discretion to ask for whatever report they want?
You're gonna have to do that anyway. Am I correct?
Ultimately, to do it, there has to be an ordinance. In our office, it's always happy to draft an ordinance or work with the city attorney. But what you could include in the motion, and I'm sure Patrick's happy to do it, is if city management has questions, give the actuary authority to work behind the scenes with city folks to help be adaptive and responsive to whatever questions the city may have that we may not know today.
When I looked at I'm sure there's a lot of variance in the retirees.
Yeah.
But the average retiree gets $16,200 a year. So, maybe $1,200 a month would be the average retiree. I mean, there's going to be a lot of variance.
Sure.
Well, I mean, I'll entertain a motion.
I make a motion that we consider a one-time increase for now of whatever the city thinks it can afford, and periodic review every 2-3 years.
There's a motion on the floor. Is there a second?
I'll second that motion.
Okay. Open the floor to discussion. Does anybody have anything further to discuss? So I'll add, and I'm not asking for the motion to be amended, but for the purpose of clarity, I'm in support of the motion, but I would like, if this motion passes, to consider additional guidance to the actuary on what we want to be presented to the commission as a whole. I think we're charged with that responsibility, and I think if we can add to this conversation, it would be helpful. So, any further discussion?
Let them sell it.
Well, I
Go ahead, please.
well, no, I mean, that study I did before, had two structures. One was everybody gets a flat percentage increase. The other was based on how long. Is there any ideas you guys have on that? Which one is better?
I don't think you'll be able to consider that. You're talking about past years since retirement? I don't see how the city could afford it.
When I retired last year.
Not everybody's ancient as I am and been retired as long, but even so, I know it'd be a whale of an expense.
Well, that's an interesting thought, though, because it acknowledges the fact that where is the inflation and where is the burden on the retiree? So for me, I'd like the report to take into consideration the actual impact it has on offsetting the inflationary conditions experienced by the retirees. And I don't think that that's just a baseline percentage increase on everybody's retirement income. I don't think that takes into consideration what is your household budget for food and housing and utilities. I mean, even when we do COLAs for all of the existing employees, the percentages are all over the board. I mean, the higher you go, the percentage increase is typically and sometimes lower than the mid-range employees. They see a bigger move. So I would like to, and again, we have a motion on the floor. We're having discussion. We can, call the question and put this to a vote, and we can always add a second motion to provide clarity. But I kind of like the direction that he's headed, is there may be something a little bit more nuanced that needs to be looked into.
Let's clarify what's before us right now to vote on, so there's no misunderstanding.
A one-time increase ad hoc or what the commission agrees would be an appropriate amount.
And then to look at it every, how many years?
And look at it and potentially look at it, not, it wasn't written into any kind of necessary.
Okay.
Although like we have the actuary bring it up every 2 or 3 years or something like that.
So I think to keep this moving along, we could probably put that to a vote, and then we could continue to have a discussion about what we think needs to be included in a report for the commission and the pension board to consider the COLA and or the amount of the COLA.
The details of it.
Yeah.
Good.
So any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes. So would you mind helping us prepare or
Yeah, no.
articulate a motion of how to
And
give you guidance
maybe,
on a report?
maybe what we should do is update the study and actually, I don't know how quickly you need this done, but if I waited until February, then we would have the 10/1/2023 numbers. We'd have the final perfect numbers. We'll know exactly what the city's funding requirement is for the following year. And we could base the study on that. And we could do a study just like I did before of a one-time flat 5% and a 1% per year retired. That way the city can see both the possibilities.
Give an example. When some cities have put in place real guaranteed annual COLAs, it's not uncommon to see that delayed. So it'll kick in after 5 years. So using that sort of a concept, you could say that, again, there's no right answer. You could say employees that have been retired 5 or more years, it's going to be 5%. Whereas employees who've been retired 2 years or less, it's only gonna be 1%. So you could structure the one-time COLA based upon how many years they've been. You could say, maybe and again, it may depend on what the city's prepared to spend. But if you want 5% to be on the high end, maybe that's for employees who've been retired 10 or more years. Employees between 10 and 5, it's a 2.5% COLA, and anyone who's, again, how much do you want to structure?
No, I guess we did have a max of 10% on that scenario of 1% per year retired.
How does everybody feel about that?
I think it's a good idea to go ahead and put, like you said, cap it at 10%. Otherwise.
So I'll just repeat the exact same study and I'll present it to you guys at the February meeting. That way you guys can see it too, and then we'll send it to the city commission.
How do we get some information that actually shows the financial impact to the retirees right now? I mean, is there a resource that we can go to show where they're experiencing some hardships with their expenses?
So what Patrick could give you on the amount that people are being paid, I think it would make sense to leave off the names, but would identify employee who retired in X year and what the benefits. So you can see the description of the retirees and what they're receiving. So you see that variation depending on how recently or how long ago. And then in terms of the costs, I welcome any thoughts from you on delving into expense data and inflation data. But I think that's a harder, also where people are living. Oh, sure.
Yeah, I can easily do that chart that shows each member of each of the retirees, when they retired, what their current monthly benefit is, and then what it would be with the COLA. And then that way you can at least see a more individualized basis, the impact on them.
What's the logic with the 5-year delay? Why the 5 years?
Well, he said he was talking more about people that set up an automatic COLA. And as you guys know, it compounds, right? So it's a lot less expensive if you start at 5 years after retirement than if you start at 1 year after retirement.
And current dollars, what they're getting paid and what they got paid and their pension is based on old dollars. When a dollar was worth a lot, now it's worth a lot less.
Well, that's how I was thinking about it. And I was curious why 5 years.
Well, the 5 years Adam was talking about, well, the 5 years for this particular, if we said less than 5 years, you don't get one. Normally, you haven't had much inflation if you've only been retired for 3 or 4 years. But in this case, this environment, it's actually kind of the opposite. The inflation has been more recent than it was 5 years ago. So I think I'll just do the exact same study and bring it to you guys. And then I'll also provide a chart that shows each retiree what this does for each of them.
Y'all good with that?
Under both scenarios?
Under both scenarios. It'll be one chart. It'll be retiree, A, B, C, D, their current monthly benefit, their monthly benefit with a 5% ad hoc, and their monthly benefit with a 1% per year retired with a max of 10%.
Okay. All right, I think we can move on to 3B, 2022 comparative analysis.
Excuse me, one thing. This is going to cost the pension. Patrick, do we need a motion because this is going to cost the pension, this study?
Yeah, that study, our minimum cost for a study is $1,500, but with 2 scenarios and the chart, I could do it for no more than $2,000.
We want to pay what it cost in 2007.
Still would have been a decent amount.
I'll add that A, these are all reasonable expenses. That's for you to decide what's reasonable. B, part of that study would be the basis of the impact statement. So if the city does want to move forward, they have to have an impact statement.
Absolutely.
So that would inform the impact for the ordinance.
So we'll entertain a motion to authorize the expense of $2,000 for a COLA study.
I make a motion that we authorize that study to be done.
Second.
Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes. Now are we on 3B?
Yeah, we've already talked about some of these. But we just provide every year well, not every year. COVID really messed us up because we usually use an intern to do this. But periodically we look at all of our plans in Florida and provide statistics, and that's what this is. And that one we provide free of charge.
Anything that jumps off the page at you?
Not that I recall, no.
Anything we need to be concerned about or take note of?
No, I mean, you guys, if you're looking at that page on investment returns, it's totally dependent on how much you have in certain riskier investments. So, you guys meet with Burgess every quarter and you go over the best plan for your particular situation. It's not like you're at the very bottom, so I wouldn't be too concerned about that.
So how do a handful of clients get away with no member contributions? Are their funds that healthy, or is it just something that they do as a perk?
Well, a long time ago, a lot of the general employee pension plans did not have member contributions. The police and fire are required to have member contributions. But over the years, and I know you guys used to have a 2.25 multiplier, right? Or maybe even less than that. So what happens usually is that for general employee plans, they'll want to improve their benefit. And usually that's when they implement a member contribution. So yeah, you can see their general employee plans up there that have 0%, but there's only 6 of them out of 200 and some plans. So.
And I just noticed a number of these are closed too.
Right.
Also, that will be a function of collective bargaining.
Yeah.
Any questions? Comments?
No.
Ms. Kaiser, we don't need to accept this analysis, do we?
No.
Okay. 3C?
So every year, when you guys approve the valuation report, we have to send it up to the state. And they have 2 actuaries, and then they contract out also. But about every 3 years, they review the valuation reports. And I guess in the education, you talked about chapter 112. I don't know if the actuarial reports came in there or not, but that's one of the jobs of the state, is to make sure that the plans are using reasonable assumptions and methods. And so that's what this is. And they approved your reports through 2022. So that's a great thing. But, they, according to their models, they put the average investment return at 5.25 to 5.75, which I think is ridiculous. But that's what they're saying. So they're saying we recommend a reduction, but that language has been in every letter I've got in the last 3 years. And so unless they tell us we have to, which they might someday, then we would have to, but otherwise we should look to Burgess and us and discuss your investment plan and what's a good assumption.
Well, you
And-
know, this is all different. You now have a 70-30 model. You don't have this allocation, in the third paragraph, the investment return assumption used in October, that's out of date. So a logical response would be to send them a copy, which they should have, a copy of the investment policy that was adopted in August of this year, which is significantly different from this. And your equity allocation is now closer to 70%. It is 70%, not 54. So the expected return would be higher than a 54% target.
Well, and Jill, can you flip back to the comparison statistics? Because we have the investment return assumption in there also. Probably the third page. Yeah. So, I mean, at 7.4, that's what you are currently, is very in line with other plans in the state. I mean, you could gradually look at reducing it. And a lot of our boards reduce it gradually, like go from 7.4 to 7.0 over the next 4 years. So next year I would use 7.3, the next year I'd use 7.2. That's a way you guys could approach it.
Now, this may sound counterintuitive, but the environment is different today. The bond environment is different. The expected returns of these plans is now being reversed upward. In the private sector, they have stopped lowering their assumed rate of returns. In fact, some companies that have actually gone the other way. They're actually raising their expected returns. Since the bond market has basically offered a 0% return for the last 10 years, that's been the major headwind causing these plans to be encouraged by the state to start to move down from 8 to 8.5 to 8 to 7.5 down to 7. But I think it's time to just take a pause. I wouldn't do anything. And I think we can make an argument based on where the fact that bonds are at a 20-year high in yields today. It's a very good argument to just push the pause button.
I totally agree, Burgess.
You have a problem with that?
Because like you said, when I look at the long-term returns, when interest rates have been real low for a long period, like that's when we've struggled to meet that 8% bogey, let's say. But now interest rates are higher. We've talked about it a bunch today. So if you can get even 4% out of your fixed income, and you can get 10% out of your equities, if you're 70-30, you're going to kill that 7.4. So the timing isn't right to make a lowering it.
Do you recommend staying as well?
Correct. I hate to recommend an investment assumption. I'm just an actuary, but
These attorneys, right hand, left hand, just to give more perspective. Florida retirement system that you're asking about earlier. The FRS uses a discount rate of 6.7, and they've been lowering it over time, but they just paused this year. So that's an example of pausing. And I'll also point out it's not necessarily an apples to apples because they use different actuarial methodologies for FRS. But if someone were to say, how does your investment return assumption compare? You can see it on the chart. And the folks in Tallahassee, right or wrong, they want to see gradual changes. And a lot of plans, as you started to do when you went to 7.4, are gradually. So it's over time. That's a conversation. And there's something magic about a 0.1, 10 basis point. And some plans have done 5 basis points, or over the next X number of years. It's the trend that Tallahassee cares about. And you're right when Burgess mentions that today's environment is very different from just a few years ago.
Everyone is redoing the calculus now. They're talking about changing the allocations, going back to a higher weighting in bonds. I mean, a lot of rethinking is going on right now. I think it would be, just to reiterate, a good idea to just hold off for a year.
Well, I wanted to ask where we're at in the process of this. Do we have to give guidance on this today, or is this for information for the upcoming actuary report?
Yeah, I just looked and you went to 7.4 last year and no direction for me to lower it even more. So you don't have to do anything with this letter, just accept it. You don't have to make any special motion unless you wanted to change that assumption.
I'll open the floor. There's no motion. We'll move on.
Sorry, do they expect a response?
There is no motion. I was opening the floor for a motion, but I think the consensus is leave it alone.
Yeah.
Okay. Okay, thank you for that report. Moving on to number 4, Burgess Chambers and Associates report.
Good, thank you.
Yeah, I love Burgess and he gives great reports, but do you guys mind if I leave? Is there anything else that will come up for me?
I don't believe so.
He's got to drive to Fort Myers. He wants to cut out of here.
It's been a long day.
Drive safe.
Thank you.
Thanks for your work.
Okay, first page, please. I'll tell you who puts a lot of work into this is Jill. I don't know if she gets enough credit, but behind the scenes, she's wonderful to work with, and we'll certainly miss her when she moves on to her next adventure. But anyway, this first page, you have it in front of you, and touched on it today at the education piece, but essentially the rapid rise in interest rates driven by inflation and on the policy end by the Federal Reserve, they kind of go in tandem, has taken the inflation, the risk premium associated with owning stocks versus bonds and sort of flipped it upside down. So you can earn now pretty close to 6% yield maturity on a bond portfolio, where that not too long ago was closer to 2%. So that's making equities less attractive on a relative basis, and that's why we are exploring with all of our clients the concept of going back to a higher bond allocation. Now, we have been talking about this for a decade. What do we do? What are the alternatives? Well, we introduced here convertible bonds. We introduced private real estate. We introduced high yield. We did all kinds of stuff here to try to, in a complicated way, fix a simple problem. But now the problem is less serious now because we have these higher rates. So we're going to talk more about that next time when we get all the work done. If you go to page 12, the target allocations here are dated because the policy that was adopted in August technically didn't go into effect for 31 days, and which is just a few days past the September 30th. So my office, we just do it by the book. See you, Patrick. Have a safe drive.
Thank you.
Thank you.
So this is significant. If you look at the domestic equity former target of 37%, it's now 52%. We have moved done a big lift here. We've pulled money out of convertible bonds. They've been knocked down from 8 to 5. We've moved 7% out of international from 15 to 8. We moved 5%. We eliminated the REITs completely because we can, they're liquid. We reduced the target allocation for private real estate from 7 to 5 and increased the bonds from 22 to 24. But what's significant is the de-risking. By pulling 7% out of international and pulling the 5% out of the REITs, that was a significant de-risk. And so now when you look at the new investment policy, we have a 40% target to large cap. I'm sorry, 40% allocation to large cap, 6% to mid cap, and 6% to small cap. We've already started that that conversion, and you can see it in the last bullet of the write-up. And I'll show you a couple things that you might find interesting. If it's too detailed, let me know and I'll stop. But if you go to page 15, what we had before the change began, we had exposure to large cap growth, large cap value. These are both actively managed, and then large cap value. Okay, so we had the growth index, we had Voya, which is actively managed, and then Ceradex, which is actively managed. What we've done is we have now introduced the S&P 500 index, which is a combination of growth and value. So we've taken some money, the money that we took away from international and the REITs, for example, we use that to buy the S&P 500. Why did we do that? We've cut the fees and reduced the volatility. That's why we did that. In the mid-cap department, Fidelity Mid, which is a core product, the S&P 400 growth, and the Ceradex value. We've eliminated Ceradex value completely. They're now, and we've basically collapsed the value and growth components into the core. So now instead of having three mid-cap pieces, now we have one. Simplifies, cuts the fees, and now we don't have this oscillation between growth and value. We left the small cap alone. Cohen and Steers, we reduced that based on the new policy. We took 200,000 away from them. Reduced the convertible bonds by 625,000 to be in line with the new policy. And down next page, international, we cut that significantly, from 15 down to 8. So we pulled about 1.4 million out of international, and we eliminated the REITs. Now, I think what the final outcome here is going to be simplification and lower fees. And I think we're going to do, the performance will be better, and we won't have to do so much engineering every couple of months when growth and value get kind of out of whack. So this will be a much easier program to manage for everybody. While we're on page 16, I want to focus on bonds. We did move about 800,000 over to bonds, so we added to it. That's based on the new policy. I should add that the high yield, which we talked about a little bit today, I think at lunch, that's something that's not a significant allocate. Well, it's about a quarter of it, but it has really added a lot of value here over the past year and the past 3 years. And that was a nice add-on to the high quality bond program that boost up the returns. So, we're looking at a report with a lot of changes that really haven't been fully realized yet. We haven't seen the outcome of these changes. Now, where have we had the most headwinds for this report? The headwinds, I'll show you where they've come from. Let's start with Voya large cap on 15. We've talked about this. The Fidelity Large Cap Index, which is essentially what it's compared against, actually it's the Russell 1000 Growth Index. We suggested to you within the last year to move half of the Voya money over to the index. And you can see we've done that. And returns have been better. The index 1-year return was 5.2 percentage points better than Voya. You've heard of the Magnificent Seven stocks? There's 7 stocks that are driving the entire market. And they happen to be large cap growth stocks. And you've heard of them: Microsoft, Meta, Amazon, Tesla. But Voya is a more diversified portfolio it doesn't have that concentration. So, but it's a headwind because it's measured against a benchmark that it can't beat. It's not even close. That's headwind number one. Major headwind. The other headwind of significance is the Cone and Steers infrastructure. What is that? What's going on there? Well, half of their portfolio is in utilities. These are solid companies. They pay a dividend. They can pass on their cost increases through the rate commission to the customers. They have no competition, sort of their oligopolies, but they are very sensitive to interest rates. So when rates went up real fast, well, as you know, they went up crazy fast. The utility companies couldn't raise their dividends fast enough to keep up with them. So investors who otherwise would stay in a utility stock said, hell with this, I can get 5.5% in a 6-month treasury. And that's what they did. Now, why do I like it? I like what they own. This is more of a value play. And when rates when rates roll over, and I think they will within the next 18 months, they'll start going down again. You'll see this thing take off because you'll see people going back because they can't get 6% in a 6-month treasury anymore. So they're going to go back into this. Another headwind is American funds. Now, we have cut international dramatically, but as an asset class, except for this past year, when international was up 20%, in the prior 15 years, international was behind the S&P 500. So we're not completely abandoning international, but we've dramatically cut back your exposure. And if you look at your peers are generally in the 15 to 18% range target. You're at 8%. So you're 1/2 the allocation of your peers. Why am I doing that? Well, we think the world's changed. And ever since China joined the WTO 22 years ago, the invasion of Ukraine and all the tariff problems we're having with China right now, trade with China has dropped in half in the last year. Half. And this symmetry now between China and Russia is a real problem for the West. And so international is kind of losing its sizzle. Europe is the other area that has some interest, but Europe is faced with huge energy problems, rising gas prices, shortages, and Germany, being the major economic engine of Europe, is now in trouble. Germany is in a recession now. And Germany is moving operations out of the country. They're moving operations here. The South Koreans are moving operations here. Just drive up to Savannah and see what's happening. Just see 16, go west on 16. The Hyundai factory that's going in there is huge. And the LG battery factory is so huge. It's just up the road, 2.5 hours from here. So a lot of things happening where international is less favorable. And now finally, let's talk about real estate. You had some great questions during this discussion about the feasibility, and it was a time right to go into private real estate. Now, long term, I like real estate. I like the stability of it. But what caught everybody by surprise, to be honest with you, is that core real estate, and this company is one of about 28 or 30 that kind of do the same thing. Their 20% or so exposure to office has hurt them. Office companies that own offices and operate them are having trouble getting financing. These guys aren't, because their debt structure is very favorable. They only about 18% of the portfolio is leveraged, the rest of it's equity. We all know what's happening with office. You don't have a lot of it here, but nationally office is in trouble and will continue to be marked down. Even medical office in Boston, which is premier office space, is having difficulties getting financing. These are office buildings that are essentially fully leased. So that's the major headwind, and that's why we eliminated dividend reinvestment program earlier in the year. So all that money that otherwise was being used to buy new shares is coming back to the plan to pay expenses. We'll leave it that way indefinitely. Now, the question might come up, why don't we just put in a redemption request? That is to start pulling principal. Well, we can do that, but American has been very stingy about redemptions. The best we can do is to get maybe 5% a year out of the portfolio. I'm sorry, 5% a quarter, which would be about 20% a year. Now, here's the dilemma there. And this is something I learned from Ash Williams. That name may ring a bell, but he was the CIO of FRS for a long time. I consider him a colleague. The problem with trying to pivot out of private real estate is since it's not really a marketable, tradable security, it's not really a security. When you decide you want to start going back in, you have to get in a queue to get back in. So you're in a queue to get out, and now you got to get in a queue to get back in. So once we think, things are improving, we're seeing valuations go up 5-10% for 6 months, a quarter, you're going to be chasing returns, and you don't want to do that. So I think we'll just have to ride it out. It's not a big allocation. There's some plans that have as much as 18% in private real estate around the state. You're not in that boat, thank goodness. So when you look at the lagging performance numbers that are shown here in detail on page 8, I don't want you to be concerned about it. We've already made the adjustments. And if you go back just 2 years ago and look at what this thing looked like, it was a completely different picture. And 2 years ago, you looked pretty sound. Results were in the 7.5%, 8% range. But what happened was one unfortunate year, which is in here. That's 2022, screwed everything up. If you go to page 23, the reason for these lagging returns is really because of 2022. Are you all pretty comfortable with what caused 22 to be such a bad year? And that was not this year, but last year. Are you pretty comfortable with what happened? That was the year when the Fed began raising interest rates in January of 2022, and they were aggressive. And when they started doing that, it not only crushed the bond market because it's very sensitive to interest rates, but it hurt the equity markets too. The market was convinced that the Fed was going to roll the economy into a recession. Corporate earnings would go down. So as you saw during the education piece, the likelihood of this happening again is virtually zero. The long-term correlation between stocks and bonds is zero. But in 2022, the correlation was 1. They're perfectly aligned, and it's not supposed to work that way. So that's what crushed us. The only other thing I can tell you is that there are other plans, much larger plans, that have private instruments, private equity, private credit. They fared well in 2022 because those assets are not marked to market. There's no liquidity. There's no way to really judge what they're worth. So what's happening right now is plans that fared well in 22 didn't do as well in 23 with the holdings they have in the private area, and they can't get the money out. Now you saw all the moves that the readjustments and allocation that we just talked about. Those plans can't do any of that. They're locked in place. So you still have the luxury being liquid to be able to pivot. It's a nice thing. So for the fiscal year that just ended, results were in the ballpark. with your assumed rate of return on page 4. 7.6%, I think where you at 7.4 is the bogey. You're already up, the equity's already up 10% so far since we started the new fiscal year. The bonds are up about 3%. So you're up about, say, 4% so far in this quarter. So with a little bit of luck, and if Fed Chairman Powell would keep his mouth shut, we might be able to get through the holiday season through December with a nice return. And you're already positioned to benefit from that. Any questions?
When does the real estate get revalued?
Good question. There's a little bit of, it's not a very efficient mechanism, and the entire industry uses the same, I'll call it, inefficient mechanism. So let's start with the firms themselves. They do monthly internal appraisals. They use discounted cash flow. They use comps if they can find them. Then they use an outside company to look at their methodology and essentially confirm that the way they're doing it is correct. But the actual MAI appraisal process is not done in a snapshot. It's staggered throughout the year. So it really takes about a year to get a full reappraisal from an MAI.
About a quarter of the portfolio every quarter.
Okay.
It's inefficient, it's slow, but there is strength. It's in the industrial area, still very strong. Multifamily is still strong. It doesn't have the trajectory it had before, but I know that the permitting, because I follow this and you do too, the appetite among developers to continue this ongoing rolling out of new projects is starting to slow down, which is good if you already own something. I should mention that as much as retail has gotten beat up, retail is actually coming back. And that's because what COVID did was it accelerated the demise of the zombie retailers. It just got rid of them fast. And so the retail operators have been able to make adjustments more quickly and moved in new customers. So people are going back to the malls. Now, we're not talking about Philadelphia and Pittsburgh and Baltimore, where they have all these old legacy malls that are really in bad shape. But malls just in Florida, you see a renaissance of rebuilding and retrofitting malls. In this case, American doesn't own any malls. They own anchored strips. They own some in Florida, like a Publix anchored strip mall, strip center, and they're all doing just fine. Their main headwind is office. They own 10 office buildings, and that's it.
And that's what our exposure is to?
Huh?
That's what our exposure is to, office?
Yeah, their exposure now is about 18% of the portfolio, and it represents about 10 buildings. There are several of them in Manhattan that I can think of. There are several on the West Coast that have been a burden on them. I mean, they have an office in Washington State, Seattle, where the major tenant was Amazon. Is it Amazon? Either Amazon or Apple. And no, it was Amazon. And Amazon, it's Class A space. They moved out. And it moved out mainly because of the taxes. And people didn't want to, maybe it was Apple, I can't remember, it doesn't matter. The employees said, look, we'd rather work from home, or we'd rather just work in a suburban environment where it's not so crazy trying to get to your car in the afternoon when they're having protests out of the street. So so that building is about 35% vacant. And that's of the 10 they own, that's the biggest challenge they have. But their New York City properties are fine. And they have an office in Boston in the Cambridge area near Harvard College, which is doing very well. In fact, they're building, involved in building another one in Boston. So that's all I have. Just hang tight. I think things will work out for you.
Okay, I see we have the Voya letter here. Do we need to accept the report?
You need to accept his report, yeah. The point letter is more informational.
Okay.
Make a motion that we accept the report as given.
Got a motion? Your second? Any further discussion? Seeing none, all in favor say aye. Aye. All opposed? Motion passes. All right, item number 5. Mr. Levinson?
It's a pleasure meeting everybody. And you know, I'm filling in for Anna today. And it's gonna be a quick attorney's report for a couple of reasons. A, because it's a quick attorney's report, but B, I have to run to the airport. So,
He said he'd do it in 1 minute, and I'm
Yeah.
timing it right now.
the attorney's report can be quick, and then I also wanted to pick up what the other 2 boards have done with regard to plan administration. So and you see there are a bunch of memos, I'm not gonna go through them all, but House Bill 3, just by way of memory, update. Was a law passed by the Florida legislature, and the key word was pecuniary, meaning that you can only invest on risk-adjusted return. That's pecuniary considerations. We are not to be investing based on political, ideological, or social, but we're focused on making money in a safe way. So how do we demonstrate that to Tallahassee? And you'll see that there's a new reg that came out, a regulation from the environment, which tells us how we upload into the portal. That's the document you're looking at. That's a memo from our office. So underlined is the reg, which is nice and simple. And Jill is all over it. So she's taken the template that we prepared for her. She put the name of our plan on it, and she's going to upload it with the investment policy that Burgess worked on. And you'll upload that in the next couple of days when we are done. And we can talk about it in more detail if you have questions. I left my cell number, by the way, for Jill. That way, if any questions come up, she can call me. But are there any questions about House Bill 3? How we are in compliance? And I'll point out, you'll see proxy voting. That if we own stocks directly, then we have to make sure that the proxies are being voted based upon pecuniary considerations. But in the case of mutual funds, we're not voting the proxies, so that doesn't apply to us. They're voting the proxies. So no further action required. And I just want to make sure everyone is clear with House Bill 3 and we are in compliance and Jill knows what to do. On that subject of Jill knowing what to do, I don't want to make the announcement. Do you want to tee it up?
Well, the board knows that I'm leaving next October and I'll be retiring, and that at the last meeting, we have voted to include the budget for the general pension board to include additional money to finance a pension administrator to start in January. The commission ended up revising their budget after they accepted it, and that is one of the revisions. We don't have a pension administrator starting.
So what does the board do? And the answer is you've got flexibility, but I described to the other boards that increasingly what we're seeing is third-party administrators, TPAs. So the city may decide if they can find someone in finance or HR who can be brought in to try to fill Jill's shoes, that's an option that the city may budget for it. And a part-time employee or someone to be assigned to the boards part-time, or to do an RFP, which is what the fire board decided to do and the police board. So they agreed to, and our office does these all the time for different vendors. And there's a handful of companies that's what they do. They're third-party administrators. They have professionals with multiple people who would be assigned to your plan. They would come to the meetings. They would do minutes. They would, there's all kinds of things that they do. They're professionals. Now, what is the cost? And the answer is we're not going to know until we send out the RFP. And just because we send out the RFP doesn't mean we have to do anything. And just look at the information if you want to go down that road. So there are economies, though, if all 3 boards decide to hire the same administrator. And I don't know if all the same boards are going to agree, but if you all agree to use the same administrator on the same day, that'll save money because it's more efficient. And I'll also point out to you that Foster and Foster, and Patrick is not here to advertise, and he's a humble guy, but Foster and Foster is an administrative arm where they provide plan administration. They're one of the biggest administrators in Florida, which makes a lot of sense because they're actuaries and they can do administration. So I'm not recommending that you use anyone. What I am recommending, though, is that you consider doing an RFP. And then if you do send it out with the other 2 boards, then there are 2 other questions that come up. Because if you get 8 responses, for example, then you probably don't want to interview all of the companies. You probably want to winnow down the list. So at a future meeting, you look at all the responses, the detailed packets you get, and decide who you want to bring in to interview. And it may make sense to do that combined if you do interviews, and maybe 3 or 4 is a good sweet spot. But to do the interviews with the other boards
Now, again, you can't promise, maybe the police are gonna go off and wanna hire someone who is a former police officer, who knows? But there are advantages if you all decide to use the same administrator, and that gives some time for the city to decide, do they wanna try to retain someone or recruit someone who can try to do Jill's job? But at least you've got that option, because October, you need to have somebody that tries to do what Jill does. So let me take any questions about third-party administrators and what that's about.
Can the different boards select their own administrator, or does that decision lie with the city commission?
I looked at the ordinance, and the pension board has the authority to do it. Now, the city can wink, wink, nod, nod. We would appreciate boards if, we all work together here. But just as the boards can hire their own attorneys, the boards can hire their own actuaries. They could, in theory, decide to separate the different administrators, but there are all kinds of good reasons why finance, because the finance director was, I keep pointing, was sitting at the end of the table, why it's just easier for the city, instead of dealing with multiple companies, to have the same company. So, the city can sort of make the request or encourage, and that can be said, by the way, if you hold their group meeting, but ultimately the boards have the autonomy to do what they want when it comes to hiring board professionals.
First of all, I want to compliment you on your firm's Herculean effort in getting this House Bill 3, the language figured out, because your colleagues, I think all of us were confused about how to approach this and how to solve it.
As much as I appreciate, talk about that when I leave. Talk about me.
No.
There's a lot behind the scenes, and Burgess isn't giving himself credit either.
No. You're a humble guy, see? But let me comment on the administration. It's important that the administrator there shouldn't be a lot of volatility in who's doing that. It should be some longevity in that role. There's a lot to learn. And we've had a history here of having administrators for a long period of time, and there's some benefits to that. So I'll just leave it at that.
It's an important decision. I want it to be a thoughtful decision. And again, if the city can find folks in city employment that they can train over the next year, that's an option. But also, I want you to have access to the RFPs, so you'll be able to make informed decisions. Trustees, that completes the attorney's report. I want to thank again Jill and Burgess and everybody, and I'm going to fly. If any other questions come up, you've got my cell number.
Totally understand.
Thanks, everybody.
All right, safe travels. So Jill, what were the specific motions made by the previous two boards?
The fire board made a motion to have the attorney put out an RFP for a pension administrator. And he said it would go out to about 12 firms, 8 to 12 firms, and they would expect something back at the next meeting.
It's a third-party administrator.
Third-party administrator. And likewise, the police did the same.
Same motion?
Yes.
Did they express a desire to have the same administrator across all pensions?
What the attorney explained is each pension has to put out its own RFP. So each pension has the ability to choose whoever they want. But he recommended, through economies of scale, to have a joint meeting to discuss and interview. Like each board might choose the top 3 or 4 and then get together and interview jointly.
Could you not issue one RFP and put the disclaimer language in there that all the boards reserve the right to award their own administrator?
I don't know why but he specifically said there would be 3 RFPs.
Well, how does everybody feel about it?
I mean, for the other pension boards, they're on a quarterly cost for the attorney. The general board pays attorney fees as they come about. So it would be a charge to the pension, to the general pension, to do an RFP. But he had indicated it'd probably be an hour's worth of time, because he just did one last week and they just substitute in numbers and names.
And there's an issue, it hasn't been brought up at all, and that's cybersecurity. And that's a big deal right now. And when you get into that, delve into this process next year, that's going to be a big part of it. How do you want a firm that has the technology to protect the information that's so vital.
Good point. We need a third party administrator. I think we should put out an RFP. That's how I think. If we drag our feet and wait.
We can, if we're gonna have a joint meeting, you talked about a minute ago to decide where we all want to go in on the same one.
No, it would be a joint meeting to do the interviews after each board has chosen 3 to 5 candidates, then they'd see where there's,
Got together and decided on one.
yes.
You'll be lucky.
Interview them.
You'll be lucky if you get 3.
Yeah.
I mean, there are fewer than a dozen, and given the size of these 3 plans, the number of souls, which is how they kind of, work out the math, you'll be lucky to get 2 or 3 to actually come.
Okay.
We're not as
entertain
big
a
as we think
motion.
we are. Make a motion that we put out an RFP for third party administrator.
Have the attorney put out an RFP.
Yes, ma'am. I'm sorry. I have the attorneys. I didn't mean to look at you, Jill. That we have the attorney put out an RFP for a third party administrator.
Perfect. Got a motion and a second. Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes.
Is it your understanding that the cost would be shared by the 3 plans?
For the administrator?
The cost of the attorneys, the process of doing the RFP and the.
No, because the other 2 plans are on a quarterly, $1,500 a quarter for attorney services, but the general plan is not. It's pay as you go with the general
Okay.
plan.
Well, how are they gonna pay for it?
Out of the 1,500, it'll be billed in the 1,500 that they currently are getting charged.
So
See, they
why is it an
get
additional charge for us?
Because you don't pay a quarterly fee. The general pays as services are provided.
Okay.
That was decided a couple of years ago.
It's $455. All right, quarterly expenditures.
And I can't show anything, everything's stuck.
Okay, well, we got it right here, Jill.
Okay. Nothing really unexpected. You can see budget versus actual for the fiscal year. It's not just quarterly because we're at the end of fiscal year.
And I don't want to keep us here much longer, but it's something that's been on my mind. What do we do as a city when you have someone who is vested and they make their withdrawal when they leave?
What do we do as a city?
I mean, do we encourage them to talk to a financial advisor to get some wise counsel from anybody?
Yes, we give them packets from the attorney explaining the tax implications of doing that. And I'm not allowed to advise them, but I encourage them to talk to other people, tax attorneys predominantly, because there are tax implications.
You have that happen very often.
Rare.
I would say
It just happened recently that a vested person, it happens periodically. People want to make investments in their house and see they're young still, or they want to make investments in setting up a business.
We used to have some of the laborers that would come in and when they get in, you see all the relatives out there just waiting.
It hasn't changed
We had a
much.
representative called Mary Lawson, we sent her to talk to her. Before she could just wait.
All right, do we need to accept quarterly expenditures report?
Make a motion that we accept the report as given.
There's a motion. Is there a second?
Second.
Any further discussion? Seeing none, all in favor say aye.
Aye.
Aye. All opposed? Motion passes. Meeting dates, 2024.
The one issue is the dates were selected in August for fiscal year, calendar year 2024 are fine, but the times in June 4th had to be changed because there's another meeting starting 4 o'clock in the afternoon. It was,
So we just moved it up,
yes.
2
moved it
o'clock.
up to 2.
We're going to 2 o'clock.
On, not
on that.
next one, June 4th. So I'll give you plenty of notice.
That's just for information, right, Jill?
Yes.
Okay. Revised budget?
That would deal with, what, the attorney was talking about, the fact that we had put in the budget, we had revised the budget in the August meeting to include a finance an administrator, a pension administrator, and now I brought the budget back down. However, the police decided to leave it where it was, the fire changed it, in case it impacts when we're going to start a third party, if a third party, it's not required to change it.
Gentlemen, I just assume leave well enough alone. Y'all in agreement? Okay. Think that concludes our business. Are there any public comments?
None.
Seeing none, I'll entertain a motion to adjourn.
I have one informational question. I had a,
You got to speak from the podium. I'm kidding.
I had a member or employee at the gas authority who heard that the retirement date had changed or was being changed. I wasn't aware of any change to it.
There is no change.
In fact, he'd been told that it was changed to 62.
And you know, there's always rumors out
Yes.
there. It's best to direct them to me because they talk to each other and
Yes, they do.
no, there's
Nothing.
nothing.
Okay. I'll make a motion that we adjourn.
So moved. Second. All right.